This is Emergence. Our first Fireside Chat of the day is hosted by Daniel Kuhn with his guest, Jack O'Halloran.
Thank you all for being here for the start of Emergence, Block's first conference. And thank you, Jack, who is the founder of Scale Network. To start off, could you tell me a little bit about how Scale fits into the Ethereum L2 landscape? How does it compare to Arbitrum and Optimism?
Yeah, great question. Hey, my pleasure to be here. Thanks, everybody. So Scale is the world's fastest blockchain. Okay, so it's actually a network of blockchains. There are 18 blockchains right now, all operating together with one shared validator set in the Scale network. Scale's ranked almost every day in the top 5 in terms of transaction volume and unique active wallets. So we have millions and millions of wallets interacting and doing around 60 million transactions a month. And so, I'm really specific to say it's a network of blockchains because it's also built on Ethereum. It's integrated with Ethereum. And to say it's almost a layer 2-ish implementation, but each chain itself is a powerful layer 1 with anchored security back to Ethereum.
Cool. Do you ever feel like the Ethereum layer landscape could get oversaturated?
Sorry, one more time.
Do you think the Ethereum layer 2 landscape could get oversaturated with dApps like Uniswap launching a layer 2 and exchanges like Coinbase and Kraken launching their own L2s? When do you think is enough?
Yeah, well, in terms of the dApp ecosystem being saturated and
just the scaling layers. When do you think we have enough?
So for me, our goal, so Scale is also gas-free, okay? And so it's gas-free because the Scale token is used to pay in advance for block space. Now, if you don't have an economic model that's, linearly scalable, because blockchains at some point will get congested. When they get congested, then you need to have, an escalated price in order to kick new transactions that are important to the front of the line. It's almost like, I took an Uber today, and so a lot of other people wanted an Uber, so I had to pay more because there was a surge fee to get my rider. If there wasn't a surge fee, everyone's just gonna have to wait, and then the service isn't gonna be good, and people just won't use it. And so gas fees have a similar surge fee. Now, within Ethereum, and then I'd say the standard layer 2 landscape, not what Scale does, but what these other products that do roll-ups, they then are having these secondary layers they're actually centralized infrastructure. They're just running software. They're running Amazon instances or Google Cloud. They're running a blockchain that's their own. And then their goals for decentralization are then to just be able to stamp the results back to Ethereum. But they're running centralized software, and they're taking fee cuts. Now, with that model, you can get some cost savings, but you still, if you don't want to have high latency, you still are going to have high fees. And so then they're saying, well, we didn't realize this was going to happen. It was like they keep kind of painting themselves into a corner with design, and they have to come up with another layer because there's no more room in that design space. So then now there's layer 3s. Now layer 3s have even more latency because those layers have to consolidate transactions, push them down to the layer 2, which then pushes them down to the layer 1. And then I think to your question is there's now the unichain and there's a gazillion layer 2s. My personal feeling is when you have centralized software at play, you will have power laws. There will be 99% of them probably won't have much business in 3 or 5 years.
Yeah.
Which
so we're facing a future of zombie chains, basically.
Yeah.
Yeah. Okay.
Yeah. So I think there's going to be a dramatic shift back to decentralization, and you even hear it within the Ethereum halls. They're saying, let's create based layer 2s. Let's create native rollups that are fully decentralized, that aren't these like fee-sucking centralized entities. And Scale is actually just decentralized blockchains scaling Ethereum that use Ethereum as a base anchor. And so there's no centralization. The Scale team doesn't take a cut of transactions. But I think it all depends on what is your view of decentralization? At the end of the day, what's the best thing for the end user?
Yeah. I mean, ultimately, you need applications. Scale is known for gaming, but also crypto gaming hasn't necessarily taken off. What is your explanation for that? What has gone wrong in crypto gaming?
I think that's a really, really phenomenal question. So gaming, there are around 3 billion gamers, people that play games every day. They just pull out their phone and they're playing casual games. In the crypto world, it's estimated there's around 30 million active players. So that's a small fraction of 3 billion. However, 30 million users compared to other categories, there are not 30 million DeFi users. There's 30 million people that use exchanges, centralized exchanges, but they're just trading tokens, right? Buying tokens, selling tokens. So gaming is actually, I think, leading the way in Web3. Now the token values of these games, they're a little depressed now. But my feeling, and not talking about prices, but in terms of growth, we're going to see Web3 gaming absolutely catapult ahead in terms of that next layer of real mass adoption, positive mass adoption.
Yeah. How do you feel the post-election landscape has changed the crypto industry?
Sorry, we got a weird echo in here. Right?
What do you make of Trump winning, and how will that change crypto?
In what? Sorry?
Trump winning.
Oh, Trump winning. Okay. Well, for those listening, I think everyone can hear us really well, but I'm getting echoes back. So I think Trump winning, it's really, I think let's set aside people's individual political beliefs, because it's a hairy topic. Let's just talk about the SEC, and let's talk about crypto regulation. There's going to be a dramatic change that's incredibly positive for the industry. And just focusing on that, because I think it's a topic that, that people listening, I'm sure there's a lot of different viewpoints. But in terms of businesses being able to leverage Web3 technology, it's going to be a massive game changer. You and I were talking about this earlier, but I talk to traditional businesses every day. Some of these big businesses that were at the forefront of Web3 adoption, last 6 months ago were saying, yeah, we're shutting our Web3 program down. We're getting sued, we're done. One, consumers, this isn't hot anymore. Two, why, I'm going to get sued, I'm going to get in legal trouble. This doesn't make sense. And so all of a sudden, all those people that said we're shutting down, they're calling me back. They're calling people like me back as well. And everyone's saying, hey, this is going to take off. One, this is going to take off again. It's going to be hot in the eyes of consumers. Two, we now have we think we're going to have a legal framework to operate in. And I think having that legal framework with certainty, clarity, and confidence is going to help propel a lot of these products into the market in a real way that's going to be a lot different than the last time. The last cycle was press releases around, this big company's doing this, and nothing ever launched. right? And then the cycle before, it was like DentaCoin, like we're all gonna, as an example, like we're all gonna pay for our dental procedures with Denta token, like, so there's a lot of these like hype mass adoption promises that failed. I think we're gonna be in a different spot this time, and I think the legislation is gonna really help propel that forward.
Are there specific enterprises that crypto is missing right now?
Yeah, I mean, so what I'd say is I'm under a lot of confidentiality agreements about the deals we're working on. But what I'll say is like there are so many, every major sports league right now is like diving back in, okay? Major sports teams, these mass consumer entities are saying, let's get back in and let's go get involved. And I think that's one category of enterprise adoption is people that have huge communities and fan bases, and they can catalyze them more and monetize slowly and indirectly. In the past, I think there's a lot of failed attempts because enterprises or businesses or teams that had huge audiences or leagues, if they thought about monetization too quickly, they end up burning their, their community. And so I think there's a different implementation this time around. And then there's other categories we could get into as well in enterprise that are exciting.
Another major difference between this cycle and the previous one is the rise of Solana. Do you think there is a risk to the Ethereum ecosystem for Solana becoming the dominant app chain?
Yeah, I think, so when I look at, I think, hats off to Solana. They've executed really well within the markets they're going after. And so, and I know a lot of the people there, a lot of respect for them, hats off to them. Scale, we've been focused really on gaming, as well as decentralized social products, DePIN, AI products. And so we have our zone, and I think Solana's been very successful in a few areas, and I'm sure they're gonna keep doing well, and and so will other people that have some focus.
Yeah. Could you discuss how marketing plays a role in crypto? I think you recently hired a CMO.
Yeah, so we just recently hired Andrew Saunders, who's I think the most seasoned, skilled CMO in the space. His background from Hollywood and NBC Universal, Amazon, and then he was CMO for Arbitrum and some other crypto projects before joining Scale. But marketing is very interesting in crypto because in crypto you have to understand you have to implement multi-audience marketing. You have developers, you have business leaders that line of business decision makers. You also have this huge retail community and mass consumer adoption. And if you don't do a good job of driving awareness amongst that group, you're going to be less successful actually marketing to developers because if you're launching a game, you want to be able to launch that game into a huge audience of players, okay? And so that's one thing I think our marketing efforts have really done well in the last year is that we've been able to attract so many different game players that then creates this ecosystem. But we have to market to them, drive awareness to them, and then pull that audience together for the dApp developers building on Scale.
Do you feel like you have to co-market for the dApps on your network?
You know what? It's interesting. So if you look at the world of gaming, you have publishers. Publishers, their job is they own a part of the game, but then they go and they promote it and they distribute it and they have this audience that they can tap into, and they've got influencers and different online marketing channels to essentially drive awareness and adoption. Blockchains are almost similar. They're almost the publishers of crypto, and whether not even just gaming, but that's the same thing if there's a Web3 product launching, there's other products launching. You have an obligation to co-market because at the end of the day, we are just some geeky lines of code that really deep cryptography. We're behind the scenes. We're almost like what AWS or Google Cloud is to consumer applications.
Yeah.
And so we show our our specialness and our execution and implementation through partners. And so it's really critical to help them be successful and help to drive adoption.
So you have a background in AI. Do you ever feel like you got into the wrong industry?
Yeah, I started an AI company in 2008, and I did it for 9 years, and it was the leading life science AI product. So we had 18 of the top 20 biotechs and pharmas, and I worked in AI for a really long time. This was on the commercial side, not on drug development, drug discovery. This was using machine learning, AI, advanced analytics products to help these companies implement on the commercial side. So I like to say I worked in AI when AI was dumb, and I got smart really quickly. But I think AI and blockchain first off, there's a ton of hype. There's a bunch of garbage. I'm not saying people are like, oh, let's slap these two labels, and that's not what I'm talking about. I'm talking about real implementations. AI and Web3 were meant for each other. If you think about it, it's programmable money. We can program if A happens, then money goes to B. If not, or C, you can put logic in to have instantaneous impact on value. Now, that also makes sense when you can combine that with artificial intelligence, right? And so if you can combine these two strengths together, I think we're going to have some amazing applications with automated payments, intelligent bots, intelligent support products for people and businesses that leverage crypto for microtransactions and different payment mechanisms. And so, I think that's an exciting topic in space.
Yeah. Do we have to fear the AI apocalypse?
Oh, yeah, so being an early AI entrepreneur, everybody back in the day was reading this book called Superintelligence, which I highly recommend to read, even though it's older, but it's all about, this AI apocalypse and, this learning curve of AI that it goes slow and then all of a sudden it goes really, really fast. And at some point, we will not be able to stop it. Now, I think we're still a ways off from that. I think it's a risk, but I personally am not in the decel camp of, hey, let's stop innovation and I think having these free market innovation is important, but it is a real threat. And, Terminator, we don't want to live in a world of, Terminator.
Yeah. It's interesting that one of the key use cases so far in AI crypto has been in meme coins, like these Twitter bots or supposedly autonomous Twitter bots making millions trading meme coins. What do you make of that whole phenomenon?
There's a famous investor in Silicon Valley named Mike Maples. He's one of Scale's early venture partners or venture backers, Floodgate is. And he and I were talking recently, and he had a good perspective. He said, a lot of crypto, it just feels like it's playing house a bit. Like they're practicing things and playing things, but it's not next level, it's not this real world application, real world, mass adoption. And so if I look at, these people creating bots to trade meme coins, that's playing house, but it's good practice. That construct, if you can take that construct and then put that into other business models, it's amazing. So I think it's actually really positive innovation. Even though at the end of the day, people are just having bots trade on their behalf, it's good practice for the future.
That's fair enough. So you raised funds pre-2020, before the rise of chains like Sui and Aptos, which are known for raising hundreds of millions of dollars. Do you ever wish that you held off, or do you plan on raising another fund?
Yeah, I think it's actually a badge of honor that, we raised our first financing round back in 2018.
It was a modest sum.
Yeah, and then again in 2019 when I think ETH dropped to $89. I remember that. I was like, wow, this is not a fun time to be doing fundraising. But for us, you just had to be that much better to be able to get financing, and you had to be smart about how you used it. And so I think we're fortunate. Now, hey, some of these products that launched into these huge market cycles and started with these huge valuations, you know, you look at their charts, they're just kind of dropping and dropping. They have their own challenges, right? And, you know, hey, maybe, and also they need to deliver. And I think there's going to be logic in the market at some point where people are going to say, what are the fundamentals of these tokens? What are the value capture that they have? What are the, you know, the user traction and the, you know, the adoption? And then, you know, put some logic against the valuations. So I think we were lucky because, you know, in terms of like playing the long game, we've just had to be better.
Yeah. As the market cycle expands, obviously Bitcoin crossed 100,000. That's
you like the little, woo. Yeah, all right.
Are you planning on growing?
What's that?
Are you planning on growing or expanding? Is that going to happen every time?
All right. Okay, one more time, sorry.
Yeah, so are you planning on hiring, expanding?
Yeah, you know, I think this, it's a good question. What does this mean, right? What does it mean? Bitcoin hits 100,000. I think it's, you know, and hey, I'm like an early 2013 Bitcoin hodler. You know, I was the guy like reaching out to him, you know, in your friend group saying like, you've got to get Bitcoin. Trust me, it's going to be great. You know, and so it's amazing to see that happen. And it's part of what this, you know, we've been saying this for a long time, this is going to happen. It's cool to see it happen. What I think it is, though, is it's a healthy mark for the industry. And it's probably something that could have happened a while ago if there were better global regulation, if there were a better regulatory environment. So I think, you know, for us, hey, we see this as a sign of stability. And it's a healthy market to grow into. And like I said earlier, I get really excited about the business adoption. It makes crypto more mainstream. And when you're talking to big businesses, you're talking to sports leagues and teams and, you know, government organizations, there's a lot more weight and gravitas now. And I think it's going to help propel the industry forward. And yeah, we're hiring, we're growing, we've got our foot on the gas.
So even during the Biden administration, you had a little bit of regulatory cover because of the way Scale launched. Could you talk about the proof of use launch?
Yeah, we did something really interesting where even non-accredited investors in the US could buy the Scale token in the public sale. And so Consensus, the organization, they launched this with their Activate product through this proof of use method. So if you think about like why we did this, well, there's this gray area between you have something that's a security because no one's using it yet and maybe VCs bought some pre-sale lower price. And then all of a sudden at some point this thing's live, it's being traded, but it's also being used for, you know, tokens are not securities, right? Because they're actually utility mechanisms. They're used as products. And so that's why we never talk about the price. We just worry about the utility as like core team builders. Now, what this proof of use launch did is it actually like removed all the gray and it just said, hey, this token's launching, but for 2 months there was zero trading. A token couldn't move, but it could be used to stake, it could be used to buy access into the network. And so it had utility from day one before it could be traded. Then after 2 cycles, 2 epochs of this, it was then able to be traded. And so Consensus, I think, did a great job building that product and even working with regulators to, you know, to get enough confidence to be able to do that as, you know, a company they're based in the US. Our Scale Labs Inc. is based in the US. And, you know, so I hope we see more, I hope we see that come back to life. And you look at the, you know, Hester Pierce and Jay Clayton's frameworks that they've talked about in the past, I think these types of products are going to be used moving forward for token launches.
Why didn't it take off? Why have there?
You know what? There was so much. So when the SEC leadership changed, there was so much regulatory uncertainty, even for those strategies. Now, there was enough work. I think it's the most compliant launch of a token ever, which is pretty amazing. I'm proud of that. But I think people were scared to do it. They just said, you know what, we're just going to get out of the US. Where we were like, let's do it in the US and try to, be as compliant as possible. I think other people just were too worried. But thankfully, I think we're going to have a different framework, clear rules, clear goals.
Yeah. Do you have any thoughts about the ongoing SEC litigation? Do you think that's going to continue?
The SEC, what?
Litigation against like Coinbase and Kraken.
Yeah, I mean, so if you think about it, there are these ongoing lawsuits. All of a sudden, there's a leadership change, right? January 20th, there's new leadership. The SEC operates under a framework, hey, they're here to protect us. They're part of, as a US citizen, they're there to protect people. They actually have they have a great goal. Now, how are they funded? Well, they're funded based off of the yield they get from winning these lawsuits help fund more efforts. So it's kind of like meant to be a virtuous cycle. Now, if they're in a position where there's going to be a new regulatory environment that they and other parts of the U.S. government are, helping determine, then they're going to lose money by going after lawsuits that are destined to fail. So I think these lawsuits are going to go away. Everyone's kind of going to, and they can focus on bad actors. There's a lot of bad actors out there that are trying to fleece people of money, but great companies like Coinbase and others, I think, are going to be, in a strong position.
Do you feel like NFTs are going to make a comeback, or have meme coins completely superseded them? Yeah,
it's interesting. Meme coins, in a lot of ways, are the new NFT projects, but it's a more egalitarian version. So if you have a meme coin, it's like, oh, there's this image, I have this dog or this cat, whatever it is. But if I only have $10 or 10 euros to spend, you know what? I can get in at that. I don't have to, whatever the floor is. So an NFT project, if I got in too late, I can't buy in. I can't be a part of it. But it's more fair and distributed. So I think from a purely speculative version of fun community building, these meme coins have really taken a lot of and these, NFT projects that would have been NFTs are now launching memes instead. But that said, NFTs I'm hugely excited about because of their utility. NFTs are powerful within consumer applications and community building products. So the NFTs of the future that roll out, I think are going to be ones that have utility, they do things, they bring community together, and so they will be able to live in the same world that meme coins exist, but these the purely speculative nature of these in the future, I think those types of projects are going to all be memes as opposed to NFTs.
Are there NFT communities that you're still following or a part of?
So Deadfellows is a cool community. They just launched, that's a great example. Deadfellows has this huge community, and they're launching a game that they're building with Unity. It's like a world-class game that lets you utilize these NFTs, and they have different series of these NFTs coming out and different things rolling out. That's all going on scale, by the way, but that's a great example of a really strong NFT project that is trying to drive more utility into that community and fun.
Excellent. So we have about 45 seconds left. Is there anything in particular that you're looking forward to?
I just want to say I feel like we're, a lot of people here have probably been in the space for a while, and this is one of these fun times. Let's appreciate it. Bitcoin to 100. I think good regulatory changes coming and traction. And I hope we don't get too far over our skis. And let's deliver and keep building.
Excellent. Well,
thank you,
Jack.
Okay, hello, can everyone hear me?
I feel like I'm on a dating show.
Yeah. Great, well, thank you so much everyone making it here early in the morning to the wonderful city of Prague. We're very excited to be here. Today we're going to talk about DeFi and about screaming at the top of our lungs to get it back in focus. We'll all remember 2021, when the DeFi summer really hit us and the excitement hit. Obviously, as we've moved on, we've all seen the DeFi charts, and we've all heard about meme coins. So today I'm lucky to be joined by a wonderful panel, and if we could introduce yourself, tell us a little bit about what you do, and maybe some of your views on DeFi. We'll start.
Yeah, I'm Darius Tobiah. I'm one of the founders at Vertex Protocol. My background's in trading, so Vertex is kind of the exchange I wanted when I was on the trading side. I guess controversial opinion for this, I hate meme coins, so if that comes up, we can talk about that.
I'm William, the product lead for Kiln DeFi. It's focused on making yield on stablecoins easily accessible on as many platforms as possible. Before this, I was a product manager at Kraken, working on the Incal 2 parachain auctions, token listings. And it's a bit cliche, but I think we have to double down on stablecoins as the best product market fit we've seen so far to get DeFi back into focus.
Hi, I'm Amplis from Gearbox Protocol. I'm like head of biz dev strategy. Gearbox is, as of yesterday, our new tagline is we're trying to reimagine on-chain credit. But like right now, you can do like leverage stuff, like leverage yield farming, leverage points farming.
Hello, everyone. I'm glad to see all the block guys sitting in a neat little row in the back there. Good morning, everyone. My name is Lawrence Day. I am the co-founder and CEO of Wildcat Labs. I am also, much like the guys at Gearbox, working on-chain credit with an off-chain twist, under-collateralized and unsecured credit facilities on-chain. I would argue, kind of maybe not so controversially looking at the charts lately, that DeFi is getting back in focus already. Have you seen some of the Dino charts? Everything's having its joyous resurgence, although it's probably yet to be argued that we haven't, in terms of, we'll get through this, what else is there for us to invent in DeFi for it not just to be running back the same things that we've already been doing for the last 3 years?
Yeah, I mean, hopefully we move away just from price charts, but let's as we see all of the legacy coins come back. But so, working with Kiln, and ask the panelists, what is the current state of DeFi? What has been happening over the last 2 to 3 years? What are we excited about?
I mean, when we say it's out of focus, I think we need to ask ourselves, who are we talking about? Who lost focus? I actually don't think institutions did. I think now that we see this explosion of on-chain yield products that are backed by government securities, and that's what they've been working on for the past couple of years, while sort of we, the degens, maybe have lost a bit of interest because the price action was so dismal. So yeah, I just see so much interest in the distribution of yield on-chain from TradFi sources, and I think that's, my view basically on where it is right now, where the attention was over the past couple of years. It's mostly institutional.
And Amplis, you're saying like, have we just fixed payment with DeFi and payment rails? I'd love to hear your view on that. And
yeah, so we were talking backstage about like Lawrence said one of his friends told him like all we've done with crypto is like replace payment rails.
And you're like, that's great. Actually.
That's actually a huge thing that we've done. And yeah, I do think like so if you look at like where crypto adoption is the highest, like it's places like Argentina, it's places like Vietnam. Like I'm half Vietnamese. Crypto adoption in Vietnam is huge. And okay, they're using like Tron USDT, right? But like if you can onboard somebody to Tron USDT, you can onboard somebody to like base USDC or something like that. And just the idea of like, oh, we're getting to the point where some form of crypto rails is replacing kind of traditional remittance and payment processing and things like that. That's like a huge step forward, and that's something that you wouldn't have been able to say in early 2020 or 2017 or something like that.
I think in terms of what's happening or what's been happening in DeFi lately, the last couple of years research has really just been focusing on more of the kind of over-collateralized lending markets. So we're seeing kind of the joyous resurgence of Euler. You're seeing Aave kind of eat the world. You're seeing Morpho coming up from behind, and these are all fundamentally these lending markets, or rather these margin platforms, where. I mean, I would argue they're fantastic platforms for shorting one asset, longing another, not actually having to incur any taxable events if you want to borrow against something. But it still kind of sits in this fundamental kind of bubble of, if you've not brought money on chain or if you've not traded it, what is there really for you to do? There's also this argument that, when we talk about real world assets, fundamentally all we're really talking about is just T-bills and like stuff backing that, so it's stuff that you get from Ondo or what have you, and that's just kind of everything that goes. You're seeing some interesting stuff with, say, like, Gearbox and Pendle as well, where you're able to strip notional and yield from assets. That's interesting, but what more is there to do? Could we start looking at, in the context of credit, things like doing credit default swaps? How do we kind of formalize that? Is that something we'd want to look at Wildcat? Is that something that someone else will come out from left stage and go, fantastic, we've got it now. The next time we all melt, you're at least covered? I hope that that's where we start looking to go.
And I mean, when we look at DeFi, and you mentioned it a few times, the APYs can be exciting. As lots of people are still remembering Anchor Protocol and what's Luna and what seemed too good to be true, can we, as we start to see 20, 30, 40% APY coming back, can we start to trust it? Or I'd love to know should we be worried about that? Or,
I think part of the problem is one of expectation. So crypto's many things, right? And the fact that it's been very lightly regulated or unregulated has meant things can move very fast. And you've got this kind of two-tier market where, you're talking about bringing institutions on-chain, bringing treasuries on-chain, doing on-chain credit markets under collateralized. That shit all takes a long time to set up.
Yep.
And then at the same time, you've got people printing meme coin Ponzi's and 10,000% ABYs and blah, 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 which grabs a lot of the attention because understandably it's quite flashy. When people are doing the hard work and they said, oh, what did you do? I ground really hard for 5 years to build a thing and then it worked. It's not that exciting in terms of getting attention on crypto Twitter, but it is exciting in terms of moving the industry on. So I think it's difficult because you talk about DeFi as this nebulous thing, but it's really 2 or 3 or 4 things operating side by side, and they're all pretty different.
As someone who spent the last year and a half grinding and as a result missed the Hyperliquid airdrop, that unlocked something of a core memory for me. Thanks.
Yeah.
I was at a Wintermute predictions event at the end of last year, and we spoke precisely about this. Where is the danger level? At what point does the needle start hitting be aware when it comes to APY and DeFi? And I said that we would probably be at around the 20% mark where we should probably be a bit concerned because that's where we looked at with Anchor. And I actually predicted that it would be related to restaking. What I wasn't expecting was for all crime to ostensibly become legal and for the next couple of years and for everyone to just start hyper piling in. You start seeing now quite regularly 25, 30% even on the stablecoins on Aave just because of the way that the utilization curve works. And that's about as legitimate as it gets on chains. So if that's normalized, even temporarily, maybe this time is different.
I mean, a lot of what's... Sorry, go ahead.
Oh, sorry. I was going to say, I slightly disagree with that.
Sure.
I think, if you look at the ecosystem 3-4 years ago, DeFi was very limited, and the UX and connections were very poor.
Yeah.
Where, you see the growth over the last 3 years, UX has improved a lot, and with that has been a lot of logical joining of primitives. So Gearbox do this, right? They have leverage that you can take borrowing from one place, put it into points farming on another, and therefore the target APYs can be a lot higher because the end return is a lot more connected to the borrowing, and there's a lot less slippage or loss in the mix. We have the same thing on Vertex where there's an inbuilt borrow lend, so you can do spot perp arbitrage very tightly. It means our dollar rates often go to 25, 30%, but it's because the funding rates on perps go to 40, 50%.
Okay,
and that's really the driver for the whole system for me, right? Is if right now that perp funding rate is it's the Sonia rate for crypto, right? You can see where the overnight demand for dollars is, and it's all driven by leverage, and it's all driven by price. So much as we'd love to not talk about price, right now that's the driver.
The only thing that there's
and when you see that go away, that'll be when you know that oh, it's getting mature. This is coming away from that kind of hyper gambling situation.
Yeah, what I was going to say is with regards to 20, 30% on Aave, right now it's mainly driven by like people looping on Athena, right?
Yes.
Like doing the funding rate arbitrage. So like that only happens in a bull market, right? Because the funding rate's only high when everybody's buying Bitcoin or whatever. But like the one thing I will say is like these kind of elevated rates are not as Ponzerific as Luna was, right? Like Luna was clearly, like when I saw Luna, I was like, this is clearly going to collapse. And I was coping for like months while it shot to the moon. And then it collapsed. I was like, yes. Like you can have debates about like how sustainable Athena is in the long run. Like different people have different opinions. Like, but it's not the same kind of Ponzi. Like we've come up with a way to have like, okay, maybe the 30% rates or whatever aren't here forever, but it's not going to all come crashing down, hopefully, fingers crossed.
I'm looking forward to the headline of Amplus suggests that Athena is brand new type of Ponzi. But I think there's a wider point here about if we're trying to get DeFi back into focus, I think maybe the core question is there, in the context of yield, right? And as funding rates start getting a bit smaller because we mature, is there perhaps a baseline rate that we could assume is something like, at what point do we consider this is mature, this is what you can generally expect to see because of risk premiums, because, you know, like if you're playing with money Lego, what should you be expecting? Is it 10% on your stables? Is it 11? Is it 15? Should it be 20? And I think if we get an answer to that, then we're in a good position to go, okay, cool, like this is why you should be focusing on this rather than, say, treasuries. Like, one of the things that I'd like to see kind of as an exogenous thing of wildcat usage is that you can at least start seeing this particular borrower profile is looking to borrow credit, and this is what the market is agreeing to lend to them at. The market is never wrong, so perhaps this is the baseline rate for a DAO. This is the baseline rate for a market maker. Everything less should be going to Aave or Euler.
Yeah.
Gearbox.
Great point. So I think, you know, unless you've been living under a rock, Trump became president of America, and I think that's, you know, I run a lot of events in London, and we used to go, wow, the US people are coming over, not because we're good, just because they're so bad. And like, I think we've really, really struggled in London to make progressive policy, but suddenly in America, that's going to happen. How is all this policy going to affect? Is it going to make is it going to speed DeFi up? Is it going to push it back on shore? Do they know what's going on? Like, I think that's such a relevant part for these. You know, if we look at us, you know, sort of a nascent industry, we don't have the billions and billions of dollars that these real institutions have. How is this going to? Well, maybe
you're saying we're not real institutions.
growing into.
I take your point.
I mean, at least for me, I think it's not just Trump's election in the US, but also the introduction of Mika in Europe. What I've noticed is it's actually created this interesting situation where the sentiment has flipped between the two regions, and it's now very difficult to, for example, distribute yield via stablecoin in the EU. So Coinbase has canceled this program in the EEA. Whereas in the US, you see a lot more willingness now to experiment and push in this direction. So I think at least one impact that's happened is I think the US is maybe going to be the region where experimentation happens in DeFi going forward. The EU will be less of a free-for-all going, and there needs to be more clarity with regards to Mika before that actually stops that trend.
But I think you could also then argue, all right, cool, let's imagine that, you know, all the red tape is cut. Americans are now free to invent whatever they like in DeFi. What are they going to invent, right? There's a, you know, it's not necessarily we don't have the, we don't know how. It's like, what would they cook up? You know, you see like World Liberty Fi is just like a fork of another lending protocol, right? Are we going to start seeing some like interesting Forex things going on? Like, again, I come back to the idea of like credit default swaps, like who's, you know, going to be facilitating those? Is that the kind of thing you'd like to see? I think maybe more likely is that you're just going to start seeing, in the pessimistic case, just a bunch of forks of things with tokens slapped onto them. And be like, yep, this is American. We've been promised that we're not going to be paying any tax from things that are like, you know, generated out of Tennessee. Fantastic. Let 1 million of these bloom.
I think that's an alarmingly skeptical outlook. I'd be a little bit more optimistic. I think, like, for obvious reasons, the people in this industry have been pretty scared about regulation. It's kind of the bugbear in the room, right? Like, it's made a lot of things possible to not be regulated or be lightly regulated. I think in truth, there's probably some healthy pain ahead. I think there probably will be now. Actually, it's not that Trump coming in means there'll be no regulation. It just means that there might be more friendly regulation comes in. And actually that clarity is going to hurt some people, but I think overall it's positive and it clears the way for, doesn't need to be a reinvention, it just needs an adoption.
Yes.
You know, like if people start to actually use crypto rails and bring legitimacy, like maybe we can all stop effing around with dog coins and actually do something real. Because, you know, like if you worked in traditional finance, you're used to dealing in like trillions of dollars every year going through as a massive industry. And crypto is just a sideshow.
Yep.
If we want to be in the main event, you've got to be integrated with the traditional financial system.
So, you know, the number that we can analyze is that, you know, on-chain credits had facilitated something like $5 billion in the last 3 years. That's a big number. It's nothing compared to TradFi markets. Like, it doesn't even register. I mean, my job is to be alarmingly skeptical about most things DeFi, but I mean, I appreciate the call out. Yeah.
I mean, Trump is like, I think it's definitely bullish in terms of, I mean, he has his own DeFi project, right? So it opens up the kind of design space for people who want to build cool stuff. In response to what like Lawrence said earlier, with regards to like credit default swaps and like different things, like these things actually, people have already tried all of these things. Like you tried index, like with NDX. They're like, Forex has happened, like there was a project called DFX back in DeFi summer.
There's Angle as well in that. Yeah.
Like there's all these options protocols that have tried and you know, succeeded to various degrees, but like haven't captured kind of anything comparable to the traditional finance options market. Like all of these things have been tried. I think what Trump being in power helps us with is maybe like people who wouldn't have participated previously now feel enabled to participate. Like they're not like, oh, Gary's gonna knock my door if I deposit into like options protocol or something like that.
This was one of the things that I was always most concerned about when indexed was a thing, that like, you know, index funds are massive, like they're absolutely gigantic, but anyone that I think at the time was interested in like participating in an on-chain auto-rebalancing index was not the type of person that was active in the DeFi space in 2021.
Yeah.
You know, maybe this time, you know, it's matured, we have like the institutions in, maybe that would have worked now. But, you know, if I have anything in DeFi, it's a curse of building something too early. But you have alternatives now. You know, you like index co-op still exists. I mean, even HedgeX still exists for options. You start seeing like there's GMCI, which does now like custodied indices. And they even, your favorite, they'll do like, you can have an index of meme coins now.
There you go.
Which I'll gift you
something to short.
I'll give you that for Christmas. How does that sound?
So, you know, when we're looking at like new things coming, I'm quite interested to know what the panel thinks about restaking. You know, when we look at like EigenLayer, like how does this restaking come into DeFi? Is it part of DeFi? Like, are we positive on it, or is this risky?
I mean, Gearbox has like benefited a lot from the kind of restaking points farming meta, and also suffered from, you know, DPEGs and things like that. So I think we've seen both sides of the coin. I think like restaking long term is interesting. I do think, and like people who are involved in restaking have admitted as much. I was on like some Twitter space like more than a year ago where somebody from one of the big restaking projects was like, yeah, the yield for restaking is never going to be higher than it is right now. Because right now people are airdrop farming, right? Like once we airdrop, then you're talking about AVS yield, so it's like, okay, you can add like a few % to your yield. Whereas when you're airdrop farming, like potentially, I mean, depending on
10,000% APYs.
Yeah, like you could get dropped $1 million by Hyperliquid or whatever. So like restaking, I think is broadly positive, but we're like past that super hype, you know, we're in like that valley of whatever, and like maybe in like 2 years, it's going to be like, okay, this is an additional way to get an extra few % on your ETH staking.
I can back that up. I think until we see AVSs that actually have real demand and generate real revenue, it's probably going to be a while before we actually see that having a positive impact on DeFi as a whole. And for now, it's definitely on the sort of frontier of speculative users. It's not going to have more.
I sort of agree with that. I think like it's really important and it's interesting, but would it have got so much attention if we hadn't been in the depths of a bear market and people were just Ponzi farming on leverage? Absolutely not. It would just be another thing in the ecosystem that just kind of was happening.
So what are you excited about then? Like what innovation that has come through that's really making you excited right now?
I think for me, this is really boring. I'm actually excited that things are coming that have proper UX. Like when we launched Vertex, everything we looked at pretty much was terrible apart from DYDX.
Yeah.
And that was kind of our North Star, okay, let's try and be as good or better than DYDX. Now, there's genuinely a lot of competitors go and look at their platforms and say, oh, okay, this is pretty cool, or they've got a nice feature or something that works well. And I think that goes over every segment in DeFi now. So now it's not embarrassing if I tell my brother and his friends to go and have a play on DeFi like it was 3 years ago, and they went and looked at Curve and went, dude, this is a scam site. I'm going to get all my money stolen. So yeah, I think that part has been exciting, and I'd love to see how that iterates and gets better over the next couple of years.
It's amazing because in the agency we often have people be like, we want to make it like this one, and so when the top is bad, you just have people copying that. So I agree with you. It's really, really exciting to bring that UX and that UI that actually looks like this is a multi-billion-dollar protocol.
Yeah.
For my money, seeing that Curve website the first time in DeFi
That rocked.
was the most bullish thing I'd ever
It was
seen.
so good.
It was
so
everything I
dope.
wanted from the internet. So good. I think what I'm excited about is also about UX. So we've talked about TradFi institutions, big players now probably feel more comfortable because of regulation changes or lack of regulation maybe to do stuff in DeFi. But if we want to, if I want to onboard my mom, she's not going to understand how do you okay, wallets have improved, right? Never mind MetaMask, Rabby, it's pretty good for a DeFi user, but if you try to explain the flow to a normal person, they look at you like you're crazy. What are you talking about? You have to approve the spending.
Yeah.
I just want to click the button and send the money. So I think UX and totally now that we have all these chain abstraction, blah 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 abstraction, account abstraction, all these things. Probably the UX should look something more like a neobank app, right? So maybe you have an app in your phone that's like Revolut, except all of the modules are DeFi rails, right? So you have a savings app that goes to Aave. You have a leverage credit module that goes to Wildcat or Gearbox. That's probably the thing that is gonna truly push us to quote unquote mass adoption.
We're starting to see whispers of things doing exactly that. I know there's a couple of custodial solutions which I won't name, that are talking about introducing not walled gardens, or not even white labeled solutions, but integrations to say, hey, you're holding assets in this location, but here's where you can actually deploy them. So you could put them into Aave, you could lend them into Wildcat and sign something using your wallet. You could end up looping through Gearbox or what have you. You're seeing this a lot with even wallets themselves, the rise of meta aggregators for pushing things around. UX doesn't suck anymore. It's not Gnosis anymore. We don't call it that anymore. The Safe app has a list of things, which kind of brings you this kind of here's the stuff that we vetted and had a look at. You can use it directly through your wallet. That's great. I think that's wonderful.
Sorry to kill DeFi, but I think that's exactly what we're trying to achieve with the product, making it as easy as possible for as many platforms, especially non-custodial wallets, to have this sort of curated access to DeFi right in the application people already trust, so they don't have to actually navigate around things they're unfamiliar with. It's right there, and it's somewhat curated, but it essentially opens up this opportunity. And on a different note, I hate to be the first person to talk about AI on the panel, but I think now that we see AI agents launching their own meme coins, with the rate of advancement, I wouldn't be surprised to see them launching their own protocols in the coming years. And I also think it would, again, DAOs have been a really boring topic for a long time. People have lost faith, but maybe we return to the original vision of that, where these AI agents are able to coordinate in a much more rational fashion than humans are, and that might actually drive the space forward in a way that, you were asking, what new primitives will there be? Maybe humans are tapped out, and our sort of our new overlords will actually be the ones who show us the path forward in DeFi.
I mean, I think Kiln should be supported and celebrated for doing this kind of bringing things together. I think this is very much, people will go, oh, but you're deciding, who gets to see what. But the reality is that there's this discoverability problem with DeFi protocols. If you're not kind of in the mix, in the trenches, you may not know that something like Athena exists. That seems unlikely to us in the room, but there are people who are going to be like, what is that? Yeah. I think,
that's what the masses need. Essentially, you have to
just a little bit of guidance.
Exactly.
Without necessarily becoming kind of an information broker.
Yeah.
I actually think that's where the regulation stuff in the States could be helpful.
Yes.
Because if you look at the UX stack for, say, I can talk about Vertex, but this would be applicable to every protocol out there. You can only do so much at the protocol level until you're reliant on infrastructure over the top. Mm-hmm. So that problem Amplis was identifying about wallet UX. Wallet UX is a constant problem when you try and onboard normies to use your thing. They're like, I've got to set up a what and put how many words away, and then I've got to guard it forever. And they're like, oh no, screw this. More scam. Crypto's a scam. But then now with account abstraction, chain abstraction, not worrying about gas, all these things start to go away. The last piece for me at the very top is fiat onboarding.
Yes.
How do you get money in and out? I put £1,000 into my Coinbase account to buy some ETH for gas a few weeks ago. End up on the phone for an hour. And I work in the industry and I can afford £1,000 and my bank just insisted I was being scammed. And until that goes, we're going to have a problem. And you're going to have these outsized rates. Yeah. I think at the minute that a big country, and maybe it'll be the US, leads the way and says, okay, this is cool, we're going to bank this industry, a lot of problems are just going to get resolved and solved down the pipe.
Yeah, so the problem you talked about is it's a regulatory problem, right? So hopefully, fingers crossed, Paul Atkins or whoever's the SEC chair and the Trump administration, whatever you think about them otherwise, will kind of open up that space. I'll give you an example. In Brazil, there's this app called Picnic that is apparently the most used account abstraction app right now, more than Coinbase Wallet. And the reason why it's so used is because Brazil has really good fiat to crypto rails via some Polygon Brazilian real coin or whatever. But the rails are really good, so it's really easy to onboard people. And therefore, just that is enough to overcome, I guess, at least temporarily, Coinbase's huge advantage in distribution and blah, blah, blah. So
we do have some notions already of on-chain ramping. We have Monerium, where you could just wing some euros into an account and then you end up minting something. You still end up needing gas, but you could, there's now things like small refuel, where you can get some.
I agree. I guess what I'm sort of saying is we probably win when people stop realizing they're using crypto.
Yes.
Yeah. Right. At the moment, it's early days of the internet. You can hear the modem dialing up. Everything's exposed.
Some of my people.
And the more that's getting abstracted away, and it's just a product you use, the better it's going to be. The more usage you're going to see.
Mm-hmm. No. The sad thing is, I 100% agree, but I'm going to be so nostalgic for.
Oh yeah.
Oh yeah.
Do you remember the curve? You remember the curve UI? And everyone's like, let's get you back to bed, Grandma.
One part that I'm quite interested in at the moment and starting to look at Bitcoin DeFi and using Babylon and point farming there. What do any of you guys, I know it's very, very early, it started last year, do any of you guys have a feeling, is Bitcoin DeFi going to be a big trend next year?
So I've been pushing this internally a lot at Gearbox. I think hopefully, my view is at the very least, we'll see a similar run-up, the way that we saw with Eigenlayer, points farming, and all the derivative projects from that. So we're going to see the same thing with Babylon.
We'll see ordinals again. But
yeah. So Babylon, and then Lombard, and Solve, and Pump BTC, and all these things on top. And then whether or not it actually kind of turns into something that's long-term useful for the Bitcoin ecosystem, we'll see, because I think the trust assumptions are somewhat different, on Ethereum mainnet versus on Bitcoin. I do know that my wife is a ZK cryptographer, and there are people working on genuine ZK L2s on Bitcoin, and stuff like that. So I don't know how much of this stuff is possible, but if they can achieve some kind of trustless smart contract on Bitcoin, then I think Ethereum's cooked, and we got.
Oh, amazing.
Well, I mean, like, but there's different levels of expressibility in the underlying layer, right? There's only so much you can do. Opcat can only get you so far.
Yeah, but if you could like just create a trustless bridge, like a trustless ZK bridge between Bitcoin and some L2, right?
Yeah, sure, that shatters LBTC and so on, and like CBBTC, but that doesn't wreck Ethereum.
I don't know. I think Bitcoin has such a huge narrative advantage. Like it's so like impeccable
It's almost like the sleeping giants.
as a narrative that. Yeah.
The sleeping giants waking up. I think we've seen the Bitcoin community being a little bit grumpy at all the cool stuff Ethereum's doing, but what they have built is sort of vault-grade companies with good storage. I'm intrigued to see what happens when they join it. But I think, I guess my next question is around these AI agents. They almost solve that UX and that UI, and it almost, with all the bridging and stuff, we start to be able to just please yield farm for me. And, I want a less than risky strategy, and AI bots can talk to AI bots and these chat bots. Like, how is that going to affect the sort of actual back-end DeFi? And where, because we have some tool I'm using, it just gets me the best stablecoin yield.
I find myself quite skeptical of this because I'm slightly an AI agent doomer. If you're asking like an AI, like, oh, can you produce a protocol for me? Then really you're just kind of doing a truth terminal, but worse. Where you're like, yes, deploy this, and now here's your thing. And there's that old IBM quote, a computer can never take responsibility, so a computer should never make a management decision. And I think when it comes down to, creating the rails for DeFi, that applies. Sure, get it to write your code. Sure, get it to like audit it a bit if it gets to that level. But I'd be mildly concerned to start seeing like a web of these things kind of running unchecked, interacting with each other. It would probably be very funny to watch, but I certainly think it should be sitting in some kind of constrained chain for quite some time before it starts messing around with real assets.
Nice. I guess it was amazing at ETH Denver because marketing became a topic. As a long-term marketeer, we've sometimes been a little bit forgotten, and we've been responsible for finding product market fit, raising money, keeping a community happy. So I know you know Eula, but what is the role of storytelling and collabing in DeFi next year? Like, how are we going to tell this story to the industry to get these people excited? Because just yield is not the thing. What is that narrative that we'll see next year in 2025 in DeFi?
We've been talking about simplifying UX, and that's a key to bringing more users on-chain. I think the same thing applies to marketing, and I think actually the Solana ecosystem is really great at this in communicating the unique value proposition to the user in a very simple, pithy way. So I think the sort of pay-fi narrative of buy now, pay never, that clicks instantly. That's good marketing, and I think in terms of storytelling, getting closer to what we see outside of crypto, where they don't talk about what's the tech underneath, how is it wired, but rather what does it do for you? How does it solve? Like, how does it improve your life? I think that's probably the key to storytelling going forward.
Yeah. I think storytelling is like literally everything. Like Bitcoin exists just because of storytelling, right? Like it's an amazing narrative, like a non-dev, blah blah blah. But like so I think DeFi tells the story of you can be bankless and have all the same things as if you were at a bank. But the problem is like the reality doesn't match that story. So when people try to use it, it's like it's nothing like what they expect, right? But we're getting to the point where if we do a good job with designing our products, we can almost have this like bankless vision. And like people hate banks, so I think that story like remains true. It's just that like we have to build our products to match the narrative that we've been telling this whole time.
This is a big part of why we ended up adopting banking but worse as our slogan over at Wildcat, because of the interactions that we have. I think in terms of narrative, like anything credit related, so like Gearbox, Wildcat, we have a very easy narrative to tell going forward. As we start seeing like a slightly heated market, as we start getting people like looking for more access for capital, as we start seeing like DAOs and foundations and like collectives who are looking to like receive money, and people who want to lend it because they're trying to like risk off a little bit in an unsecured sense, but away from like their DeFi protocols. And I think that lends itself really easily to engagement and looping with other protocols. So again, I mentioned Pendle earlier, stripping yield from that, so at least for example, here's a certain amount, so here's the growth. If you want to take like any debt from something like that and looping it into into Aave or whatever, because I think it's not just a narrative for your own protocol. I think it's really important, and it behooves all of us to start telling the story about how what we work with interacts with everything else. You know, how we can be like, you know, how Kiln ends up like being able to allow us to, you to interact, pull something out from Aave and put it into Wildcat. How you end up being able to kind of like leverage up and loop on Gearbox. How Vertex might participate in something beyond
Amazing.
just your own stories.
Well, we're here today. Bitcoin's 100K, so well done everyone who's been here right from the start. So I guess we were talking about, is DeFi back? To wrap up, I would love just for each of you to give your own sort of 30-second summary, what to be excited about for next year. And we'll start here.
Yeah, I mean, we've sort of moved from being just a like perps DEX to being kind of cross-chain interoperable solution. I'm really excited about just getting a bunch more chains together, seeing other people work in that space, and seeing how we can grow the ecosystem as a whole.
I think when you see product market fit, you should double down. And for DeFi, again, it's stablecoins. So really focusing on making it easier to earn yield on it in a seamless way, to pay with it. I think that's going to be key for the next year. And a lot of institutions are very interested in how to actually enable that for their users, where they weren't excited about that a couple of years ago. So I think that's going to be a big trend in 2025.
I mean, DeFi is back, and we're going to go higher than ever before.
DeFi is back.
Yeah.
You heard it here.
Like what I'm excited about is, so at Gearbox, we've got the kind of back end, like we have the smart contracts and stuff that we want. Like it's all really, really good, like no bad debt, blah, blah, blah. We've been running for 3 years. Now we're like focused on how do we get distribution, right? So what I'm excited about is this like idea in my head of like, DeFi should just be like a neobank app, but that app is just the UI, the way that like Uniswap has a UI and then the smart contracts, right? Like you could have an app that combines all of the composability and modularness of DeFi, but it looks like Revolut. And that's kind of what Gearbox is trying to slot in. Like we're trying to be a module for the smart wallets that are coming out in the next few years, and that's what I'm excited by.
I don't think DeFi actually left. I just think everyone left DeFi for a while. The capacities of DeFi stayed where they were, you know, kind of post the FTX crash. And everyone was more interested in going into the trenches and doing meme coin stuff, or they get sniped into the restaking narrative, what have you. And, you know, UX introduction, like improvements aside, and maybe some improvements on like zero knowledge and how that might participate with DeFi, as well as hopefully a more sensible regulatory regime, means that as you said, like, we're going up forever, but we're going to be seeing a joyous renaissance.
On that point, when do you think we're actually going to see zero knowledge like move away from just like chitter chatter to really working?
I mean, they're working on some cool stuff, man. Like,
yeah, like, I've been told that for ages.
You can already do peer-to-peer via ZK. Like somebody pays you, like you want to on-ramp from fiat, right? Like you pay somebody in fiat and they pay you in crypto.
Yep.
In a kind of trustless way. Like that already exists.
Yep.
That didn't exist 4 years ago.
You could just API scrape from a bank account and release escrow from a smart contract.
Yeah,
That's amazing.
I'm talking about that WhatsApp moment where we break through. But
the ZK people are cooking.
Yeah, no, I'm very, very excited for ZK, but I think that's a wrap. Thank you so much. Please give a big round of applause to the panelists.
Thanks, guys. That was good. And now.
Hello, everyone. We're here to talk about the next frontier of Layer 2 solutions. We've got a great panel here with projects building in the Layer 2 sector. So if you could start off with some introductions, starting down the line there of your project, your role, what are you working on?
Hey, everybody. I'm Jack O'Halloran. I'm CEO and co-founder of Scale Labs. The Scale Network is our network. It's a Layer 2-ish implementation. There's 18 Layer 1 chains, all controlled and guided by the ETH mainnet.
All right, my name is Martin Durka. I'm a co-founder and tech lead at Zirkit. Zirkit is a layer 2 as well. We are a zero-knowledge rollup, and our specialty is that we bake in some AI tools into the sequencer to determine whether transactions are benign and honest or malicious for our community, and for those that are malicious, we put them in quarantine.
Hey guys, my name's Namik. MegaETH has built the first real-time blockchain. By effectively decoupling consensus from execution, we've been able to deploy a technique called node specialization, which allows us to take effectively the blockchain architecture to its absolute limits and push what performance really looks like on-chain.
Yeah, GM everyone, my name is Cecilia Xu. I'm the co-founder and CEO of Morph. So Morph is a global consumer layer, and we are acting as a distribution hub for all the resources builders need, from launch to scale to mass market.
And I'm Patrick, or Patryk Kraśnicki, for any Polish people in the audience. I'm a senior research analyst at Masari, covering layer 1s and layer 2s. So to kick us off, I want to dive a bit deeper into each of your respective projects. What is the ideal user for your blockchain? And yeah, who are you targeting with your chain and your project?
Should I start?
Yeah.
Well, as I said, that we are a global consumer layer. So basically, our target audience are like two groups of people. One is the builders who build for everyday users and everyday use of projects. And the other target audience is the everyday users. So basically, what we think that most of the chains in the market right now, they are building for crypto native or degen people. So it's kind of like the community is pretty small. It's always the same group of people, and then we are washing them again with their money. But the purpose of Morph when we start this project is that we want to make the pie bigger. We want more liquidity and more new users, new retail users to come in. So that's why we are targeting like not exactly the other side of degen people, but more like we see degen as a core group of crypto users, but we want to expand the market into like your friends, your family, for people who should understand that on-chain has much more value than off-chain. Yeah.
Yeah, so like everyone in this room came to crypto because of some lofty ambitions, right? Of how the world should be, how the world should look like. And you very quickly realize the infrastructure is more or less garbage, doesn't work, doesn't exist. And we've kind of devolved into like hyper-speculative meme coin trading, which, don't get me wrong, I love my meme coins, but there has to be more. The singular thesis of MegaETH is we actually are not there yet. As an industry, we have not exploited and taken performance to its absolute limit to build applications which have never really existed before, real-time applications with performance UX parity to Web 2. By building this environment, what I'm solely focused on is inspiring the next generation of builders, inspiring the next generation of founders to build a variety of applications, some financial, but a lot non-financial as well, that will be able to like leverage peer-to-peer economics, leverage crypto, leverage the power of blockchains to build net new applications which can't exist anywhere else. So for me, the ideal user is going to be a cracked builder, a founder that wants to build a multi-billion-dollar business. And then, very simply, it's going to be someone that has no idea what a blockchain even is, because they're not using this application because they want to like farm a chain, right? But they're using this application because they are able to experience something they weren't able to experience with Web 2 data centers.
Cool. So for Zirkit, I perceive sort of three ideal groups of users. The number one group of users are the end users who want to experiment with crypto, who might have used crypto in the past, but essentially want to do more, but they are a little bit cautious, because in the end they are working with their capital. They don't want to put it into a random DeFi project where in 2 days it's just going to be gone, right? So by fostering the security and doing the detection of hacks on the transactions that come to Zirkit, we are sort of enabling and helping this group of users. Now, the second target group are the builders. Those are the cracked-up founders that need to build something for these people to use, right? When you take a look at the current chains, on every single chain you will be able to find some kind of a DEX. On every single chain you will be able to find some kind of a lending protocol. On every single chain you will be able to find a stablecoin. But what's next? You know, this is kind of sort of the necessary minimum that you might want to have for your chain to be usable. But to attract the masses, to attract more and more of those end users, they want something more, right? So this is the second target group. And the third target group for Zirkit are honestly AI agents, because I think that we are switching into the era where a lot of interaction with blockchains will be done in a very automated way and very automated manner. So where we are going with our chain is, you know, providing essentially a playground and a very fruitful playground for these AI agents to be able to interact and transact. Go ahead, Jeff.
Yeah, so Scale, we've been around for a while. We've been around, you know, live for over 4 years. It's given us time to find our sweet spot, and Scale has 0 gas fees. So the Scale token's used effectively to rent block space. So that's really, you know, our sweet spot is gaming, AI products, decentralized social, DPIN. So we have over 300 projects already building on us. We have around 60 million transactions per month right now, and averaging around 3 million unique active wallets a month, which are all, you know, top 10 of all layer 2s and layer 1s. But we've been not as focused on DeFi, but focused on areas where having large gas-heavy applications is really valuable, and kind of found our sweet spot in, yeah, gaming, AI, and those other categories.
Okay. So we know a bit about each of your projects, ideal users. What differentiates you as a layer 2 network? Maybe what customizations have you made, and why should these users come to your chain specifically? There's a lot of projects out there now that are either consumer focused or gaming focused, DeFi, liquidity focused. So why your respective project? What differentiates you?
Yeah, it's a good question. So I think when we first start Morph, we look into the market. There are so many layer 2s on the market. I think today there are probably like 200 layer 2s on the market, launch or not launch. So how can you differentiate yourself from all of them? This is the first question we ask ourselves. But when we look into the market at that moment, we feel something wrong, because everyone, like every layer 2 is competing with each other. They're basically optimizing technical features. Sometimes it's like small technical features comparing with each other, and this is their main differentiation. But the truth is, like, no builders or no end users really care about that feature, that specific feature. So if we spend so much time just for technical optimization, but forget about how can we help the builders to scale their business, how can we really make the market bigger, how can we bring in more end users in, then all these infrastructures have no users or like builders to use that. Why we are here? So that's why we started Morph, because Morph has, from day one, we have all these resources for builders to like need from launch to scale, as I said. We are incubated by one of the biggest exchange in the world, which is BigGet. So from day one, they help us to embed into their whole ecosystem, which means that from day one, we have like 40 million to now it's like 50 million users from the exchange and BigGet wallet, so which we can funnel to our ecosystem project very easily. And also, meanwhile, the native wallet for us can easily help our builders to have so many different functions with the built-in wallet. And meanwhile, because of the partnership or the very strong relationship with all these centralized exchanges, because my background also, I was running a top derivative exchange before. So we have so close partnership with all these top tier exchanges, which means that when our builders, they want to go listing, they will have a bigger exposure and a better chance to go listing to these top tier exchanges. So these are all these pain points we see from the user acquisition, from the listing side, for the builders when we talk to them at the first beginning. They understand that it's not only about to integrate with a chain, and that's it. Basically, this is what they get from all these chain support right now. But what if we can help them to funnel so many users? What if we can help them to go listing easily when they have a certain scale? That will be the key differentiation from us. So basically, we are acting as a venture studio to them to kind of like incubate them from very start and to the very end. Yeah.
You know, to be honest, I think as an industry we should be a bit disappointed in ourselves when it comes to layer 2 landscape, right? We are more centralized than Solana, and we're slower than Solana. It's absolutely insane. So in my opinion, like, you know, the technical design choices made by the vast majority of L2s today are very boring, deeply undifferentiated, and like just not interesting. The reason why we've built the MegaETH construction the way we have is because we are proudly and singularly performance first, right? And a very simple thesis, which is very controversial these days, which is that consensus adds, you know, delay time, right? It's the stragglers problem. For us, we built a layer 2 because we decided to say if we can decouple consensus from execution and then hyper-optimize execution, we can achieve a level of performance which no layer 1 will ever be able to achieve, right? And that's what MegaETH does. By leveraging an architecture called node specialization, we're able to effectively look at the tasks associated with a blockchain from first principles. Traditional blockchain architectures are homogeneous, meaning a singular node does all the tasks associated with a blockchain. Sequencing, execution, validation, dissemination, the whole shebang, right? The issue is, these are very different tasks, and they have very different ideal makeups. So, you know, you see Ethereum as a blockchain, an L1, the most decentralized Turing-complete L1, hyper-optimizes for decentralized for validators, validation. Very, very easy. Issue is sequencing and execution is horrible. It's not very performant. No one can pretend it is. Solana makes other decisions on that trade-off curve. It's a bit more centralized, but it's vastly more performant. For MegaETH, we say because we're layer 2, because we have different trust assumptions we can make, because we settle in the most decentralized blockchain in the world, Turing-complete blockchain in the world, we are able to effectively build custom software and hardware configurations for the particular task as a node. And that means 100K TPS, 10 millisecond block times, and a level of performance we really haven't seen in crypto before. Yeah, I think like other than that, we'll talk about ecosystem later. We do a bunch of really awesome stuff. We have 4 mega mafia builders literally at this right here, building cracked companies, raise a bunch of money from top venture funds, building applications only possible on MegaETH. But honestly, for us, like the main differentiator is the tech, right? No one has made the design choices we have. No one has so proudly leaned into building the most performant execution environment before, and that's what we're very proud of.
So I have a little bit different angle here. When you ask an L2, how do you differentiate from other L2s, all the technologists will start talking to you about the technology that is sort of happening under the hood. You will hear about the fancy proving systems that are in the background. You will hear about the circuits. You will hear about various finality times. And you will hear a lot of technological stuff. But the bottom line is that everybody does this. Everybody is trying to advance this technology. But none of that projects directly at the end users on the network. You know, if you ask yourself directly, do I really care? Is it a deal breaker that my L2 will be having 20-minute withdrawals versus 25-minute withdrawals? The answer is no. You know, those 5 minutes, they do not really matter. So where we see our opportunity to differentiate and where we actually see opportunity for every single L2 to differentiate is actually to provide new opinionated features that target the end users. So for us, I will, you know, we have 2. I will circle back to the security at the beginning, right? So when you look at the 2024, there were some, you know, security incidents and hacked protocols on other layer 2s. And there was always a discussion on crypto Twitter, should the team do something about this, right? Like, should they pull this God mode because they still hold the private keys, they still have centralized sequencer and all that, and roll this attack back, right? And there were teams in this year who have done that, and there were teams who, you know, didn't do that. And the community didn't react really well to neither of those, because in the end, when you are, you know, when you allow for a hack to happen, and then you have to make a decision whether you're going to undo it or not, you're essentially shifting the damage, right, from the LPs to other people who traded or opened some positions based on the fact that a hack has happened. So we say, no, this is wrong, and we want to prevent hacks before they actually get included in the chain and before anybody in the world sees the consequences. So that's the #1 reason. Number two reason, again, we are currently in the future where AI and blockchain, they have the future, right? We've been for ages and ages dreaming about the times when we have self-driving cars and the car can pull to a gas station and, you know, fuel itself and pay with cryptocurrency. So we are currently at a time when AI has a lot of capabilities. It all starts with those trading bots and AI agents, right? But for this to actually be functional and, let's say, safe for the users, you know, so that your AI bot doesn't send all your funds into an oblivion to some address that it doesn't have a private key for, you also kind of want some cooperation from the chain. You want to have data that is required for making these elaborate decisions on what positions to take, where to trade, and what to do, somehow very handily exposed. You have to have them exposed in a very fast fashion, right? Because the mempool keeps going and going and going. So where we also want to differentiate ourselves is to provide the AI agents and everybody who is building something like that with the opportunity to work with high quality data and having fast access to the chain. I think that that's also very sexy and, you know, important for the community at this point.
Yeah, so I'll tell you a little story. So Scale, a long time ago, back in 2018, was part of this original batch of layer 2s on the ETH mainnet. We, however, took a very different approach. We did not integrate rollups. And so there was these arguments happening in these Telegram chats, and finally it was like 2019, and Scale's not a layer 2 because we refused to, one, commit to centralization of having centralized sequencer, but also we enabled these chains in the Scale ecosystem to actually have their own finality. So they're running consensus. We're not decoupling data availability and consensus. Now, the ETH mainnet is used to provide security back to all these chains, though. So how do you prevent these chains from having collusion issues, having all the issues you would normally find with a smaller committee of validators? Well, that's where the ETH mainnet comes in, and this, you know, single network in the Scale ecosystem that can produce all these shards. So we kind of like, one of our biggest differentiators is that now we're not a layer 2, but we provide second layer scaling for Ethereum projects. And that's kind of the tagline here on my hat is we're built different. So that's our story.
Okay. So we're talking about layer 2s and all these different blockchains. And we're in a world now where there's hundreds of different networks. It's going to be thousands soon. And that presents different challenges. Largely, what's facing the space right now is both liquidity and user fragmentation. Funds and users are across different chains. It's hard for them to interoperate. How does that play into your projects? What are the challenges that presents for you? And then maybe on the flip side, what technology or projects are working to solve these interoperability issues that you're excited about? We could maybe start with Jack.
Yeah. So when I think of interoperability, Scale itself is this ecosystem of shards, right? There's 18 of these shards. So the challenges we experienced a few years ago, I think, are a lot of the challenges that the rollup world is facing with all these different fragmented implementations of rollups. And we actually had to, go and create this interconnected layer between all of our chains. So a user can bridge from chain A to chain Z in less than a second and zero cost now within the Scale network. And you need to couple some nice UI features there as well. You can't just rely on custom contracts to do this on the back end. End users don't know what a chain is, okay? If you want to service consumer audience, that people playing games, people using AI apps, their mind's blown if like, hold on, my money's here and there at the same time. So we had to go to great lengths to try to just remove all that complexity and abstract it away, and learned a lot of things in the process. The other thing is just token mapping. If you have lots of different chains in the world, if you have a token, if you have ETH that comes in from 2 different places, or USDC that comes from different places, and you don't have some well thought through token mapping standards, try to tell a normie that, oh, that's a different type of USDC than this other one, and that's why they're showing up different in MetaMask. So these issues are really, they're complete, and the fixes have to come both from the UI layer and the back-end layer. So that's my quick take on that.
I will agree with that one line that users do not know what a chain is. I like to say that if we want mass adoption of crypto, we have to be ready to serve users who are the equivalent of my grandma. My grandma has no clue what chain is. She has no clue what Ethereum is. In fact, when I get home and pull out my Canadian money out of my wallet, she will ask, is this those Bitcoins of yours? So we have to be ready to serve users like that. Now, it is also important to realize that this problem is not a problem that was sort of introduced by the existence of layer 2s. We have Bitcoin, we have Ethereum, we have Solana. In the end, users want to have exactly the same attitude to these chains as to the layer 2s. They want to ignore the fact that there are multiple chains. They just want to have money on blockchain, and that's it. And when I want to move money from A to B, I don't care if I'm interacting with Arbitrum or Base or Uniswap. So I think that the problem exists. It's important to acknowledge it, but it actually wasn't created by layer 2s. It would exhibit on its own one way or another. As technologists, we love to compete. We love to build these new features. We love to do new stuff. I will avoid mentioning any projects that are working on solving this issue because I don't want to provide some sort of promotion in here. But obviously, this topic is being discussed, right? Chain abstraction on its own. You can find numerous talks, from DEF CON and from everywhere else. So the topic, we are as a community aware of it. There are people working on solving it. In my mind, that solution has to heavily come from the front end perspective.
Yeah, I guess we can sort of like L1 to L1 cross communication. I think it's pretty cooked, pretty dangerous. A lot of people don't actually understand what those risk profiles look like. One chain will always be less decentralized than the other chain, and then you're bringing on systematic risk. For L2s, it's a bit lighter because of the challenger periods associated with optimistic constructions, or less time for ZK constructions. So yeah, I think we're pretty bullish on cross L2 interoperability. Polymer over there is working on it, pretty bullish on those guys. Yeah, I think have you seen Lord of the Rings?
Of course.
Yeah, I'm a bit like Gollum, one chain to rule them all. Just kidding. I think my opinion is global state machine for the win. MegaETH is built with the idea that we're here for atomic composability, and we've made the design choices to be able to scale, honestly, linearly of hardware. With the MegaETH architecture, hardware becomes the constraint, and I think the way you solve for, chain abstraction is by having atomic composability in one environment, and that's why I came into crypto. That's my dream, and that's what I'm focusing on.
Yeah, I think these three builders have already mentioned enough about interoperability, and this is definitely something we need to work on. But I actually don't know. I don't have clear solution right now for how can we, make users flow their assets between different chains pretty easily now. It's not only a chain problem; it's also interoperability infrastructure problem. But we need to embrace that. We need to embrace with each other, with different chains. Yeah. So, yeah.
So, want to talk about the ecosystem and the growth side of things now. Marketing has been a big topic in the industry this year. Founder-led marketing, you're all founders. How do you think about marketing and positioning your project and communicating, whether it's these technical innovations that you have or more on the user side, the application side? How do you think about marketing?
I think, well, one lesson we learned from our launch, because we launched our mainnets 1 month ago, and one lesson we learned from that is that we should definitely start our marketing much, much earlier, because we start to build everything 1.5 years ago, everything about, the tech part. So we spent the whole 1.5 years to build up all our chain technology, but we are too conservative about marketing. So we wanted to be more ready to go to the market and say, hey, this is our technical feature, this is why we are different. But we should have started much earlier, because you will see the huge difference once we start to talk to the public, once you, I personally start to build up my personal brand for Morph. It's huge difference, because you need to stand out, you need to speak publicly about everything about your project. And to answer your question, the difference between, talk more about technology and also we are more consumer-centric, consumer-focused chain, it's actually pretty tricky, because the biggest target audience of us is still builders, so they still care a lot about what is your technical features, what kind of support you can give to us. But when we talk to builders that we want to have more consumer-centric builders, 6 months ago it was very difficult to find them because no one actually support them. Most of the chains are still supporting like DeFi, GameFi, NFT, AI projects. I would say 90% of them are like builders in these sectors. But if you say, okay, we are looking for consumer builders, there are not so many of them because they're not getting supported. They don't see that users are used to use the consumer-centric applications. So, but now everything has been changed. A lot of chains start to talk about consumer-centric applications. People are talking about how can we bring blockchain into mass adoption with the very consumer-focusing applications. So yeah, I would say it's different. But the thing is that users, they choose chains because of the application. They don't choose chain because of the chain technology. So when you do marketing about, hey, we are very consumer-centric, all the builders here are very consumer-focused, the end users are far away from you. They don't get it. So you have to push and to let the builders know that how important it is to build for everyday users, not only for the crypto native people. So yeah, it is tricky here. Yeah.
I think that's a brilliant answer. We have a lot of the same theses as Cecilia. I think like on our end, we don't have mainnet live. So I think in my personal opinion is hyper-focusing on like building a community before a chain exists is a bit of a LARP, right? Like what I focus on is just builders, founders. Finding these founders which are really, really sharp and then working very closely with them. I also believe like the first cohort of people you work with has to be unbelievably talented because talent attracts talent, right? So for the past 6 months, just been hyper-focused on finding really strong founders, working with them very closely on building applications which have never really existed before in crypto, helping them end-to-end from like mechanism design, architecture, helping them hire, help them fundraise, really literally end-to-end. And I think that's been pretty successful. We've raised like 8 figures for the industry, for the ecosystem. I'm not even like the low bar of that. You'll see some cool announcements in the next, basically in the beginning of the 2025. Yeah, and I think after that, you can focus on community and stuff. Like when you have a mainnet, like users will come when you have great applications. I think that's a great thing you can study Jeff from Hyperliquid for, right? Like, maybe we don't actually have to LARP nonstop on Twitter. Just focus on building in a beautiful application, build a beautiful product, and reward the users and the participants of that ecosystem and that culture that you've created.
So this is such a loaded question that it's really hard to answer it, and I don't even know where to start. So maybe at the beginning, I kind of sort of dislike the term marketing. The term marketing, at least in me, seems to be something where I am trying to sell you stuff that you do not really want, right? So I very much prefer terms like support, incubation, providing resources, and so on. So now, this is also a chicken-egg problem, right? At the end, as a network, you always want to have the end users. Those are the users who come to use the dApps that are present on your network. But at the same time, the dApps, they want their users. Nobody's going to come and develop a dApp that they already know they will have troubles attracting the community for. So it's this weird situation where the end users are asking for something to do and the builders are asking for the presence of end users already, otherwise nothing is going to happen, right? So what you end up doing are sort of baby steps. So the way how we were addressing it in Zirkit, for example, was we wanted to provide the end users, the potential end users, with something to do, right? Without having this numerous landscape of dApps that are already deployed on mainnet. So that's why in probably March of this year, we opened a staking program where users were able to deposit assets that were somehow predetermined for being bridged to L2. We didn't do it the way how some other projects did, where these funds would be locked, but it was just a straight up deposit contract. That was there to provide a confidence to the builders that we are actually able to attract capital, right? When you take a look at a chain and within 3 weeks you suddenly see $3 billion inside of a staking contract, that's a very good signal that some builders are already willing to accept and say, yes, we will start building. Now, when you're launching a network, if you actually look at the segmentation of traffic on other networks, you will realize that very few big projects are responsible for major amount of traffic on the network. So I absolutely 100% agree with here, where the first builders and the first founders who come onto the network should be super, super talented and should build the projects that people actually want to use and that are pleasant to use. Because that is going to create that effect of users actually coming to the chain and then attract more builders in this like kind of a self-feeding loop. So in the end, L2s, they do have to be as supportive for anybody who wants to try the network and remove friction from all the possible angles.
Awesome. Yeah, so we're in a unique situation here. I guess I am on the panel because we've been live for over 4 years, okay? And for us, when we first launched, I think we had like 10,000 unique active wallets a month. We thought it was great. We were really good back then at developer marketing, grassroots marketing, kind of anti-marketing. It's like, because developers don't want to be marketed to or sold to. They want to, to be partnered with to help solve problems, and they want to be able to pick solutions, not be, have things forced upon them. So we were really good at that, and like now we have over 300 applications building on us. But we were lacking this like mass market adoption. I think Solana, by the way, has done that really, really well. And so now, fast forward, we kind of like learned how to market to consumers. You have to do multi-audience marketing. You have to market to developers in the right way, and anti-marketing way, but you also have to market and shill and help your games and your consumer apps and your AI apps and your DPIN apps. You have to help these people attract users and build a base. And your job, as whether you're a chain or a layer 2, is effectively to be a publisher and a like growth vehicle, co-marketing growth partner to applications building in your ecosystem. So now we have over 3 million unique active wallets a month, and we're thankful to bring on Arbitrum's former CMO, who really helped grow their ecosystem, to help grow our mass market adoption, awareness, and it's you got to do both.
So meme coins aside, memetics are very big in this industry. Networks are now trying to differentiate by like having mascots or certain colored branding or inside terms or jokes, things like that, which is fun. And how do you guys think about that when differentiating your project kind of on that like community side? What do you think about that, and how does it play into your project?
I think it's pretty funny because when you have that in your ecosystem, something like community can remember, which can be meme, can be anything. Like I think 1 or 2 months ago, people are talking about me posting too many feed pictures, and then that instantly create a lot of attention for community. And we didn't know about that. This kind of meme stuff can create so much like buzz on the market, but actually it helps a lot for your marketing. So I think it's a good thing, actually. I mean, crypto space, crypto bros are so weird. They just like weird stuff, so why not, right? We should be bold, we should try everything, yeah. But it's very difficult. You cannot like manipulate that. It has to be organic, happen. It's just like something random, but people pick it up and they like it. You cannot always create something by yourself, like officially. I don't think crypto people like it.
Yeah, I love this industry. I don't think anyone's interested in my feed pics. So what I had to do is like basically, we love memetic culture, right? Like, I mean, we call ourselves Make Ethereum Great Again, Ethereum. I think memetics are good. I think good merch is good. I think being very authentic is good. And actually standing on business is good. Like, truly believe we will make Ethereum great again, so it helps. And just like good vibes.
So this little cat, I actually have a full backpack of plushies with that little cat in the back. So if you want a plushie, find me. That is to say, yes, we definitely work with mascots, we definitely work with merch, we come to all blockchain events that are hosted globally. That was the case in 2024, and it will be case in 2025. The reality here is nobody in this room will be super, super excited about the fact that a chain can do 1,000 TPS for longer than 30 seconds. But a lot of people will be excited at a party, jumping around with giant, cat and having fun for the whole evening. So yeah, you have to have it.
Yeah, memes are fun. It's about community, but it's also, that's how you market. And when you think about social media, there are creators and there are consumers. The way you win as a crypto project is not to be the creator yourself, but to inspire this whole audience and community of creators, okay? So like, I've kind of been able to, it was a great learning lesson for me. I've been starting companies since 2008. Came from enterprise software, doing AI when AI was dumb. But it was all B2B marketing. And then this industry is so amazing if you just embrace it, and you get your community creating and building things, and in not just product, but memes and social movements. And so I was actually just in Lisbon talking to our engineering team, and one of the guys said, "Who are all these people on my Twitter feed? Who are these people? Do you know who this one is and this one is? They're making all these memes." I'm like, I don't know who they are, but we're glad they're here. But you have to strive for that and embrace it and have fun along the way. So
awesome. So we've got just 2 minutes left. I figured we could wrap it up with a quick 1 or 2 sentences of what y'all are most excited about for your project or the space in general. What excites you over the next few months?
Yeah, I'll just say, we're just shipping partners, helping people go live. Got a ton of go lives. I think there's over 120 queued up that are just getting ready to go live. So that's our big thing, is just helping these devs and these teams be successful.
I'm excited about a lot of stuff. First and foremost, the stability of our network. We are a fairly young chain. We launched mainnet in the summer 2024. So far, stability has been great. We did TGE last week. What's coming next? We are looking at a major prover upgrade, which is going to come around February and provide us with some, faster and better proving capacity. We are looking at a lot of AI features as a chain. Zirkit wants to embrace AI as much as possible. We call it the concept of a cognitive chain. There is a lot of stuff coming that I'm excited about.
Yeah, I think smart contract-based blockchains are in danger of not having PMF. And for me, I don't think pump.fun is the only thing our industry is meant for. So what I'm excited about is just like finding people like yourselves here today to work with, to build applications which will, make Ethereum great again, but also help us as an industry find the next stage of our evolution and our life cycle maturity. So please do reach out.
I would say because our mainnet finally launched 1 month ago, so it's all about how to make sure that our long-term vision really come true, instead of just telling the VC about our narrative before our mainnet launch. So there are a lot of things to happen and help builders to do, whether it's funnel the users, increase your users, and then help you to do the fundraising, and also to help you to do listing in the future. So a lot of things ahead, yeah.
Amazing. Well, this was super fun. Thank you all for being here, sharing your thoughts, and to the audience as well for tuning in.
Good morning. Welcome to our panel that tries to shed some light on a question that is probably top of mind for most of us, and that is, how do I navigate the crypto trading landscape? We have some experts here on stage that will help to answer these questions, And of course, we will be talking about centralized exchanges versus decentralized ones, the custodial aspect of it, about execution, all those topics that are really interesting for everyone who's trading crypto. I'm Andre, head of research at GMCI Crypto Indices, and I'd say let's start with a short round of introductions. Charles?
Hello, good morning everyone. My name is Charles. I'm with DYDX. I'm the CEO of the DYDX Foundation. DYDX is one of the leading decentralized exchange for perps since 2018. So OGs in the world of perps trading and constantly innovating. We can come back to this later. Great to be here.
Hi, my name is Katya. I'm the CEO of Bebop. At Bebop, we enable spot trading on-chain by aggregating both on-chain liquidity and off-chain liquidity with market makers RFQ.
Bartosz, CEO of Cube. It's a hybrid exchange that runs on top of SVM.
Hi everyone, I'm Vitaly, the CEO at Spark. It's an order book exchange. We're live on Fuel Ignition mainnet. We believe that to bring the next wave of adoption to Ethereum DeFi, we have to transition from AMMs to the order books.
Thank you for that. So this year, it feels we have hit so many important milestones. And I'm not talking about prices. I mean, waking up today in the morning to see Bitcoin at 100K or 0.1 million, however you want to call it, that was, of course, exciting, but we have had so many product launches, spot ETFs, crypto protocols that launched, that did major upgrades, all those upcoming, hopefully, positive regulatory changes. So my question would be, looking at 2024, what have been the most exciting changes or trends that you have observed related to crypto trading?
Sure. So for me, I think the change in the nature of meme coin trading was really interesting. I think moving away from large market participants trading momentum and VCs in general, and seeing retail driving meme coins in general has been a huge change in the space and brought just new life into the ecosystem.
Yeah, that's true. It's interesting that you say this because I was actually thinking about the larger participants, and also that the larger participants are coming into DeFi much more. And when I say larger, it doesn't necessarily mean huge institutions and things like this, but more kind of what's known as centralized teams. And by centralized teams, I mean literally a team of people who work together really hard to grow in the space. So, for example, at Bebop, we work a lot with market makers, just like all of you guys, right? And we definitely have seen a lot more entrants into the space, kind of at all sizes. So whether it's the market makers that have been active in CeFi, now going deeper into DeFi, or whether it's smaller teams that actually start straight away with MEV and with other kind of activities in DeFi and looking for different ways to trade on chain. So I think that definitely happened on the kind of other end of the spectrum of the coins. But yeah, that's kind of both of these things. It's like the mid curve is there, but the extremes definitely something that grew.
I guess one other thing which stands out from 2024 in my perspective is really the birth of app chains dedicated to trading only. DYDX is obviously one prime example of it, but we've seen Uniswap launching their own chain as well, and some others. Chains, the layer 1 chains, which are dedicated to trading only, so it really shows that the kind of specialization of the space is getting more and more clear, and there are verticals of different type of activities within the world of crypto trading. And people get better and better at what they pick as a focus. And for DYDX, launching the chain was a very big part of the history of DYDX. We had a part of our life on Ethereum since 2018, $1 trillion of trading volume in this part of the history of DYDX. Fast forward, we launched the chain about 12 months ago now, recording $250 billion of trading volume, so roughly $1 billion a day. and being able to essentially control the full stack and really improve the experience for users, and also being able to innovate at a pace which is much more controllable by our own teams involved with DYDX in general. Being able to jump on the meme coin train and enabling instant listing, for example, so people can essentially launch very quickly a market by themselves on the DYDX chain. So I think this evolution of the infrastructure is also helping and supported by the growth, but kind of feeding this flywheel of growth, more users, more liquidity, more assets, which I think is beneficial for everyone.
That's true, that's true. We already talked about CeFi and DeFi a little bit. Katja, you mentioned it. And also meme coins. I think they have contributed to people just trying out DEXs, whether it's on Solana, on Base, just to get some meme coins that are not yet listed on centralized exchanges. So if we look at basically the ratio of SEX volume and DEX volume, centralized exchanges still have a lot of volume. And what is the main advantage of using a SEX, and what is the main advantage of using a decentralized protocols?
Well, I think this year also marks the transitioning from how price discovery is happening when you list any asset. And I think meme coins were a great training environment for the community where we have seen that you can list on-chain, you can make a fair launch, you can discover the price, and then it creates way more opportunities for the centralized exchange listing. And then, of course, you understand that you can increase the volumes for one or another asset without being afraid that understanding the counterparty risks, I would say. Again, because the price discovery is happening through the community and not the VCs.
I guess one advantage when I talk to institutionals, which are for the most part still on CeFi, I think only 30% of the crypto institutionals are in DeFi today, so there is still a big space for growth and improvement over there. If you take a picture of the spot market today, about 10 to 15% of the global spot volume is happening on-chain via Uniswap and some others. If you look at the perps market, which is 10 times bigger than spot, you only have, I would say, between 2 to 5%, depending on the days, which is happening on-chain. So the perps market is bigger, but the migration of perps away from CeFi to DeFi has not progressed at the same pace as Uniswap. So I think there is a very large potential here. And one of the advantages of DeFi versus CeFi is, I think, the openness of the infrastructure. And it makes more and more sense for more and more people. Essentially, when you trade on CeFi, you're trading against a black box, and you're trying to get information and guess information from the flow coming outside of this black box. If you look at proper DeFi protocol, when they're designed the right way, DYDX is an example, the order book is totally transparent. So as a trader or as a quant, I'm able to essentially look at how the market performs, how my peers are performing, and I can identify like a specific wallet which maybe have always like 20 bips better performance than me every day, and trying to understand and train my algos better. So I think there is an access to data which is really an unfair advantage to DeFi infrastructure in general. And the institutions are starting to feel that whenever you trade on DeFi, it might be more fair in a way, but the black box is still there, and it does not allow you to outperform your peers so easily. On DeFi, you can really kind of improve your performance, improve your knowledge of the market by having much more open data to feed your algos. I think the vast majority of the volume is still happening via API, and beyond these APIs, there are essentially algos, which are constantly fine-tuned to perform the best.
And just zooming in on institutions and big players, what is needed for them to switch to protocols like DYDX, apart from the advantage of transparency and data availability? What are they asking for, or what are they looking for when trading?
So first, it's very strategic for them. So some institutions will be a little bit, I should not say that, but maybe a little bit more lazy and comfortable, saying, okay, we're doing okay on CeFi, why do we want to expand on DeFi? It's a lot of headaches, I will have to deal with my compliance department, I need to have my engineers much more on their toes to understand how this infrastructure works. But I would say like a larger and larger part of the institutional trading firms are seeing DeFi as strategic. Everyone knows the market is migrating to DeFi anyway. And some of them are taking actions much earlier than others and starting the learning curve before. So we see some shops which are saying, okay, DeFi might not be highly profitable yet, or we're going to allocate only so much, but I want to train my infrastructure team. I want to train my traders to make sure that when DeFi explodes, or when the proportion of the market expands more and more on the DeFi side, I should be ready. This is my responsibility. So people I think, are having a strategic view of the market in general and decide to go to DeFi for these reasons. The other side of the coin is probably the world of DeFi changing. If you look at all these centralized exchanges, the Binance, the Coinbase of the world, they are all into a global race to acquire licenses in different markets. Most of the licenses those centralized exchanges acquire in different markets are mostly for spot only. So what it means is that suddenly, let's say Binance acquire a license in France, they will get a spot license only. And within a week, they have to essentially close down all the futures accounts and lending accounts of their French customers. And the same scenario happens in many different countries. So there is also a change of liquidity in centralized venues where the retail is still very strong, but there is signal that the retail flow on centralized venues might be changing over the coming years with those centralized venues acquiring licenses. And for the most part, they are not licenses for futures, only for spots. So there is a strategic view of saying, okay, the infrastructure is about to evolve and we need to be ready, infra and trading side. And there is also signal that the flow is probably also starting to move, and the big base of retail users you will find on futures market is still very strong again, but starting to move. So that's really what's driving a lot of institutions. And then the pace of innovation. I think DeFi, if we want to accelerate the growth and eventually the dominance of the market, is creating some unfair advantage for DeFi. So if the goal is to basically be at par with centralized exchanges, we're going to only reach so much, right? But if you want to be at par, at the minimum, and then starting to create your own businesses, your own unfair advantage via instant listing, for example, DYDX released a few weeks ago the capability for users of the protocol to instantly list any new assets. So nowadays, we have like 10 new assets per week being launched on DYDX. That's something which is not possible to be done on centralized venues. So it's a good mix of market trends, market demand, and also as DeFi protocols to kind of carve yourself very unique value proposition so the migration accelerates.
I mean, I think a lot of the volume still in this market is retail driven, right? And kind of that is like it's a complex problem to solve, but like the formulation of this problem is very simple, right? It's like it's ease of access. And so ease of access, and with private access, I think it's, the UX of access and trading generally is much easier to achieve, to be on par or even better than centralized exchanges. But with, spots, it has been kind of historically more challenging, and it still is to an extent. It's definitely getting there. And I think generally, if you think about there are two types of users, right? And from retail, kind of broadly speaking, people who just want to get DCA into a coin or something like that, and then there are people who actually trade. The people who trade all the time, price discovery, and they're much more price sensitive, and so that is where centralized exchanges in many coins tend to be superior. They also want to have access to all sorts of different coins, right? Like without kind of having to be in the EVM ecosystem and Solana ecosystem and something, right? So they kind of want to have access to all these different coins and kind of get into the action that's happening right now. But then for the people who don't trade regularly, it is ease of access. And if you think about the hurdles and the barriers, there still exist today quite a lot of those, and getting a wallet, the seed trade, all of that stuff that we know, right? But this is getting so much better, and we're going to get very soon, I think, in 2025 for sure, to the point where actually CeFi gives you more hurdle because you have to go through KYC and all this sort of stuff. And even if you don't mind, it's just annoying. You have to take a picture, and you don't look good, and then you don't want to see some guy who's comparing some AI comparing it to your passport picture and whatnot. So basically, as soon as it's just super easy in one go to get and buy Bitcoin, ETH, Sol, whatever that is, right? That's where we're going to see like a much accelerated curve of adoption on DeFi. And I think that's realistically what's going to kind of change that 15% kind of market share within DeFi versus CeFi.
I think many of us have still vivid recollections of FTX and what can happen with centralized exchanges. Not so much maybe people who are just entering the space. That's why I wanted to pivot to Cube. So you've taken a quite unique approach to being an exchange. Can you tell us more about it, Bartosz?
Yeah, sure. So maybe like answering the before question. For me, like moving aside the KYC aspect and like how people onboard to the exchange, it actually starts with the infrastructure, right? When people access the infrastructure, the main difference is the trade-offs from like the developer perspective. And when I think about it is, with centralized exchanges, when you are onboarding to the exchange, the predictability of the infrastructure might be easier to understand. They can tell you, hey, you are in this specific data center on this specific switch, and you can connect to it, and you actually understand what you are getting into. And yes, maybe the order book and the behavior of that and how you access the data is a bit more opaque because they are not publishing necessarily their code and like how it runs, but the infrastructure will be very predictable. But when you are connecting to the on-chain infrastructure, the trade-off is like the code is very transparent, but the infrastructure that runs behind it might be very complex. And as a market maker, you end up needing to deal with those two different things. And that's why like onboarding us, like if you are trading on the centralized exchanges, moving to the DeFi world as a market maker can be very challenging because like understanding how like the RPC infrastructure for Solana, for example, works is very tricky. And then understanding how like that's different from Ethereum and like how MEV affects you, like when you trade, like that's something that you will never experience in the centralized world. And you can say, hey, it's more transparent, but in reality, it might not be, because like MEV is like the opposite of transparency when you are trading. And you can say, oh, but like you can get front run when you are connected to the switch and this and that, but like no, if you are if you paid for the access to the switch and you know your cable is super short, like they will not front run you. But like if someone pays behind the scene, the provider, like RPC provider, you will not know about it. And it might be super opaque. So like I think like at the end of the day, when you think about like as a market maker, both of them will exist because they give you different aspects of trade-off as engineering. Even like if the regulation changes or not, like let's say we scrap the KYC and you don't need to like provide your passport or face to both venues, you will have both like existing side by side because they give you different characteristics of performance. Like you can compose one and in a different way. And
do you think something like you know, the CeFi type experience? You know, we also have ETFs, right? So we haven't spoken about that. So that's kind of TradFi. That's, you know, that ultimately that is something that has like amazing infrastructure, you know, from all the you know, OG exchanges and all this sort of stuff. So like I just wonder, like I'm not predicting, you know, the death of CeFi, but I'm kind of interested in like whether it is indeed going to go into like, okay, there's like this DeFi world where all the meme coins and like any asset and like all of that sort of stuff. And then like for the majors, we're actually going just into ETF world and do all the, you know, short cables and whatnot. Because, you know, like centralized exchange APIs are not like, they're not like, you know, they're not the most amazing ones, you know, compared to
like they're easy to understand,
CME
right? Like you just connect and like, you know, like you get like fixed API and all of them are the same and like it's super easy to integrate. Like it's like you have like literally one person at the firm that can like connect to like hundreds of exchanges and it's no effort. And then when you switch to on-chain, each smart contract will be different and suddenly you need a team of like people. Yes, it's very transparent. There's a lot of code out there, but you need to understand each different characteristics of it. And it provides a lot of overhead and you don't know if like you are doing it right or not. You might end up being hacked. It's a lot of headaches. The ETF though is very interesting because like to answer the question about the FTX, it's like the level of abstraction, right? And like where are the trade-offs? And the ETFs are, especially when you think about like custody and what people are talking about, like how do they custody? When do they buy Bitcoin? When do they sell it? Like it's very opaque. Like what's the risk of that product? Like in many cases you just don't understand. And like that was ultimately the problem with like what happened at FTX, right? Like you didn't know where were the assets. They were saying, hey, there are some assets somewhere, and maybe they're there, maybe they're not. And ultimately that's why DeFi is like much more transparent, and like what we decided to do at Cube is like have the MPC that's super transparent and people can see the asset all the time. The problem with that is if you need to go to like rehabilitation of assets and like suddenly market makers want to get loans, now you need to like figure that out. And it's much like the cost of capital increases. So that's like another trade-off on like another spectrum. So you just need to keep thinking about these different trade-offs. So in short, I think there's no free lunch. There's no like silver lining that you can say, oh, we will just do this and it's solved.
Continuing to talk about infrastructure, I wanted to ask Vitaly, what was your reasoning behind bringing an order book on-chain? So order books, pretty common for everyone who trades also on centralized exchanges. What was your reasoning behind the decision?
Yeah, it's a good question. So before Spark, I was running growth at Mango Markets and I was building on Solana. So for me, running an order book on-chain, first of all, is a completely normal thing. And when you interact with the parallelizable chain, again, it's something a little bit unfamiliar for the EVM community. So here's the thing. I totally agree with Charles and I totally agree with Bartosz on every point regarding the infrastructure. On spot, your goal is not to lose the money in the first place. And infrastructure matters a lot. And then onboarding the users is, of course, the ultimate job. Over the last couple of years, on-chain venues have been almost completely illiquid, and all the traders, they have their tech, their bots, their algorithms that are relatively unified. There is this like CCXT spec, right, that is being used by everyone, and the majority of the trading firms are using Python bots, Python-based algorithms. But there is this group of on-chain traders, because when you interact with an on-chain order book, you only have SDK, right? And you got to build all your bots yourself. And risk management is also on you, on the trader side. We believe that this group will be, of users will be growing within the next couple years, and we're targeting those. We're working with small trading firms that, again, are very active on Solana today, for example. Actually, we're onboarding the majority of our users from Solana community. And I think also to bring it brings the next wave of adoption. When I say adoption, that's users. If you look at the trading companies and the traders that are trading on Sui app to Solana, again, they're very different from, let's say, Hyperliquid. I mean, if you go to Hyperliquid leaderboard, you can still find many on-chain traders there. So we're actually not competing with Hyperliquid or off-chain order books with on-chain settlement. We're onboarding the new group of users.
And speaking about onboarding, or generally, what is the main bottleneck that all of you are facing in terms of getting new users on board? Is it still that you need to convince them of the liquidity situation, of certain price execution guarantees? Is it that you just need to focus on the UI, UX part of it? What's the main bottleneck for you?
The main bottleneck is the same, I think, in trading all the time. It's you got to make a better product that comes with a lot of smaller tasks, like lowering the latency, improving the data indexing. It's still a very nascent tech. It's still a very young technology, I would say. And that's something, when you say on-chain order book, for instance, there's all flavors to it. Like Serum, for instance, they had a huge binary search tree that Solana stores on-chain, and that makes the state pretty bloaty. If you remove that off-chain, you like fetch the data from the indexer. That's what Ether Delta were doing, for instance. it comes with a completely different set of problems that you're going to be facing. But when you onboard, in Spot, you onboard users almost one by one, almost like single-handedly every company. That's mostly business development effort. On Perps, that's marketing job. That's why it's so big, I guess. It's a more degen product, so to say. What's the main bottleneck? Well, for the last couple of years, because we were bootstrapping the product, we now have 3 indexers, but making them work on a completely new virtual machine, because we're running on Fuel VM, with a new programming language called Sway, was a big challenge. Now as this thing works, another challenge is bringing the users, but I was pretty surprised actually when we launched and we started talking to the users that this tech didn't represent any fear for them. I think the next step would be expanding this user group, and we're on the crossroad between onboarding the traders from the centralized exchanges or expanding the DEX trader community.
Let me take the opposite view. I think in Web3 in general, we think very badly and inefficiently about distribution. I see so many projects, and DYDX partially is doing this also, doing exactly what Web2 project did 10 years ago, trying to acquire and bring everyone to your own shop. So you spend money marketing, advertising to bring everyone to your .com or .app or .if, whatever it is. And if you look in the real world, distribution will not be changing so much even though we are in the digital world. I think Web3 next wave of user acquisitions in DeFi in general will be when the DeFi project will start to understand and execute on better distribution, bringing the product where the users are. There is 150, maybe 200 million crypto users which are sitting on DeFi, on CeFi, and they're getting less and less services from time to time because their exchanges are getting licenses. And I think when you look at all these CeFi players, they are all facing the same issue, and they are all thinking, okay, I get license, I get essentially the scope of my business kind of shrink down. I'm building a non-custodial wallet. So you have the Coinbase non-custodial wallet, the Binance non-custodial wallet, and so on, right? So I think there is a big opportunity for all of us in DeFi to think how we're going to distribute, and instead of trying to bring people to our own shop, trying to bring the product on the right shelves where the users are. And there is an opportunity here, and this can be probably kind of really hockey stick kind of growth for many projects, to find ways to essentially improve their distribution and accelerate their distribution by an order of magnitude by bringing their product into the Binance non-custodial wallet, the OKX, the BitGet, everyone has the same thing, so that we don't have to think so much about what are the bottlenecks for onboarding, but thinking how can we be just more easy to consume, and let some of these exchanges, which sometimes have more an American flavor or an Asian flavor, and they know how to deal with the different onboarding flows for different parts of the world and type of users, and let them do this kind of work. But I think there is a really big opportunity here where DeFi can essentially rethink more deeply how it's distributed, and not taking the hard fight of acquiring user on your own, but thinking how do I distribute better. And if you look at how finance and TradFi products are distributed, for the most part, they are distributed this way. Your bank today, your fiat bank, is an aggregator. Usually they have a license for a saving account, and then they tell you, oh, Charles, you can do also stock trading. Let me give you access to the stock market via a prime broker, aggregating services from a prime broker. Same for my car insurance, aggregating the services from for an insurance company. I don't see why the distribution kind of framework will change so much in crypto. I think the terms and the commercial terms will be very different. The pace of connectivity will be different. It will be permissionless, so it opens the world for more efficiency and more competition in pricing. But this is what the people want. So I don't think we should fight this wave too much, and thinking more in first principle, like where are the users, and bring the product to the right shelves.
Now, putting ourselves in the shoes of the retail user. If you want to trade, Bartosz, you briefly mentioned MEV. How is it possible for a retail user that is, let's take one example of somebody who's just trying out DeFi for the first time, doesn't really understand slippage, doesn't understand MEV. How can they protect themselves against bad execution?
Yeah, I mean, it's pretty tricky. Like, I think, like, products are trying to do a pretty good job. And I think some of them are, like, succeeding pretty well at it. I think, like, Jupyter, for example, like, slippage protection is very, very good for retail. Some products are providing, like, DCA, like, functions, at least on spot. And, like, if you expose it and educate users about them, they actually, like, use it. But like end of the day, like maybe it like doesn't matter, right? And like that's connected to the previous question as well. It's like if users believe like they can make money with your product, sure. Like they don't like the slippage will not matter. The way the like product looks like or is distributed, or like how many hoops you need to jump through. Like do you need to take a picture or provide a passport? All of this like does not matter if they think they can make money. And like ultimately that's the question I think that like is like core of like the crypto, right? Like the product market fit is like, can I make money here? Everyone is here to make money. And as soon as you can answer that question and the user sees it, I think like they will just come.
I think there's like for kind of a spot, I think there are kind of a few different types of users. I mean like, you know, everyone needs spot, right? Like everyone needs to swap tokens for you know, multiple different reasons. And so some of those audiences are definitely like either kind of price sensitive or just want a certain level of certainty. For example, automated actions is something that like, you know, for those kind of projects and for those kind of automations, it's super important that if you schedule, you know, some like stop loss, or if you schedule if this then that type of workflow, you have to, you know, basically kind of have enough tokens coming out of your spot trade, you know, for that next action to be possible, right? And so this is where, for example, from our perspective, we are able to deliver those no unexpected slippage quotes from market makers due to, you know, the RFQ system and how it works. And this is kind of like a lifesaver, for example, for those of them, this and then automations. And ultimately, that is something that might be used by kind of like under the hood by the end users who just want to say, hey, you know, if today is the full moon, I would like to buy some Bitcoin because this is kind of like my trading strategy. Then somehow, even though it's like, you know, the slippage itself, like if they went just to come and click, wouldn't have mattered, but, you know, for that workflow, it does matter. So ultimately, but ultimately I agree with your point that, like, I don't think it's a job of the user to protect themselves from MEV. I mean, that's why all these products exist, right? If it was the job of the user to protect themselves against MEV, it would also be their job to read the smart contract. It would also be their job to, you know, code into smart contract to interact. You know, it's not the real world, right? So, I mean, this is why we all kind of have a role to play in this industry, right? Is to solve those problems for them where relevant, and hopefully make money for them along the way.
So
should we speak about indexes?
I would love to talk about crypto indices, but I would be shilling my own project, right? So
I have a question for you. I had a very nice conversation 18 months ago with very large trading firms, and I was kind of questioning them about their appetite for indexes, and I got a blunt answer saying the market of crypto is not mature enough to kind of trade it with indexes because it's basically Bitcoin and then it's altcoin. And this guy was not really bullish on indexes. And I kind of understood his answer, but I was not really satisfied with it. And in traditional finance, I trade indexes, and I'm happy with it. And I'm still kind of looking at this market, and I know you guys are very active on this space. Do you think, is it the right time now for indexes in crypto, or is it too early?
I think we're getting ready. I do agree that a couple of years ago it was likely too early, but yeah, you look at different metrics, right? So you have to look at capping mechanisms for sure. There are some index providers out there that don't cap their constituents, which means that an index looks like 60% Bitcoin, 30% Ethereum, and 10% everybody else. So that's obviously not a smart way of approaching things, because you can argue that, okay, I'm just going to buy Bitcoin and ETH myself. So I think weight capping is important, but now having the spot ETFs, having likely more ETFs in the next, let's say, 1 or 2 years, I think we are getting to a point where indices are feasible and we are hopefully right on time. Because if you look at TradFi, like 70 to 80% of TradFi perps volume is index-based. So everybody trades the NASDAQ, the S&P 500, the Dow Jones, local stock indices. So it seems like an obvious bet. But yes, crypto, it has been not a common tool, not a common trading tool to use indices, but I'm quite confident that this will change.
And what will be the audience of indexes in the early days of the indexes market? Will it be like retail, or do you think like large trading firms will be comfortable to take positions via indexes?
That's the beauty of it. So indices are for everyone. You can be a large institution. You can trade it as a CFD. You can trade it as perpetuals. You can use it to basically go long or short on narratives to basically hedge yourself. There are many ways of doing it. If you have let's say tokenized indices, you can use it as an ETF, do your DCA, just based on how the market is going. We have done, of course, back testing when we did our indices, and our top 30 index has been better than Bitcoin if you look at the last 4 years. So of course, in the bear market, it goes down more. In the bull market, it goes up way more. So actually, the outperformance is still significant. So even holding, let's say, a top 30 index over the period of 4 or 5 years is quite a profitable strategy. So I think it's just a question of time, and trading indices with the lower volatility and the rebalancing done for you, I think it makes a lot of sense.
I think the question is a bit more complex. It's really about the portfolio construction, right? So like when the reason the indexes are traded more in traditional finance is the portfolio construction is different. It's in many cases it's based on like factor model, and that just doesn't exist in crypto. Like nobody trades crypto like based on factors. If you don't have that, then like you don't need indices to like hedge the factors to like create balanced portfolio that's beta neutral. And then the only use case then for the indices is like, oh, I want to trade this theme of like tokens, but then it turns into a meme. Or like I want to trade OG coins, like I can just buy them.
Yeah, but actually this is like I was thinking that like I think the kind of case for the crypto indices right now is around theme, around those themes, and that's yes, you can just go and trade those coins, but actually, I think there is a segment in the market who like doesn't necessarily want to like pick those coins every time and then rebalance because one of them is dead and a new one comes in. So kind of like investing in narratives. I think with the alt run that kind of already have seen starting, and that's probably will continue. It probably will go kind of like theme by theme, and I think this is where kind of like those kind of like sector indices might be quite interesting. The GMCI 30 index, or like any kind of like broad market index, I feel is kind of has more potential as a benchmark, kind of data point, perhaps more than an investment like today, which would be different from kind of obviously how TradFi works in terms of index ETFs and things like this.
I will use indexes for to benchmark the fund performance, for example, or benchmark my own strategy, like having an index around, even though I might not be trading the index, maybe my first interaction with it will be, am I doing better than the index? And maybe the conclusion will be like, Charles, you should not be making yourself busy that much for so poor results. Why don't you just follow this index? But I think it's probably part of the journey to benchmark yourself against the index and see if you would have done better. Yeah.
For sure, but to be honest, most of the funds, they contact us, they see how the benchmark performs, and then they decide to not benchmark against our benchmark because it's hard to, to outperform it. If you take, let's say, 20% of the upside and 2% annual fee, it's hard to beat the index. I mean, it's the same in TradFi, right? Not many consistently beat the NASDAQ, the S&P. But yeah, definitely definitely interesting to watch. We are out of time. I'm not sure how strict we are here with the timing, but are there any questions that I haven't asked that you would like to talk about on your end? If not, then I would say please feel free to reach out to us if you see us at the conference. I think we all have stands here. Feel free to come talk to us. I'm happy to talk about crypto indices if you want to. And yeah, thanks for your insights and thanks for your attention.
Thank you, everyone.
This Fireside Chat is with Austin Federa and is hosted by Tim Copeland.
Awesome. I'm here with Austin Federa. How are you doing?
Hey, thanks for having me.
So up until yesterday, or at least I guess the whole time I've known you, you've been at either Solana Labs or Solana Foundation. But as of yesterday, you announced you're doing your own thing. It's called 00. You're the co-founder and then president of 00 Foundation. What's 00?
Yeah, so 00 is a new project that me, Andrew McConnell, and Matteo Ward have started. And we're really setting out to rebuild the fundamental underlying fabric of blockchains in the internet. And today, when you look around and look at all sort of fast and high performance blockchains, the one commonality you see is everything operates purely on the public internet today. Whether that is a central L2 sequencer, whether that's Bitcoin, whether that's the Solana network, everything is taking place using the same pipes, the same pathways for data flow. That's all mixed up with iMessage and Zoom and Twitter and all sorts of other types of communications. And one of the learnings from the time at the Solana Foundation, where I was heavily involved in the FireDancer project, was that the limiting factors on the scalability of blockchains into the future, especially if we care about decentralization, is not compute. Right? Everyone thinks these networks are compute limited. They're not really compute limited anymore. It's bandwidth limited. It's interconnectivity between validators. It's how quickly you can have state changes from one node propagate out to 2,000 node clusters. And it's how quickly you can get transactions to land into these blocks, right? And so what we set out to do was take the best of the high-performance private networking world, which is nothing new, right? Companies have been running their own private high-frequency fiber lines, whether that's Google and Netflix and even back in the day Oracle and IBM, or whether it's the high-frequency trading firms that all use the latest and greatest and the fastest technology to try and front-run each other and get to exchanges as quickly as possible. If you've read Flash Boys, it's all that type of stuff. But in crypto, we're still stuck using the public internet. And the public internet's great, but what it's not great for is dependable, high-throughput, high connectivity. And so the question for us with 00 was, can we build a network that allows multiple independent contributors to come and bring 1 gigabit, 10 gigabits, 100 gigabits of connectivity on physical fiber lines all around the world into this network, and do it in a way that gives users and validators cryptographic assurance that their transactions are not being monkeyed with, that the network is actually operating as it should, and also give them the performance of private networking technology.
Okay, so basically you're saying the internet is not good enough.
The internet's great. It's not good enough for the aspirations we should have for blockchain. If you want to have Bitcoin continue to be the strongest, most decentralized protocol out there, it should operate on the public internet. It should be able to operate on 56K modems. It needs to be universally globally accessible. The minute we start to move into execution layer blockchains, right, whether that is Solana, whether that is L2 environments, whether that's SUI, whether that's Aptos, any of these types of systems right now, they're too slow. And they're too slow because the connectivity fibers between them are too slow. It's the same reason that no financial trading firm in the world would be caught dead using the public internet to trade on. It's too slow, it's too latency prone, the jitter is too high in all of these type of systems. And so our goal is if we really want to get blockchain up to 10 million transactions per second, even if we're doing it on a centralized sequencer, you have massive state propagation issues where how do you get all that data, all of those changes in real time, pushed out to the RPCs, to the indexers, to the exchanges? How do you create global price discovery markets? All of it comes down to how fast you can move data and how much data you can move.
Okay, so it's sort of like a content delivery network, but specifically designed for blockchains.
Yeah, I mean, one of the sort of crude analogies that we were using in the early days is Cloudflare, right? Cloudflare is a global CDN network with point of presences in all these different markets. They do protection for websites, right? DDoS protection, all these other sorts of things as well. But like fundamentally what we're doing is combining two different frameworks of technology. One is high capacity, low latency global fiber links, and the other is hardware acceleration for some of the most common tasks in blockchain.
Okay, so what is it that you're building specifically? Is it a blockchain? Is it like a neutral network?
Yeah.
What sort of form is this coming out as?
So we don't have the language in the industry today to talk about what this thing is. We've been calling it an N1 as opposed to an L1 because this is not a new blockchain in the sense of no one's going to be writing smart contracts so they deploy onto this network. You're not going to be, having to get a new wallet to interact with it or something like that because it's not really meant for users to interact with in the traditional way. Under the hood, we do have a custom-built blockchain that is going to be running across all these nodes, but that's really just because blockchain is the best system of accounting humans have ever come up with. And what we need is we need a system to actually properly manage the accounting of who should get paid out and those sorts of systems. But this is base layer infrastructure technology for all fast blockchains. So a network like Solana can, validators can say, we're going to opt to locate on the 00 network, which doesn't necessarily mean they have to move where they are today. They can extend the network and bring it into the places that they're already operating on. But what it offers them is a much faster pathway for communication. We talked I mentioned a little bit some of the filtration services. So we can do things like packet deduplication and signature verification on hardware devices in the network. Right? So these network appliances are built into the switches. We are using FPGAs to accelerate this type of work. And really what that means is we can offload about 70% of what a validator currently does today. They spend 70% of their time on Solana, and this is true on other networks that see huge demand, just sorting through transactions, throwing out the duplicates, making sure the signatures are valid, all the good stuff you see normally happen in a blockchain. That takes about 70% of the time a validator has to build a block today. And so we can do this through hardware acceleration, and the validators themselves will still do redundant signature verifications to make sure that all the transactions are valid, but we're able to use resource sharing and offload that because one of these network appliances can support probably 100 validators or so downstream from it. And so we're kind of taking, I would say, like old principles of resource sharing and bringing it into blockchain. Because today, if you're an Ethereum validator, if you're a Solana validator, if you're a Sui validator, you face the full force of every piece of transaction demand in the whole internet that's coming into you when it's your turn to build a block. And that's really hard, right? That means people have to over-provision servers, or you have to introduce things like mempools that that increase latency, right? Now you have to land in the mempool before you can land in the validator, or it forces people into private transaction systems that aren't universally accessible. And so we think we can kind of take the best today of like what works really well in crypto, and we can probably accelerate it 1,000x.
Okay, and are you targeting this to be the infrastructure for all blockchains or primarily high-performance ones?
So I don't know if there's much of an advantage of like the Ethereum layer 1 operating on something like this because the goal of the Ethereum L1 is not to be fast, right? It's roughly doing 14 to 20 things per second, and everyone's pretty happy with that. But the minute you start to look at anything like Mega ETH that's trying to, or much more high performance systems like that, you start to run into the exact same issues that Solana's been battling for the last 2 years, which is insane demand, unintentional DDoSes because you have this massive flood of demand coming into the network. And that sort of thing is exactly what 00 is designed to address. So, Solana is one of the first, the first network we're building out support for because it's the one where there is immediate product market fit. If any of you were at Breakpoint and saw like the new Firedancer client for Solana can do 1 million transactions per second, it can't do that on the public internet because the public internet's too slow, the jitter's too high, the latency's too high, all these sorts of issues. But as we look forward, I don't think Solana's going to have a monopoly on being the fast chain, right? We're already seeing Base pushing gas fee limits up. We see the roadmaps for decentralized sequencers. The minute you start to see multiple entities trying to produce and even 10,000 transactions per second in a block, you are starting to need the types of things 000 is able to offer.
Okay, and let's say you are supporting like a lot of big chains, and you're funneling a lot of the transactions, and you're basically responsible for a lot of that. How do you ensure it stays credibly neutral?
Yeah, so credible neutrality is one of those words we throw around a lot in blockchain, and the truth today is there is no validator operating on any network that is in itself credibly neutral, right? This is something that's like a very hard thing to like get your head around because the networks themselves are credibly neutral, but each validator is its own dictatorship. It determines exactly what transactions it wants to put in its block. It has the ability to reject transactions, and there's no way to enforce that a specific validator must include your transactions in a block, right? This is literally what MEV is all about. This is what these side deals are about for landing transactions. And so the way you sort of think about that on a network level, though, is, well, there's always another validator that I can go to, right? If this Ethereum validator has said it's OFAC compliant, well, there's another 47% of the network that is not. And so I can go around it and submit a transaction somewhere there. You can't do this with a single sequencer, but there's arguments about how you can bypass a sequencer and write directly to the L1. Back to your question, though, about like 000 and its neutrality, when you're dealing with physical networks, the idea of a Nakamoto coefficient or some sort of number like that, it changes dramatically. So you can look at a network like Ethereum and you can say there's 20 entities that control the majority of stake, or Solana, it's something like 19 entities that control enough stake to interfere with the network. And so that's the Nakamoto coefficient of a network. When you're looking at a specific endpoint on the 000 network, it depends on how many other connections are coming into it. So for example, if I'm running a node in a location where there's 2 independent contributors that are bringing bandwidth and filtration services into it, my censorship-resistant point from the 000 network is effectively 2 at that point, right? But you still have the public internet as a fallback. And so with all these types of systems, if you're running a network that only has 20 validators, it's pretty easy for those validators to collude and censor you as an individual. And so the goal of 000 network is to build out extensive redundant connections through multiple points. Now, part of this comes down to each of these nodes and connections on the 000 network. They're run by independent contributors, and they are going to have tokens staked to them for economic security. And so there are slashing mechanisms and other types of enforcement mechanisms. You can make sure networks are behaving fairly. But at its core, this is a classic problem in crypto of you have to catch people who are misbehaving. And the way you do that better than catching them is you align incentives, right? And so we have a pretty robust economic model built out that is designed to make it so the incentives to interfere with anything moving over the network, it's not a net profitable activity. The same way you can build a block on Ethereum or Solana that has an invalid signature in it. Every other validator is going to catch you and throw your block out, and you're not going to get any rewards.
Okay, and talking of incentives, will there be a token?
Yes, right? It's a token incentivized network at the end of the day. And it has a token not because we want there to be a token. In fact, the network is significantly easier to build without a token, but we want this thing to be permissionless. And we want it to be, it's really important, I think, to me from a crypto values perspective, that anyone can go in and they can say, I want to bring the 000 network into the area that I choose to operate my validators in. Maybe I care a lot about being able to run validators in my country, right? Brazil is a great example right now. It's extremely hard to run Solana validators in Brazil because the internet infrastructure in Brazil is quite poor, and the latency time, like literally the amount of time it takes light to get from Brazil to like Amsterdam is too long for people in Brazil to be able to run nodes on the public internet. But 000, because we're reducing latency, you're actually able to now expand the geographic region of the world where you can run it. And one of the core learnings from Solana is like just because someone like me is sitting at the foundation doesn't mean I have any better ideas than anyone else. And so what a token does is it enables permissionless contribution of resources and it allows people to build the network out on their own. And if you don't have a token, you're not able to do that. This is the power of tokens and power of economic systems that are based on tokens.
Okay, and how much money could this save validators?
So it depends, right? Right now, what we see on Solana is there's a huge amount of money going into prioritization fees. You see this on Ethereum as well. And so there's two ways to look at this, right? The first is from a resource saving perspective, we're saving about 70% of the time it takes a validator to process transactions. That's 70% more time they can build more efficient blocks and more profitable blocks. But the minute you start to have global low latency connections, suddenly any MEV systems have a huge incentive to use a network like this because they can land transactions more quickly and efficiently to wherever the leader happens to be in the world at that time. This also applies to RPCs. They can get state updates more quickly. So a leader produces a block. That block has to propagate out through the rest of the network. That propagation time varies, right? Just because a block is produced every 400 milliseconds doesn't mean every node on the network and every RPC is instantly updated with that new data. Even on something like Base, where you have a centralized sequencers, the RPCs are always playing a catch-up game to where the state of the network is at any given moment. And so that's one of the main use cases for 00 is increasing block propagation and transaction ingest time. We think we can, in combination with Jito and other systems, you can probably squeeze 2x the economic performance out of an individual validator, and you can probably cut their costs by a pretty significant amount because they don't have to over-provision protection resources as much. And they can optimize much more around how do we build blocks better as opposed to how do we make sure we're able to build the block in the first place.
Okay, and what's the timeline looking like as you sort of gear up towards a potential launch?
Yeah, so we're building out an initial testnet in 16 cities, which is about a 20 gigabit network globally. We actually have 4 validators running today on Solana mainnet that are operating on the 00 network. So we're in good phases with the testnet program. We expect that to be rolling out sort of a more public testnet over the next few months. And the goal is to get the network operational in 2025 in a permissionless state.
Awesome. And when I first heard about this, my initial thought was, why didn't you, you've been very well connected to the whole Solana ecosystem. Why didn't you go out and launch any sort of protocol on Solana? You could have raised a lot of money for that. You could have made a lot of money from that. That was my first thought. Why choose 00?
Yeah, I mean, it's a good question. I'll say, having spent the last 4 years in Solana, it is the network I know best. It is, I think, where some of the most interesting and exciting application layer and execution layer problems are happening now. I had the urge to go build something, and, when you have that urge, you have to follow it. And the question is, why didn't I do that explicitly just in the Solana ecosystem? I think the aspirations of something like 00 are much larger than just Solana, and especially than just crypto. I mean, you talk to Andrew and Matteo, are my 2 co-founders, about this, and Andrew's vision as a CTO is that the whole fundamental architecture of the internet is wrong. That we have gone from a place where this is an independent system run by different core contributors all around the world in the early days of the academic internet, to a system that is largely run by the cloud providers and tier 1 internet providers, and they have an important role to play, but we see a consolidation occurring. And if we fast forward 10 or 15 years and the cloud providers are running 80% of the internet, I don't think that's an internet that we want. And so, from my perspective, the ambition of most projects in crypto is far too small. We're thinking about 10,000 transactions per second as success. We're thinking about $4 trillion market cap is meaningful. We're thinking about, a few 100 million users globally, generously. We're probably even less than that as mass adoption. We're all thinking way too small still. And so part of the goal of building this project is to build the underlying base layer neutral infrastructure needed for people to start thinking about what does a fully hardware accelerated blockchain network look like that's aiming for 20 million transactions per second. How do we actually get these systems to a place where someone like Visa and MasterCard and NASDAQ are actually considering using them? And how do we get to a place where we're leveling the competition field between centralized players that have privileged access and decentralized players all around the world that are able to participate in these types of networks? And when I looked around, what I saw is a ton of innovation on the software side and almost no innovation on the hardware side and zero innovation on the networking side. And to me, that is, if you want to go mine asteroids, you got to build rockets first.
All right. And on that note, that's all we have time for today. I want to thank Austin Federa for being here. My name's Tim Copeland, editor-in-chief of The Block. And I hope everyone enjoys the rest of the conference.
Thank you.
Good afternoon, everyone. It's a very exciting day to be talking about the future of Bitcoin. Obviously, for anyone who may have missed the signs around the conference center, we broke past 100K early this morning Prague time. But yeah, outside of that, there's also kind of the potential. People are talking about a U.S. strategic Bitcoin reserve. Plenty of interesting things going on in terms of building on Bitcoin. Which these two gentlemen here will discuss in turn. So with that, I'll hand it over to you, Manib, to kind of introduce yourself, and then we'll move from there.
Yes. Hi, everyone. Manib here. I'm the founder of Stacks, which is a Bitcoin Layer 2 project. Think of this as Bitcoin is very simple, very durable at the Layer 1, and you can move it to Layer 2 for faster, cheaper, but more programmable Bitcoin transactions and contracts. So we've been live on mainnet since 2021, and recently did a major upgrade of the network that if people were more tuned to the project would be aware of.
And Brendan.
All right. Hi, everyone. Brendan, one of the initial contributors at Core. We're a Bitcoin scaling chain, fully EVM compatible, secured by Bitcoin, specifically miners who delegate hash. Over 75% of which participate in the network, and then there's a native Bitcoin staking function. So as a Bitcoin holder, you can also participate in the consensus and earn block rewards. We've been live for about 2 years. Project was fair launched, looking to expand the utility of Bitcoin as a side chain, and just hit a big milestone of $1 billion in TVL. Lots of users, and excited to talk about everything Bitcoin today, future of Bitcoin, and just have fun. It's a big milestone with the 100K psychological barriers, so I think it's going to be a fun panel.
Yeah, definitely. So with that, I want to kind of start in terms of what you guys may think is the biggest misconception about Bitcoin's future. Maybe as many people, or I think Jerome Powell just made a comment earlier today at the DealBook event about it being digital gold or like gold. Obviously, that's kind of a long-term maybe misconception about the asset. But yeah, I'd love to kind of hear what you guys are thinking in terms of what people may be missing or misunderstanding maybe about the future of Bitcoin.
Yeah, I think if you look back to like 2017 or even 2021, the last two sort of like bull markets that we've seen, the general consensus in the industry has been that Bitcoin is this like old chain, right? Like you can't really build on it. It's a store of value, sure, but nothing interesting is happening on Bitcoin, right? So that was sort of the narrative, and it reflected in developer activity as well. If you would go to like a DevCon or Breakpoint for Solana, you'll see like a ton of developer energy, people building interesting things, experimenting, and I think that has been that's something that we in the Stacks community would be very vocal about, that no, you can actually build on Bitcoin, it's very interesting, it's actually very secure. Yes, there are some technical challenges, but they can be overcome. And I think in the last, I would say a year and a half, which people are calling it sort of like, Bitcoin Renaissance or Bitcoin Season 2, whatever name you want to give this, there has been almost like, developers are coming back to the mothership, right? Like people are realizing, especially with like ordinals and runes on the L1 and the fees going up at the L1, people are realizing that Bitcoin L2s are going to play a major role, just like they're playing a major role in the Ethereum ecosystem as well. If anything, Bitcoin needs L2s more than Ethereum because Ethereum is programmable at the base layer. So I think that's still one of the biggest misconceptions out there, I think.
Yeah, Brendan, anything to add?
Yeah, just to jump on that, I think Manib said it well. Just to store a value, I think is a misconception. There's a lot of latent demand to do things with Bitcoin. Some of the use cases that were just mentioned, runes, ordinals, and then obviously we're in the scaling space. Folks want to do things with their Bitcoin. They want to collateralize it. They want to borrow. They want to do things with it, earn yield. And we, talk to builders, institutions, holders who have Bitcoin, and they talk about this every day. So there's clearly a lot more value and story here than just a straight store of value. Another one that stands out is that you need to give up custody or take crazy risk or trust assumptions to earn yield. There's new products coming out, Core being one of them, where you can stake non-custodially directly on the Bitcoin network using a hash time lock in your own wallet. Gone are the days where you have to give up custody in like a BlockFi or Celsius and do very risky things with your Bitcoin to earn yield. And I think there's a lot of folks innovating in that space, adding utility without having to take on a ton of risk, and that's super exciting. That's kind of step one, I think, to expanding utility of Bitcoin. Yeah, we can talk more. There's many others, but that's what comes to mind.
Yeah, no, it's a great point. And I think it kind of tees up the next question well, because you mentioned Ethereum and of course yield and some other protocols here, but what kind of tech do you see as being kind of most exciting from other tech stacks to bring to Bitcoin? Obviously, it can be things that you guys are doing with your respective projects or just other things in general you may be seeing in the ecosystem.
Yeah, so I think, let me step back first, right? I think in the early days of Bitcoin, when I sort of like discovered it, this is like 2013, 2014 era, there used to be this concept that any successful experiments from other smaller chains would eventually come back to Bitcoin. It's a little bit like, hey, let them run the experiments, let them do more risky things. And if something actually finds product market fit and we see that this thing actually has legs, it works, those things will come back to Bitcoin. And everybody sort of believed in that back in the day. And they would look at, Ethereum. Obviously, Ethereum is a much larger and mature ecosystem now. But back in the day, they would look at it almost like a test net, right? Like, hey, let them play around with things, let them do risky stuff, and then we will implement this on Bitcoin once it's proven. And I think it took a very long time for that to actually pan out. But some of that is finally happening now. Like, even if you look at, Ethereum pioneered a lot of roll-ups research and ZK or other types of things, and now Bitcoin is getting almost like a head start, right? Like those 5+ years of R&D that happened in Ethereum, the technology matured, and when people are trying to bring those things to Bitcoin now, there are a bunch of new, Bitcoin roll-up projects that got funded. Most of them are not live yet, but they don't have to spend 4 or 5 years rediscovering what has already been discovered, right? So I think that's the broader lens to think about. And then in terms of use cases, I would say stuff that has clear product market fit in terms of stable coins or simple things like, locking up your BTC in a smart contract and getting a stable coin loan against it. Last cycle we saw, BlockFi and others, they were centralized use cases and they blew up. And the decentralized one actually survived, but they were built on Ethereum and other places, right? Not on Bitcoin. So I think the next wave is going to be actually pretty low-hanging fruit in a way, but with much larger capital base and a much more mature user base that Bitcoin has.
Sure.
Yeah, building on that last point, I think that's one of the key things, right? It just hit 100K. It's like $2 trillion plus asset, likely going to grow a lot bigger. There's just so much capital and latent demand that I think there's a lot of renewed energy to come build things here. And I love the way Manib put it, that there's a lot of technology, like what I say, coming home to Bitcoin. So it's just to add a few more things, very excited about research around interoperability. Mentioned ZK, but there's tech like BitVM. There's some OPCAT proposals and community consensus building happening there that would make interoperability with other chains a lot actually trustless and enable L2s. So that's pretty exciting. Very interested to see how that pans out. And yeah, there were just a lot of innovations in the EVM ecosystem. Core's EVM Just excited for a lot of those to come to this capital base that's basically just kind of sitting there, not doing a whole lot. And that, to me, is a massive opportunity.
Yeah, so I guess as a follow-up to that, do you think 100K will kind of bring in more kind of this people to these Bitcoin L2 ecosystems with respect to kind of they want to find more ways to get yield out of their asset, or do you think maybe they try to sell their asset and get that, pricing that way?
It's a great question. I mean, I think see kind of the price here is, try not to think about it too much, honestly. I know probably everyone says that in the build, but generally try not to think about it. But days like today are obviously super awesome and exciting if you're in the space. But to me, it's like free marketing, right? It's like great marketing. It educates people. They start to talk about it and hopefully come in. And now with new solutions that are coming out, you can do things with your Bitcoin. And you're seeing folks that have been in Bitcoin for multiple cycles and have been sitting on the asset, very excited about putting it to work in solutions that aren't centralized and super high risk, with the risk of losing a ton of Bitcoin. And again, I think that's step one of utility, such as like non-custodial staking and others. And then you're seeing people who want to take on more risk coming on chain and deploying Bitcoin derivatives. There's a ton launching. It's super exciting. So yeah, I guess the answer to the question, rant over, is I think it's overall good. It's a leading indicator. It increases the amount of capital there is that can come on chain, and it builds excitement. And then the people who've been sitting on bags a long time are very excited about finding opportunities to do things with their Bitcoin, which bodes really well for the space that we're in and why we're trying to unlock that capital.
Anything to add, Manish?
Yeah, I think the 100K was an interesting moment for sure. Like, I don't know how it happened, but I woke up. Like, my body just felt it, that something's happening. I woke up at like 3:30 in the morning, and I checked my phone. Probably my phone was buzzing, and I think that's why I woke up. And for a minute, I couldn't believe, like, is it a dream? Is it actually happening? Like, have we crossed it? And then the funniest part is that a lot of my, let's call them the normie friends, right? Like that you've been trying to tell them about Bitcoin for years and years. And they're sending me messages that, oh, it actually did cross 100K and now I'm buying, right? Like it just never makes sense, but they actually get convinced after they see the price movement that, oh, this thing is actually going somewhere. And these guys were right? Like, so I think new capital enters when the asset actually crosses a certain threshold, and people were skeptical before, but when they see it happen, they actually get more convinced. And then I agree that a lot of the early holders, like this is actually a pretty interesting problem that a lot of like developers are realizing this now. A lot of the early Bitcoin people, like people that I met like 11 years ago or something, they actually don't want to sell their Bitcoin, but they also don't want to get tax hits on it, right? Like needless tax hits. So someone can say, hey, why don't you just use WBTC on Ethereum, right? The technicality there is that BitGo is going to issue you a 1099 because there's a custodian in the middle, and any Bitcoiner who's been sitting on like large capital gains doesn't want to get a tax hit just for you moving their BTC from one chain to another, right? So you have to design, so with Stacks, the type of solutions we're designing, it's not just speed and Bitcoin hash power, those things, but it's like the way you move your Bitcoin actually needs to be fully decentralized and open for tax purposes also, so that there's no custodian in the middle and you can actually just move your capital. And the second thing is security. Like these people are paranoid. Like if you've been hodling your Bitcoin for 10 years, the last thing you want to do is actually lose it in a hack or in some company going under or something, right? So that's why we in the Stacks ecosystem, we have a very, very safe programming language. The downside of that is like, it's not Solidity, it's not some other well-known language, but once developers get a hang of it, and it's like a very precise tool, right? Like it's optimized for safety. The Bitcoiners do feel better about that. Like, okay, this contract can be much easily formally verified. You know exactly what the program can and cannot do even before running it. So it's like, the way I think about the Stacks ecosystem is that because it comes from a very deep Bitcoin background, we're sort of designing products for ourselves. Hey, is this something that we would use because this is these are the criteria for a Bitcoiner to actually start putting their Bitcoin into a contract.
Yeah, for sure. I had a similar experience at around 4 a.m. I think my phone notifications woke me up too. So, but yeah, obviously we're talking about a lot of inbound capital, especially breaking that threshold. And there's obviously also been a lot of speculation, as I kind of mentioned at the top, around the U.S. Establishing a strategic reserve of Bitcoin, especially given the recent election results. So, with that, do you think a strategic reserve would be beneficial to the future of Bitcoin?
I mean, it's definitely very bullish and a good thing. I don't know how you can't see it as a very positive sign. And it's kind of like game theory that Bitcoiners have been talking about for a very long time that's actually coming true. I mean, we'll see, right? To be determined, but you're already seeing other folks like Bhutan, El Salvador, et cetera, that are stacking sats. And the US already has a lot of Bitcoin, as does, I think, the UK. So it's kind of a bit of a dream scenario too, right? And then if you think about building a new financial system in a way, like this is a new collateral asset that they hold that they'll probably collateralize and want to use, unlike historical assets. So I think it's just very exciting. And the game theory is playing out. It's basically a dream game theory scenario.
Any thought?
Yeah, so I think we can actually almost like study this sort of a dynamic at a smaller scale. If you look at even large VC funds, if a new category comes along and becomes big enough, at some point you're almost forced to enter, right? Like if let's say ride sharing or whatever category was there, and you're a large fund and you don't have a play in it, it's almost like you're not doing your job, right? So the competition from other funds would get VCs to actually enter a space. And similarly with endowments, right? Like if the Yale endowment is actually allocating certain amount to crypto, it puts pressure on the Harvard endowment or other large endowments to also react, right? And I think the similar dynamic actually plays out at the nation state level as well. And especially if US, which is still sort of like the superpower, does something, I think it actually puts a lot of pressure on other countries to have some sort of a response to it and start taking things more seriously. And this is already playing out. We mentioned Bhutan. There are rumors, and again, I'm not going to comment on rumors if they're true or not, that there are certain sovereign wealth funds that are already building Bitcoin positions. And as soon as that becomes real, let's say you're a sovereign wealth fund of Singapore or somewhere else, and you're noticing that these other players who are really your competitors, right? Like the managers of these sovereign wealth funds, they track their capital allocations and returns against the other funds, right? So it puts a ton of pressure on them that, hey, we don't have exposure to this new asset class that's actually growing pretty rapidly. So I think that's the dynamic which Bitcoiners have been talking about for a very, very long time, and it actually might start playing at a global scale.
Yeah, might actually tease up kind of my fun speculation question as well. Who do you think goes next, to your point, about this kind of nation state, FOMO, for lack of a better term?
Yeah, I think
if the U.S. goes ahead.
Yes, so I think there's an old saying, right? Like with any new technology, like it takes longer than you think, and then it happens faster than you think, right? Like if you and then certain world events sometimes trigger stuff as well, right? So a perfect example for that is how COVID triggered everyone to switch to Zoom and Slack, and it almost happened overnight, right? Like everyone was forced to suddenly use it. But for the 10 years before that, slowly, all the building blocks were kind of like coming together. And then finally, a world event happens, and suddenly everyone's now working remotely, right? And the technology was there. Similarly, I don't know what that event is. Is that event US buying Bitcoin reserves or like something else? Like it took like 10 plus years, and then suddenly, the adoption might get triggered very, very fast because everyone is like, oh, we have to do it right now, otherwise we'll be left behind.
Brendan?
Yeah, I don't have much to add. I mean, I think I totally agree. And I think it'll just, people would need to move very fast, and it'll come down to whether it gets politicized or not. And in certain countries where it gets politicized, it may miss out frankly. So it'll be very interesting to see how that all plays out. But we're already seeing it happen.
Yeah, no, it's a very interesting point about the politicization of it. So yeah, kind of switching gears a little bit, just with the increasing number of investment vehicles holding Bitcoin, right? Obviously, we had the ETF approval earlier this year, which seems like it happened years ago at this point, just given all the activity there. But also, people are buying MicroStrategy for similar reasons. What do you think, given that, I know we talked about self-custody earlier, how important do you think that is to the future of Bitcoin? Obviously, with other ways to invest in it, does that seem as important, given the concerns, too, about holding, right? So, Brendan, you want to start?
Yeah, happy to share. So I think the ETFs, ETPs, et cetera, are generally positive. They allow certain institutions or funds to participate in this asset when they can't. Like they just can't custody themselves due to regulatory reasons, et cetera. And then for your average person too, it allows access where maybe otherwise they aren't willing to go through the pain of setting up their own custody. With that being said, self-custody, as a bit of a purist, seems to be the way to go. Should do there's the typical not your coins, obviously, but should do everything you can to self-custody and hold this long term. And I think what's been just to share a couple insights. So I think that's the way to go. There's institutions that are going different routes with Fireblocks, custodians, et cetera. And then people who have Bitcoin have historically used hardware wallets, Ledger, Trezor. But I think what's been interesting with all this utility that's coming out, I do the venture side at Core as well. So we're investing in awesome Bitcoin projects, a lot of which building on Core. I'm seeing a lot of new wallet innovation because a lot of these historical wallets, like self-custody wallets for folks, don't enable a lot of the technology that we want to see happen for Bitcoin. And so there's kind of like Gnosis safe style UI multi-sig built on the Bitcoin multi-sig. There's other options popping up. And I think that's very interesting because a lot of folks see security as a priority and are building around that and making these self-custodial wallets more connected with these new opportunities that are coming to Bitcoin. So I'm super excited about that and definitely see it as the way to go. And I think the incumbents will update once all this utility launches. They're already moving on it, but they have a ton of priorities. So it'll be nice to see them update and have folks continue to use their self-custody services.
Sure. Any thoughts?
Yeah, I think you mentioned the ETF approval. I'll just share some story because I find it amusing. So when the ETF news was coming out, I was at an event in Switzerland in St. Moritz, and some of the OG Bitcoiners were there. And these are the people who have taken the SEC to court and have been fighting this for a very long time. And the news comes out on the SEC Twitter that the ETF is approved. So it's a bittersweet moment. People are like doing cheers and they're happy. And it's like a collective, we will remember this night. And then turns out that it was a rug pull. and the Twitter account was actually hacked. Yeah. And the ETF was actually not approved. And that was like such a downer that we just shared this moment, and it was a rug pull, right? And so the next day, ETF actually gets approved, and then you can't even celebrate anymore, right? Like you just have a bad taste of it from the last night. But anyway, I think the ETF approvals obviously were a huge deal. I think something like $70 billion worth of Bitcoin has been purchased by these institutions. And it does raise questions about self-custody and is Bitcoin becoming more centralized. I think I'm generally in the camp that it's a step in the right direction. It plugs you. This is this incredible instrument that plugs Bitcoin into the traditional financial world, right? Like it's almost like an API. Now people can start building all sorts of like complex financial products against Bitcoin as the asset through the ETF. But I do think it raises concerns about self-custody. There are some old Bitcoin developers I know who are actually pretty demotivated that so much of the Bitcoin is now ending up in centralized custodians, and this is not the future that we wished for. But I think I'm on the other side of this. I think it's actually a good thing. It will force, for example, there's already competition building up for Coinbase. A lot of the ETFs are using Coinbase. but a lot of other custodians are coming up, and there's pressure that they need to decentralize their custodian setups as well, right? So it's going to put pressure on different sides of the industry and really pressure test it. And I think self-custody would remain a thing. I think people realize the importance of it, and of course, Bitcoiners are going to continue to educate others about the importance of self-custody.
Yeah, and to riff on that just a bit, like I agree on the ETP side, and we're seeing innovation even just with ETF CTPs, right? And new products launching like yield-bearing ETPs, yield-bearing ETFs. I think will be coming in. I don't think any right immediately, but coming in the future. So what's interesting is even these large amounts of capital in traditional products are looking for yield on Bitcoin and incorporating it into their product. Like there's already a product staking Bitcoin on Core through Core's consensus, earning yield, passing it on. So imagine you're an ETF ETP holder who gets exposure to the asset and yield. It just shows you the hunger, even in TradFi products, looking to do more with their Bitcoin. So I think it's an exciting development.
Yeah, and you guys recently had your own ETP, I believe, right? Kind of release in Europe, or
yes,
or ETP
yeah,
based around your token.
Yeah,
yeah. So yeah, no, it's fascinating. I think it's, I wonder, do you think, just because you bring up kind of the OG's perspective, do you think it'll be easier to get the OGs to move from the cold wallets to these other solutions that give them more availability, or the retail to kind of get into getting the self-custody piece?
Yeah, I think the way I think about this is that the Bitcoin L1 might evolve like a cold storage. Like, it's like hard to access and it's super secure, and a bulk of the capital is actually there. And I think these L2s or side chains or other types of protocols, they're more like your hot wallet. So whatever amount of Bitcoin you move there, it's for more transactions, for use in economy, or even like, locking it up for yields. And I think the OG crowd would have to become comfortable with the hot wallets, right? Because that's the thing that it's like, you went through 7 years of winter and you still are alive, and that's the precious thing you hold and you don't want to lose it. So I think they'll start with small amounts, and that's my guess. Like most of the people I know, they will start with small amounts, but small percents of a very large capital base is still a very large opportunity, right? Like even if you deploy 1% of BTC into DeFi, that's like $20 billion or something, right? And so I think that's the way we're looking at it, that when we talk to people that, hey, start small, try it out, and slowly, you'll start building confidence. And also these new systems like, stacks or apps built on stacks, they'll get battle tested over time as well. So you don't want to grow too fast anyway, right? Like you want to have a healthy pace and let the security issues iron out as more and more capital is being deployed.
Sure. Brendan, anything to add?
I think there's options for both. Like I think even Naval, lots of Bitcoin, eventually gets to a point where like you're just scared about your personal security. So I think he's publicly said he moved it into a custodian, right? And leaves it there, as opposed to custodying it all himself. I think you're going to see certain folks, funds, that they're going to be kind of pushed to do that for certain reasons. And then I think on the counter side, I really like the way you said that about the cold wallet, hot wallet piece. But I also think like just building on that with the hot wallet, I think they'll use their own custodial wallets as users, because to get to the utility to do things with Bitcoin, and I see this as like one of the key use cases is going to be never selling Bitcoin, collateralizing it, using some other coin as means of payment. I don't know if Bitcoin itself will be the actual payment piece that we thought of a decade ago, but folks will collateralize it with very low LTV loans and use it, and you'll need to execute that on some other chain. Bitcoin just simply can't handle, at this point, the frequency of those transactions. And anyways, the thing there is utility is going to grow. There's tons of builders on Core, all these other ecosystems. To go do that, you're going to need a non-custodial wallet. And I think that's going to push a lot of average people to custody their own Bitcoin, use services that can interact with these apps and utility that's coming out.
Yeah, one thing for self-custody that I'd add is when people say self-custody, I think by default they assume that you are just doing custody yourself.
Yeah.
Whereas Bitcoin is programmable, like you can have very sophisticated setups as well. Like, you know, one of our companies in the ecosystem, like it's like you can have a multi-sig where backups are in different countries and multiple board members plus the CEO needs to sign off before the Bitcoin can actually move. And all of that is possible because Bitcoin is digital, right? And you can actually program these pretty sophisticated setups, which in some ways, if you know what you're doing or you're sophisticated enough as an individual or as a company, it can actually be more secure than a custodian, right? Because you can take the protocols and implement them your own ways in your trusted, you know, setups with backups and stuff. So I think self-custody, I think, is a very fascinating area, and there are companies that are trying to make it easy for, like Casa is one of the companies that is actually innovating in that space. Like it's super secure, but they're trying to simplify the UX for normal users as well, that they're making self-custody easier. And I think those type of, I think a lot more innovation will happen in this area.
Same.
Excellent point. Yeah. So yeah, one of the things you guys mentioned was kind of collateral, and obviously recently it was reported that Cantor Fitzgerald may be working with Tether to kind of onboard and use Bitcoin as collateral. So to me, that kind of brought up an interesting thought. Do you guys think that Bitcoin will be integrated into the traditional financial system more fully or sooner than a new financial system will be built around it?
By faster, you mean like out first? Because I mean, there's options on chain now. There's many options, and we see that as a key use case. But I think it's totally cool to have the institutions, et cetera, that are going to want to collateralize with Cantor. I think that's great. But the overall macro is, I think almost everyone will be doing that long term in every country, or everyone who has access to Bitcoin personally. And ideally, there's options for the average person too that can be done on chain. So I don't know. I mean, they're already available on chain, so I guess it's the on-chain solutions. But yeah, I think you're going to have different systems for different segments of folks with Bitcoin, and certain folks are going to want to deal with Cantor and institutional focus, and then you're going to have a lot of on-chain folks that can collateralize their Bitcoin, go spend it, and have a new financial system money network built on high throughput side chains like Core. So I think that's like one of the biggest use cases. That's like a couple steps down the road. That's where, you know, I think the panel's future of Bitcoin. I think that's one of the places that we're going that we're super excited about.
Yeah, for sure. To that point, you know, what do you think would be kind of, you know, an interesting kind of application of Bitcoin as collateral? Like maybe, you know, some people are talking about real estate or other things. You know, what do you think would be kind of an interesting way to use Bitcoin as that in the future?
Yeah, I mean, on a personal level, I was one of, you know, when they launched the certain Bitcoin markets on Maker, you know, I collateralized Bitcoin many years ago and bought some real estate in where I lived at the time. And it was a bit janky, and there are different trust assumptions, right? But I was comfortable with that. And I think that's just one use case where it's like, there's no way I'm selling Bitcoin. No chance, right? But need capital in the real world. So, you know, I think some of the key use cases are, you know, folks who want to do that. But I think even just using money day to day for transfers is going to be an interesting use case. And they're not going to use Bitcoin to do that. They'll collateralize it and use some form of coin or stable coin to do so. So to me, it's you know, collateralized stable coins or Bitcoin-backed stables. There's a lot of innovation with folks even doing, you know, just collateralizing Bitcoin on the Bitcoin network and then minting stables on side chains where you can actually have high throughput transactions. So I think there's a lot of folks building there, and we'll see which ones win out, but it's like a multi-billion opportunity. And we're seeing, again, on the venture side, I see pitches every week on this.
Sure.
Yeah, I think you had an interesting question about would Bitcoin get integrated in the traditional financial system, or would new economies emerge around it? And I think it's both. I think the new economy would probably emerge faster because it's, you know, it's like startups, right? Like they can move fast, they can build new stuff, And we have already crossed like this threshold point where, we were talking about this before, that people had the misconception that you can't build on Bitcoin. I think that's sort of like done. There are enough projects now, they're funded, have builders coming in, and they will build the new rails, and you'll start seeing Bitcoin deployed everywhere. I mean, already if you think about it, like when Coinbase made the move of CBBTC, like their programmable Bitcoin asset on Base, like we were talking about game theory earlier as well, it just forced other exchanges to do that as well. I think Kraken had to do it, others have stuff in the pipeline. And then because Coinbase is now doing a centralized version of it, that means there's demand for a decentralized version like SBDC on Stacks and others, because people who don't want to use the centralized wrapped Bitcoin would go to the decentralized one. So I think this is the new rails that are being built. But at the same time, Bitcoin is slowly getting integrated into the old financial world as well. One personal sort of like example that I have is I have a friend who was looking for a mortgage and had a bunch of Bitcoin, but there's no way for their dealer to value Bitcoin as part of their application, right? But interestingly, he said that if you move your Bitcoin temporarily into your Coinbase account, because Coinbase is a publicly trading company, we can assign some value to your Bitcoin because your Bitcoin on Coinbase's books is worth more than a Bitcoin in a self-hosted wallet for the traditional world, right? Because they can trust a publicly trading company and a balance sheet coming from a publicly traded company, right? So if you do 2 + 2 over there, I think it's entirely possible that Coinbase or some other large company would be one of the first ones to integrate BTC-backed loans and just enable it because they're already plugged into the traditional side. But the builders can move fast and do it in a decentralized way where you can just deploy capital on chain and do it. But I think the demographics are also very different. Like your grandmother is likely not going to take a loan on chain, at least anytime soon, right? But they might be able to do it if it's just offered as part of like a Chase product, and she has some Bitcoin in a savings account somewhere.
Yeah, no, it's an interesting point. So do you, Brendan, I think to your earlier point, and I think it's right in terms of, people will go to Cantor for, who are looking for that. Do you think those same people will ever come to this, the Bitcoin DeFi space? Do you think there'll be a point where it's robust enough for their purposes?
I think so. Again, I think it'll just depend on how the segments mature, but eventually there'll be enough legitimacy and capital in the decentralized system that hopefully folks will be willing to interact with it. I mean, I think you're seeing the TradFi system kind of implement some Ethereum technology, and some have experimented with stable coins and other types of projects on that blockchain. And I think it just takes time, but you're already seeing those two worlds kind of weave together. So I think it's totally possible in the future as more and more capital flows and there's more legitimacy brought to these Bitcoin scaling layers.
Good point. All right, I know we're coming up on a few minutes left here, so we started with misconceptions. How about we end on what you each think is the most promising thing about the future of Bitcoin, what you're most excited about, whether it be your thing or something else you're seeing in the ecosystem. Munib, you want to start?
Yeah, I think one thing I'll share is that I'm obviously biased because work in Stacks, and SBDC is our programmable Bitcoin asset that's launching next month. But the more I think about this idea of like Bitcoin running on faster rails or Bitcoin becoming more programmable without changing the L1, right? Like we're never going to change the Bitcoin L1. I think this market might actually evolve a little bit like the stablecoin market, because if you think about stablecoins like Tether or USDC, they're really backed by treasuries, and then they issue a programmable asset wherever there's demand, right? So even newer chains that come up, like if there's enough developers, enough demand, Tether would go and issue the asset over there because they have the backing. And if Bitcoin is the pristine sort of like capital base, and you can prove that Bitcoin is locked somewhere, people can issue these programmable Bitcoin assets wherever the demand is, right? The demand might be on Core, on Stacks, on Solana, on Aptos, somewhere else. And I think that's a very interesting sort of like unlocking of BTC capital that just wasn't there before. Bitcoin capital was just sort of like stuck in one place. And with these programmable assets, BTC would just be available everywhere with different trust assumptions. Like CBBTC has very different trust assumptions from, let's say, SBDC on Stacks, right? But I want Bitcoin to be everywhere, be very liquid, fluid, and be available on every chain in a way.
Brendan?
I feel like they're going to music play us off here. Yeah, I think that was very well said. It's like hyper-Bitcoinization. So, Core just hit $1 billion in TVL, and it was like the quietest thing ever. And I think it just shows how much capital is in Bitcoin. So the thing I'm most excited about is that capital flowing on chain. I think it's going to dwarf Ethereum TVL within a couple of years. And I think that opportunity is absolutely massive. So I'm very excited to see folks doing more and unlocking this latent demand for Bitcoin.
All right. Well, with that, thank you all for listening, and we'll bring this to a close. Cheers.
Awesome. Thank you.
Thanks, Steve.
Thank you.
So firstly, I just want to start by thanking you all, both locals and those coming from far and wide, for attending. Today, we're going to be talking about mastering market making, strategies, insights, and innovation in crypto. Today, I am joined by Laurent, Matoush, John, and Elaine. And really, what we're going to do is explore strategies and insights in risk management and innovation in crypto markets. That being said, gentlemen, I want to turn the floor over to you to introduce yourself, and then we'll jump in.
Sure. Thanks for having me, Kelvin. So I'm Laurent Benayoun. I'm the CEO of Asheron Trading. We're a digital asset market maker. We service token issuers, exchanges, and even other market makers. The goal of market making is to improve market efficiency for all market participants, right? So issuers, their community, their investors, and so on and so forth. And the reason we do so is because we want to facilitate the adoption of crypto because we see it as the future of finance. At Asheron, what we do is we put an emphasis on transparency, on compliance, automation, and education. So transparency, we were the first market maker to have a portal with live KPIs for all of our clients. In terms of compliance, we're getting regulated in Singapore with the MAS for major payment institution, and in Europe under MiCA with the AFM in the Netherlands. And then in terms of automation, we have a pretty lean team, but we run only systematic strategies. And then education, we talk with incubators, VCs, universities, and so on and so forth. And that's also the reason why I'm on this panel. So I appreciate the opportunity.
Awesome. John.
Thanks, Kelvin. Hey, everyone. My name is John Pennington. I'm the head of business development at JST Digital. We are a crypto-native trading firm founded in 2018, headquartered out of Singapore. And we focus on a few different things. We do market making on behalf of both token issuers as well as exchanges. We also help crypto holders with balance sheet management. And finally, we deploy our own capital. We view ourselves as ultimately a high-touch boutique. The clients and partners that we work with are truly our partners. We want to be service-first, transparent, and regulatory compliant. And super excited to be chatting with both the Block team as well as the other panelists.
Awesome. Tush?
Thanks, Kelvin. So I'm Matoush. I'm founder and head of trading at Vincent. Vincent is a crypto-native market maker. We are one of the top trading firms on the centralized and decentralized exchanges, and we also do some OTC business and some market making for projects. And yeah, that's pretty much it.
Awesome. Elaine?
Hi, my name is Alan, and I work at GSR. GSR is probably the oldest crypto-native liquidity provider market making in the space, founded 2013. So it's a long while we have been on the market. I think something else that's important to know about GSR is we're very client franchise orientated. I think later in the discussion, we will have a discussion about market making on a prop side or for a client side. And besides making markets, which essentially means to making sure everybody that wants to buy and sell can do that in a very smooth way for the people that didn't know what it is. We're also an active investor in the space.
Nice. And so to start, I actually want to quote a former Federal Reserve chairman. It's an interesting in a book I was reading on market liquidity. And this was on September 24th, 2010, Benjamin Bernanke, in his speech titled "The Implications of the Financial Crisis for Economics," stated that another issue brought to the fore by the crisis is the need to better understand the determinants of liquidity in financial markets. The notion that financial assets can always be sold at prices close to their fundamental values is built into most economic analysis. The reason I think this is prevalent is because one of the things that spun out of the 2008 global financial crisis were cryptocurrencies and Bitcoin. So that being said, has the evolution of crypto markets helped us find solutions to Mr. Bernanke's problems?
I don't know if you guys go first.
Yeah, any order.
So I think that what Bernanke is referring to is CDOs, right? So it's essentially like the repackaging of subprimes, right? So like poorly rated securities into like higher rated securities. And this was done through putting into competition rating agencies, right? And so, like banks were constantly repackaging those products, and they were creating CDOs and CDO squares and so on and so forth, and they were offsetting those positions from their balance sheets to other institutional players and so on. And because they didn't want to hold, those toxic assets on balance sheets. And, this lack of opacity led to the collapse of, the system and its actors, right? And it led to government intervention and, expansionist monetary policy. And in this context, the value proposition of crypto and Bitcoin in particular was essentially to say, like, it will be a currency with no inflation, essentially. And, it's kind of like responding to this problem. And it's also like the value proposition of crypto was to cut the middlemen that are expensive and opaque, right? So in a sense, Bitcoin and probably like DeFi have accomplished this. Like smart contracts are fully transparent. Code is the law. But there's an interesting phenomenon. We're on a panel on market making that I think is worth mentioning. That is kind of like akin to those rating agencies. So there's this rise in prominence of market maker brokers. It's essentially like companies that help issuers match with a market maker in a sense, or select a market maker and then monitor the performance of the market maker. And kind of like under the premise of bringing more transparency to the market, they're putting market makers in competition that sometimes put up proposals with unrealistic KPIs that cannot be met. And there's also like conflict of interest potentially involved. And so I think that it's interesting because on the one hand, you see the underlying philosophy trying to answer the problematics of the financial crisis. But then on the other hand, you see like some centralized parties that emerge still in crypto and that go against kind of like this idea. So I find it pretty interesting, yeah.
Yeah, I guess looking at it from a slightly different perspective, the 2008 crisis, to Bernanke's point, people couldn't take a view on the assets that they wanted to trade. And while this doesn't necessarily relate to liquidity, so to speak, the 24/7, 365 nature of crypto, I always find fascinating that if it's a weekend and there's something geopolitically going on, Bitcoin's swinging wildly, altcoins are swinging wildly, and I don't think it's necessarily people taking a specific view on crypto, but if it's middle of the day, Saturday, London time, that might be the only liquid asset class you can trade. And so I find that aspect of crypto and crypto liquidity as a proxy for global risk markets as a really interesting corollary to Bernanke's point 15 years ago.
I see maybe like three different things regarding crypto liquidity. The first one is the liquidity that you actually see in a specific order book. Like you see an order book and there are some orders there, and how much is there actually. The second view on liquidity is how much money is there in market neutral strategies. There are, for example, buying spot and selling futures or perpetuals. And sometimes there's way more demand than there's in this chunk of money that is doing the market neutral strategies. And what happens is that you get very high funding rates, for example. That's what's happening now. And the third one is that crypto, because of a lot of leverage in the system, it experiences sometimes these shocks, and these shocks can dislocate things temporarily. So those are maybe like the three things regarding like specifically crypto liquidity that I see.
Yeah, let me try to add some additional perspective of everything my colleagues already mentioned. I think the first thing would be like, where's the difference between a fundamental value or the price? I mean, as you mentioned to start out, I mean, the financial crisis was a problem. We had like a lot of, let's say, either illiquid or highly illiquid instruments, CDOs, CDO squares, CLOs, and whatever combination of three letters was out there. And then we talk about the price, which is normally referring to something like a public market price, where you can trade during market hour. So I think everything in the financial crisis was basically like individually underwritten product. So you have less people able to provide the market. I think when we compare that to general crypto, which is excluding NFTs and let's assume no tainted coins, is very fungible. So everybody can come in and move around. So that should be increasing the time. Then something else, if we just look at the crypto market versus the TradFi market, which is closed on the weekend and probably 6 to 8 hours open, just having more trading time or more or less a continuous spectrum you can trade on will just increase price discovery. And the other thing is like, it's very hard for us to start making markets in CDS or CLOs. It's very easy for us all here to start making markets in crypto tokens. So just that it's accessible to much more people should also increase the liquidity. So I would say since then, adding the crypto or the blockchain or token component to the TradFi element would help increase liquidity.
Awesome. And I guess going back into thinking about like pricing versus fundamental value of assets, can you talk about how your firms really think about these things? I guess to start from you, Alan, and then come back down.
Oh, yeah. I mean, I think that everything with the fundamental value in crypto is a bit tricky, just general. I mean, what's something worth, whatever someone pays you for it. Because if you need the dollars or the shekels or the Swiss franc, whatever it is, and you need to sell it and nobody buys it, you have a reality check where the price actually is. How we think about it from a firm perspective, it's much more like inventory management perspective. You accumulate some inventory, then you want to get rid of it, and then you manage the risk around it. But there is not like one weird price point we somehow come up and we're just going to buy if it's below like a crazy monkey, because that probably would make us exit liquidity for a lot of stuff. Now, in the second pillar that we also do, let's say OTC trading, we run a big option book or vol book on the crypto space. I mean, then you can start out with stuff like Black-Scholes. Then we come up with somewhere where it's a fair value around that. But just for the pure market making, it's more like inventory management than being fixated on about the specific price.
Yeah, so I think it matters like what your time horizon is. If you're trying to predict like how much stuff is moving in the next 30 seconds, you probably don't care that much about some fundamental value. You care like what's happening in the market, who's buying, what's the order flow. If you're trying to predict something for 1 year, then maybe you want to try looking at some fundamental metrics. And yes, this is very hard in crypto because like what fundamental metrics should you look at for, I don't know, Doge or peanuts? Like this is just hard. But there can be things like that. But I think it really depends on like what time frame you're looking at.
I mean, if I can add something very brute to look at it, it's like the idea of a forward. I think to have some kind of at least price indication, look how much token are out there, how much will be out there in the future, and then that could be a starting point to come up with like a term structure forward curve.
Yeah, I think Matush made a great point on the time frame is what's very important from a market making perspective. So we market make on dozens of different CeFi and DeFi venues, and one thing that our clients have really appreciated on the venue side has been our ability to make liquid markets in the hot new tokens, which the trend lately have been new meme coins. And for us, where we have gained increasing confidence in our ability to price these assets are having more data points as it relates to other meme tokens. So perhaps that is some sort of kind of theoretical value, but yeah, we're not taking a view of, at least from our market making perspective, on the venture side it's different, but from a market making perspective, we're not trying to assess what is this going to be worth in 6, 9, 12 months. But I think we've done a really good job being able to say, what is this thing going to be worth in the next 100 milliseconds?
I agree with everything that has been said, in particular that derivatives are easier to price probably than spot market assets. So we really specialize in like bringing assets to markets, right, and like primary listings and price discovery. I think the way we treat it is really on a case-by-case basis, right? First of all, it's not clear if like all assets have a fundamental value, right? And it was mentioned meme coins before, but if you look at Bitcoin, for example, you could think like theoretically that Bitcoin had a lower bound, around mining cost, and then maybe an upper bound in terms of like dividing the money supply in the world over 21 million, right? And if you think about it this way, it would probably put Bitcoin around 1 million per coin. And it's interesting to see how fractionable Bitcoin is also, right? If you have 6 zeros, that's 1 million, and then 2 more, that's cents, right? So I'm not saying that's how Satoshi thought about, like the fractionability of Bitcoin, but it's interesting to note. But crypto in general is seen as a risky asset class and as a speculative asset class, and so very often you have exacerbated volatility, especially with liquidations of leverage positions and derivative positions, right? And so you have like massive dislocations, and this goes back to the point of the time horizon. You have massive dislocations from what could be seen as a fundamental value, right? And so you have to be prepared as a market maker and anticipate those change of like environments essentially. And then that was for Bitcoin, but then you can look at other cases, right? Ethereum and its use cases in DeFi, BNB and its use case in centralized trading, for example. So we really approach it from like a case-by-case basis, and we look at comparables and so on and so forth, and there's quite a bit of modeling that's involved, trying to figure out if there is a fundamental value and what it could be, yeah.
Understood. I was not expecting to get into meme coin market making on the panel, but do have some questions there, but I'll save that for later. So kind of segueing a bit into talking about spreads and profitability, like how do you guys think about setting a spread which are profitable on and also trade like often enough on?
Yeah, so that's a very good question. So from a market maker perspective, right, your profits are derived from spread, and essentially it's like the larger the spread, the better, and the more active the market, the more taker flow there is, the more round trips you do, and the more profits, right? Because profits are essentially spread times number of round trips. So, that's in theory, a market maker is looking for like a market that is super active, actively traded, but also that has a very large spread. Now you introduce competition. And from like a game theory perspective, as long as you have two market makers, spreads are driven to 0. Now you introduce trading fees, and spreads now are larger than 0. And then you compete on trading fees, right? So you have market making rebates, but then it can get more complicated than that, right? Like you have strategies that involve like a maker leg and a taker leg, so you have to take this into consideration at times. And then you add adverse selection, right? So now not only you have market makers, but you also have like what we call informed traders, right? Traders that have some kind of alpha. And so you are at risk of adverse selection, so now you need to adjust your spread. And lastly, you look at volatility, and you try to model volatility, and then you set your spread, which determines your order density, which determines liquidity, which determines volatility. And so it's a full circle. So it's a very, very complex question, but it's an interesting one nonetheless, and there are a bunch of models that exist for that, and like the in practice approach is very important, yeah?
Yeah, I think just building on that, not all volume is equivalent, and you want to really ensure that you are capturing as much volume as possible, but the right kind of volume in that non-toxic flow, but also lower volatility volume, so to speak. Taking it a slightly different direction from a client-facing perspective, when we're making markets on behalf of either an issuer or an exchange, we obviously want to provide as tight of markets as we can to, we would never directly influence volume, but hopefully deep and tight markets increase volume for that given token or that given venue. And if we've contracted for specific KPIs, we're going to stick to those. And so from a BD perspective, it's being very thoughtful with our quantitative and trading teams approaching any deal that if we've agreed to market make on a venue, we know we can stick to what we promised, because that's something that you don't always see with market making firms.
Mm-hmm.
I like this example where you start with one market maker and then you add all the competition and the spreads pretty much go to 0. I mean, this question of how wide you should quote, it's sort of the holy grail of market making, so it's kind of hard to explain that in a short panel, but it results from this like fierce competition of multiple firms, and this is what causes like the spreads to be quite tight. And maybe then the second thing that came to mind for me was that you have actually two types of market making. One is where a trading firm is actually trying to make money on the exchange, providing this liquidity, and is actually trying to be profitable. And the second type of market making is where you're providing liquidity for some project, for example, which has some utility from this additional market making. And because people, can transact with lower costs, and in this kind of deal, you don't necessarily need to make money. You can even lose money if you're providing enough value to compensate for that.
Yeah, I think it's helpful to break it down. I mean, there's market making on exchanges. Exchanges will ask multiple market makers, so it will take care of itself. It's going to be competition. I mean, even if you wish to quote like that, if you never get hit and you don't get paid, you're out of business. So competition takes care of it. Then you have like the majors, like the very liquid coins, which have a lot of flow. There you need to find some kind of agreement. You have your risk system, and then you decide based on that how you want to compete. And then the last part is what you mentioned, where you essentially have a new project that comes up, where you as a market maker on the client franchising side are actually often overquoting, which leads that you get picked apart by all the market makers for different reasons. Because compared, if you have an IPO and the stock gets out there, there is some public profile about the company. People heard about it. There were some VC rounds. There is interest in it. There's an IPO book that gets around and it's out there, so you have some flow. But with a lot of the project, you can say it's very early stage VC investments that becomes liquid. They lack all that stuff before. So you put out the liquidity and the token is also some way for them to gain additional traction. And you need, as a market maker, to find some other way and form to make money than just a pure spread.
Cool. And I think you all touched on it throughout your answers to the previous question, but if you could just expound on it a bit more, like what are some theoretical tools that your firms use for understanding complex market structures? I guess we'll go back down the end and come back this way. So, Alon.
Sorry, the question, what tools?
So, yeah, what are some theoretical tools you use for understanding complex market structures?
I mean, the company started in 2013, so there was no tools around there. So I can tell you, like, all the stuff is in-house built over time, where we just analyze it. We're also like around 220, 40 people, dedicated quant teams, and we built most of the tool, actually almost all in-house, just out of necessity. I think if we would start today, we probably would have a different approach. I think there are good providers out there, but in our case, it's like built in-house.
So for our tools, I mean, it depends like where the question is aiming. Like if you want to learn more about these things, I think the best way to do that is to just do an internship or get employed at a market making firm. There's a lot of academic literature, but you have to be very careful with that. The people who really know what's going on work at these like top firms. So maybe one thing, if I had to pick, that you could try to look into the papers that would make sense would be maybe market impact. Like this is pretty well studied. So, you know, if you want to buy 1,000 Bitcoin, like how much are you going to move the market on average? And there's a lot of academic literature about this kind of problem, and it can be sort of reasonable for most markets, the things you can learn there. But for many other problems, like how to set the spread and how to deal with the adverse selection, I don't feel that there is anything really good out there, and you need to learn this stuff at the trading firms.
Yeah, I would piggyback on both those points, and also we're hiring, so if anyone wants to learn those things, hiring globally at the moment. But yeah, I think we try to learn as much from internal as well as external data as we can. It's probably no giant surprise, but like Al mentioned, it's, you know, our firm not quite as old as GSR. We've been around since 2018, and so we've had to build a lot of things ourselves and continuing to refine both our tech stack, but also the quantitative analysis stack is an ongoing process. It's like driving a giant, I don't know, like a cruise ship that you just need to keep on course, but it's very complex throughout the whole process.
Yeah, I agree and disagree with some points that were made earlier. I think that there is like interesting literature to understand market making from a conceptual standpoint. So I can name a few models. I'm not saying that we're using them necessarily internally because they're too simplistic to reflect, you know, the reality of the markets. But they're interesting from a conceptual standpoint, and you can always extend them and you can always build on top of them. So the first one is the role model for the concept of cost, essentially, and, you know, related to spread. There's another model, the Gloucester and Milgram model, and this is about information flow. So essentially, like, you monitor trades and quotes, order arrivals, order cancellations, fills, and so on and so forth, and you essentially separate your population of traders into informed traders and uninformed traders. Then you have an extension of this model for order cancellation, strategic order cancellation, which is very interesting. And then you have the Kyle model, which is essentially like based on order size, and this was mentioned before. How do you conceal yourself among like essentially a plethora of uninformed traders? You have another model about market manipulation by Alan and Gail. You have the Avellaneda-Stoikov model that is very seminal in market making about risk management, inventory risk, and so on. Again, those are like very, very theoretical. Like no one is going to publish research that makes money for sure, or like that makes quite a bit of money. So you have to kind of like build on top of those models, like see them from like more of a conceptual standpoint. It's a vast simplification of reality, and you have a bunch of assumptions, but then you can take it from there and kind of like expand from it, right? And then internally, what we use also is like Monte Carlo simulations for, based on continuous time Markov chains. We use stochastic models based on historical prices of comparables and so on and so forth. So, like there's like the simplistic approach in the literature, and then as was mentioned previously, what really happens behind the scenes that is like somewhat more involved and more hands-on, yeah.
Understood. And I think, Laurent, you touched on risk, and that kind of goes into the next question, is how do you really think about mitigating inventory risk and autocorrelations?
So that's a good question. So in our business, we're not necessarily subject to autocorrelation. I'm speaking for us. I don't know about the other, my colleagues here, but we're not necessarily subject to autocorrelation in that we don't necessarily have like long-term positions that are subject to large drawdowns precisely due to autocorrelation, right? In terms of inventory risk, however, obviously every market maker is subject to it. The idea behind inventory risk is that as a market maker, you're buying an asset that is going down in value, and you're selling an asset that is going up in value, right? And so what you don't want is to be essentially adversely selected by some market participants that may have some more information than you do, right? They have an alpha, they have an edge, or they believe they have one, right? And all of a sudden, you end up with like what we call an inventory skew, right, or an inventory imbalance. And there are quite a number of mechanisms to mitigate this, right? The Avellaneda-Stoikov model is one of them. It's not necessarily great, but it's one of them. We use other tools as well. We have, like hedging mechanisms, arbitrage strategies. You have a more liquid venue, a less liquid venue. So you're a maker on the less liquid venue, you're a taker on the other one. Depending on the contract structure, if it involves options, for example, we can run delta neutral strategies and systematic delta neutral strategies. So that's pretty interesting as well. And then finally, like stop conditions and volatility tolerances and things like this that are more like brute force mechanisms, essentially. So, yeah.
Yeah, I think just building on the hedging aspect, it's really interesting in that in a perfect world, you would probably never have to hedge a trade from an inventory risk perspective, because almost certainly hedging is going to have whether an explicit or implicit cost, whether that's trading fees, crossing spreads. As Laurent mentioned, you might be running a maker hedging strategy, which means getting filled rather than taking liquidity, which is probably cheaper. But I think it goes back to first trying to be in a trade that you wouldn't need to hedge on some sort of time frequency. But then secondly, equally importantly, is how to cost effectively hedge. And so we spend a lot of time thinking through that aspect of the overall strategy and a risk management perspective. And we can talk about a lot of other types of risk management as well, but yeah, I'll leave it there for now.
So I will just maybe add that you cannot avoid if you're running like a maker-only strategy that is not doing taking, like you cannot avoid certain market conditions where you're just destined to lose money. It will just happen because there's some event, for example, there's some news coming out and your algorithm doesn't understand like what's going on, and it will just acquire the wrong position and just lose money, and this is sort of inevitable part of the business. Will you control the damage or the losses by risk limits usually? So you have risk limits on many different things, and you control this type of worst case scenario loss by basically that.
Yeah, I mean, I would say risk limits to start out, because there's an information asymmetry, especially if you work with altcoin projects. There's a lot of shenanigans getting played still, sadly. So you will take some losses there. That's just part of the game. And then on the other side, when you have the option loan model on the market making side, it just helps to migrate a lot because you just can run a delta neutral strategy. Cool. But I think you just need to look at all the market making mandates or venues you have as one kind of portfolio, and then just hope like on average it's going to net out that you have more money at the end of the day than you started with.
Yes.
Yeah, and I think it's an important point that there's a misconception that a market maker is like magically making money on every trade.
Yes.
And yeah, we're hopefully making money on more of the trades than not, and we wouldn't probably any of us be in business if that wasn't the case, but there's no magic money printer sitting behind the scenes. And I think especially in the crypto Twitter world of, oh, these dark scientist market makers, that's not the case. And so it's how to hedge your risk, how to not get blown up, and how to hopefully make money on more of the trades than you don't.
I can give an example where Vincent lost a lot of money. It was when Tesla announced that they bought BTC, and some people figured out from the quarterly report, and just BTC started moving up like crazy. And of course, like algorithms know nothing about the Tesla quarterly report, so we just, on average, made the opposite position against that and lost a bunch of money. So stuff like that can happen.
Well, nobody likes talking about losing money. So on a lighter note, I want to actually go back to the meme coin market making piece that we spoke about. And I guess really, do you believe in fundamental value? How is a meme coin market maker should I thinking about the squirrel to hippo ratio, if you will? Maybe not necessarily about meme coins, but in general, how do you guys think about fundamental value? I mean, it kind of was in the piece we were talking about, different time frames, so on and so forth. Just kind of curious if you could expound on that.
I mean, on the market making side, it's probably easier to look at it from an investment side when we look in. I think there's like the argument you have centralized entities or business cases application that would be superior in a decentralized way. They're more robust. They're use cases that are just better implemented in a smart contract than having some humans running around in a building. So you can come up with the value. But for me, it's like if peanut, or even for Bitcoin itself, I see the stuff you can look, okay, how big is gold? The world in 10 years is going to be more digital than analog. So probably like my kids will want to have Bitcoins or not gold. And if we extrapolate that, it could go to that kind of market. But that's just also a bit like guesstimation, how you end up there. I think on the meme coin side, it's basically a bit, if you look at the concept from René Girard about memetics, I think that there's a lot, if you have like this ability almost to understand what other people like and go in, you can make the money, but you can also have like the other side that just accept a lot of meme games are just huge coordination game. And if you basically have to ask yourself where the fundamental value is, you're probably going to be exit liquidity. So.
Understood. So as we kind of near the end of time to talk, I really just wanted to give you all the floor for just anything you'd like to discuss what your firms are working on. So please, gentlemen.
Yeah, sure. So one thing that I think sets us apart a little bit is, well, aside from transparency and compliance and so on that we've discussed before, is our ability to integrate new essentially trading environments, right? Be they chains or decentralized venues with like all kinds of like different underlying mechanics, right? And also like another thing, as I said, is that we put like a strong emphasis on automation. So one thing that we're looking at right now is like incorporating meta agent into our trading strategies. So just to give you an idea of like how a trading firm works, typically you have like a quant research team, quant dev, and quantitative trading. Research is producing kind of like the design of the strategy. Dev is kind of like implementing it, and then trading is like setting up the scripts and monitoring the scripts and configuring them and so on and so forth. So meta agents really come at the end, right? They sit on top of strategies, and they're able to select which strategy to kind of like pick according to whatever market environment. And on top of this, it can like configure the strategies and so on and so forth. So it's really akin to what a quantitative trader would do, right? So yeah, that's one thing that we try to do on this side. Aside from this, I don't know how many applications AI really has to trading. The truth is, like when you look at machine learning, only the most basic models work, if they even work. Like I'm talking about linear regression, which is I don't know if that's even machine learning, but you look at any kind of like complex model like LSTM or genetic algorithms and so on and so forth. They don't necessarily work in crypto because there's like a lack of sufficient data and there's a lack of clean data as well. And so, yeah, I mean that's one thing that we were trending towards, essentially like catering to different like decentralized exchange mechanics and the rise in prominence of DEXs after the collapse of FTX, and then also like how to incorporate like new tools essentially to improve our trading efficiency on a day-to-day basis. Yeah.
Yeah, I think one thing, a topic that I'm glad we got to mention it, but market making is hard, but we embrace the challenge of market making in this space. And what I mean by that, at JST, we've taken a view that doing the challenging things in crypto is where value is created for everyone. Value is created for our clients, value is created for us as a firm. And, that's manifested in really engaging in some partnerships that I feel like we're at the cutting edge of things. For instance, I took an early view a few years ago that order book dexes were going to be a bigger part of crypto. And as a result, we've now helped double-digit dexes go live with seed liquidity. That's super rewarding because it wasn't the easy thing to do. It wasn't just listing a token, which is not easy in its own right, but it was something that we took a view on where the tech and where the space was going. And for me personally, and I know that my colleagues on the trading and engineering side, we get a lot of fun out of that. And that's where I see us, continuing to hopefully deliver value for our clients, for the space. And then, excited for where things are headed, and hopefully can give you a better answer on the peanut versus hippo ratio later on.
Sorry, Calvin, can you repeat the question? I don't want to answer something else.
No worries. I was just saying, just the floor for you to just talk about what you guys are working on.
Right. Yeah. So Vincent is right now about 110 people. We have like the typical breakdown. You have a tech team which develops, the connectivity to the exchanges. So we receive the data in a fast and correct way. Then you have some networking team which makes sure that you transfer the data quickly between different locations. Then you have a quant team which tries to build the models that you trade. Then you have a trading team which is kind of close to the quants. It's maybe both of those roles are a bit hybrid. So maybe the traders understand the market stuff a bit better. So we'll have a bit better overview like what's currently going on and what currently needs to be done. Yes, and then there will be the other parts of the business, like business development, legal, and so on. But I mean, our product is the market making, so it's basically the tech team. And well, in Vincent, it's very collaborative, very open culture. So everybody knows everything. It's not like silos that are in a lot of the big firms. So I would say that is probably something that I believe makes us special.
Yeah, I'm not going to give you the GSR pitch, but if you reach out to me, happy to do that. I think just for everybody in the audience, you now heard a lot of market making. Not sure if you have more question answered or you have more question to follow up with us. Hopefully second one, but I just want to bring it up there. When you look at the token, having a liquidity provider or market maker is a necessary evil. Please go out there and start having discussion. And the stuff is with market maker, everybody can call themselves market maker, but it's a huge spectrum and quality to get. So have a talk with multiple market makers to get a really good feeling. Even if it's just a necessary evil, it's very important because if you launch and your launch looks very bad, it's going to be very hard to the medium and long term. There is like every investor, everybody you're going to talk to, they will ask you for the ticker and they're going to look at it. And if your launch is like that, it's not going to be helpful for all your ambition you have. Now, we as a firm strongly believe that liquidity is just part of the infrastructure when we are in the blockchain space. What do I mean with that? If I have a Tesla at home and the stock's halves, my car still works perfectly fine, hopefully. But with its token stuff, it's a bit little different. If you cannot access a token, if you cannot access ETH, it's going to be very hard to use that kind of application. So it's actually a different framework. So we understand the liquidity is the base layer. But over time, it will become more and more a utility and a commodity, and it will just be raised to zero. So how can you differentiate? I think there's interesting stuff on the treasury management. We look at a lot of projects. We look at a lot of DAOs. They're holding tens, hundreds of millions in one token. They have zero diversification. If you just would take the bond or the equivalent in the TradFi space, they probably would have like 4 to 6 investment banks helping them to manage that treasury. And treasury management is not just leverage up your own native token, which you already have, you pay your employees in it, but having a proper thing. So we think on the treasury asset management thing, very interesting development. And something else is essentially like we see TradFi coming into our space in both ways. On one side, they use crypto as an underlying in ETP, ETF, in other kind of products. And then on the other side, the mid and back office, they also move it on-chain. What I mean by that, they take money market fund and tokenize it. So I think this new overlapping area, because it's TradFi, highly regulated, time-wise fragmented, is a very interesting pool to look around for opportunities, because I think it's a lot of new stuff. It's a lot of regulatory arbitrage that could come out. So if you're actually able to understand both sides, that's an interesting path we look at.
Photo finish. It looks like that's all the time we have for today. Thank you all for listening in, and I hope you enjoy the rest of Emergence. Thank you all.
Born from a unique collaboration between Paris Blockchain Week and The Block, we're proud to present a groundbreaking event. Please join Nathaniel Elkim in welcoming Start in Block.
5-minute Q&A and then some moderation overhead, so it's 10 minutes per company, I think. Yeah, and then that's nothing.
Hello everybody, thank you so much for being here. You can't imagine how excited I am. What's going to unfold before your eyes is the fruit of months of efforts and collaboration between The Block and Paris Blockchain Week. But before we start, I'd like to tell you a quick story, a story that started 2 years ago in Paris. My name is Nathaniel Elkaim. I'm a VC investor and I work with Paris Blockchain Week on the startup and investor track. And I'm also a big fan of on-chain data. With on-chain science, we dive into what's in it for the founders, essentially. So getting back on this story, 2 years ago, we asked ourselves one question. How can we support Web3 founders? What's the best way? And we came up with a startup competition to select the best founders, but also to give them rewards. So what's the best thing we can offer founders at this time? Well, I'll start with the money. We got a lot of VC to commit and soft commit funding for the participants, but that's not all. There's also a lot of visibility and reach that is offered to the participants. This partnership with The Block is already huge, and you can see this lineup of amazing partners we managed to gather. Soft commitment, mentorship, office hour, a lot of things are on the line for the funders that are going to pitch. So these attracted over 200 startups. And since I told you I love on-chain data, we managed to get a lot of information about them. The first thing is that they're early-stage startups. For 80% of them, they are either raising a pre-seed or a seed round. The most coveted topics, for example, were DeFi, infrastructure, and even AI, which is even more in the narrative right now. We even had every chain, and you can see how the chain breakdown show the good distribution of different ecosystems being represented today. So we could dive even deeper into the data and have granular segmentation with the chain, per stage, per country. If you have interest in this data, please reach out, because I think there's some marvelous initiatives to take from here. But now will be the moment to invite our 6 finalists who made the cut. So the rules are simple and very sharp and the same for everybody. Each founders will have 3 minutes to pitch their projects, 3 minutes to answer questions from the jury, and then 2 minutes with the jury to get their feedback. And then after all 6 funders had the chance to pitch their project, we'll have a little moment where we'll select the 3 winners of this edition. So please, can I have applause for our 3 juries of Start in Block? So Charlie, Lou, and DC Builder, please join me on stage. Thank you. Hi. Welcome in. So to start with, I'd love to know more about you. Would you have the chance to tell me who you are and what's the most exciting thing you're about when it comes to founder speeching? We can start with you, DC.
Sure. So I go by DC Builder on the internet. So I'm a research engineer at the World Foundation. So World is a project that is building the largest digital identity and financial network. We built this thing called the Orb, which is a hardware device to prove that you're a unique person. And I work with applied cryptography, distributed systems engineering. But also in my free time, I do a lot of angel investing. So I've done a lot of deals in different areas, digital identity, cryptography, scalability, privacy, AI, a bunch of other topics. So yeah, that's more of what I do. Yep.
Thanks. So this is Lou, head of Certic Ventures. A lot of you might know Certic for the auditing services, but actually we started investing in this field about years ago, and this year we decided to officialize it as Certic Ventures. For now, we are focusing on 3 different verticals. First one is a more strategic, M&A focused, let's say, investment batch. A second one is to support different layer 1, layer 2's ecosystems to grow their network, to grow their ecosystem. And the third one is a more financial investment focused. So thanks you for you guys.
Yeah, hey guys, I'm Charlie Sander. I'm an investment partner at CMT Digital. We're an early stage venture fund that has backed probably close to 150 companies in the blockchain space since 2018. We focus primarily kind of on pre-seed and seed startups. And by far the best part of the job is talking with just really talented founders who are super passionate about what they're building and watching them go accomplish it.
Thank you so much. Well, now that you have amazing juries on stage, I think it's the time to introduce the first founder, hear their pitch, and we'll listen to your feedbacks. So I'd like to welcome on stage Hivelo, the founder of Hivelo. Sorry, Dominic, you're invited to join us right now.
Good luck. Thank you. G'day, everyone. My name's Dominic Carosa. G'day, judges. My name's Dom Carosa. As you can maybe tell, I'm from Australia. Before I talk about Hivelo, I just wanted to talk about DeepIn and where DeepIn originated. For those that are not aware, DeepIn as a concept is a segment of Web3, and it's a couple of years old. But it actually originated about 40 years ago with NASA. And so NASA was basically generating a whole bunch of content from their satellites, and they just didn't have the computing power in terms of processing all of this. And so they set up this division called SETI to try and investigate how to solve this problem. And so fast forward, I remember being a teenager and downloading SETI on my computer. Every day there would basically be a download. I would process that data and then send it back to SETI/NASA. And back then, without the advent of the blockchain, it was basically, the reward was if I found a star or a planet, it would be named after me. You know, and that's the concept, and that's the first concept of distributed computing, decentralized computing. And I just wanted to kind of set the scene. In terms of Hivelo, my view is it's always starting with the team, and we've put together a team that's been there and done that before in both Web 2 and Web 3. The last company that we co-founded was a company called Banksa. Banksa is one of the leading fiat on and off ramps in the space, second behind MoonPay. And then we stepped aside about a year and a half ago to focus on Hivelo because we just saw there was a really big opportunity. And so our vision is really about trying to bring DeepIn to the mass market. And what we know about DeepIn is there are hundreds and soon thousands of DeepIns. Some of them range from point and click to most of them require Docker, and some of them like Akash requiring Kubernetes. And other platforms. And then there's a requirement for staking as well, where you need to own that token. And our view is, you know, there's a time to learn and earn, and there's got to be a better way. And so we've created Hivelo, which is basically an aggregation orchestration platform that allows customers to run multiple DeepIns at the same time. and then allowing them to get paid out in the native DPIN tokens, stable coin or cash. And then as we generate more first-party data, data that's not on-chain but is proprietary, we're going to be able to optimize. So every person's machine will basically have different DPINs according to their computer and their location. And what we've built, we've been live for about 3 weeks. It's literally download, install, plug in your wallet details and start earning within minutes. And so really, in conclusion, I'd love to follow us on Twitter, and happy to take any further questions.
Perfect, right on time. So would you like to start, Lou, with a question?
Yeah, I may have a first one. Actually, you're talking about aggregating a lot of DPIN-related protocols, but we know that there are a lot right now on the market, but at the same time, their token or their utility are also questioned. So how would you tackle this problematic?
So first of all, I think your question was around the thematic of DPIN. In my view, I'm a believer of DPIN. If you go back to the internet in the 90s, everything was decentralized. When I built a website, I would host it on my machine at home or at the office. So it's still very early days. I think there are certain verticals in DPIN that I see tremendous opportunity, and that's in the GPU space, purely because there's a lot of AI companies out there that need GPU hashes in order to train their models, and doing it in a decentralized way is materially cheaper. And when I say materially, it's about 80% cheaper than doing it in the decentralized way. So my personal view is I think there's big opportunities in DPIN. Like any new market, whether it's the internet or blockchain, there's going to be thousands of competitors, and then over time there will be a consolidation. But ultimately, I think as one of our shareholders said, if DPIN wins, then very high probability that Havelo is going to win at the same time, because we're not trying to pick what the individual winners are. We'll ultimately let the data determine what are the best DPINs to run on your machine versus, say, my machine. And that's kind of part of our building our moat with first-party data.
Thank you.
Can I ask one? So I'm wondering, usually when you have a centralized versus decentralized paradigm where you can choose, like as a user or service provider, like which infrastructure should I run my tasks on, what sort of areas have you seen like adoption within DPIN? Like what is a specific business case where people prefer using the decentralized case because the offerings you have are better compared to their centralized counterparts?
Yeah, I think first of all is just ease of use. And just to give you, I guess, an example, we're targeting this not only at the crypto market, but at the Web 2.0 audience. And I think as someone was saying on the panel earlier today, we're like, the number of crypto users is like 1997 in terms of internet. So we know there's this huge wave about to come, and most of those users are Web 2 users. And we've built this with the view of, can we allow a Web 2 user to basically use our product without having to know about private keys, gas, staking the native tokens of the DPIN that they're trying to run. And so we just take all of that complexity away from the user, which basically makes it streamlined. So if you're a Web3 user, you'd use it because it's faster and easier and much more effective because it saves time. And if you're a Web 2 user, we basically automate that entire process and then give you an option to get paid out in cash, stable coin, or the native DPIN tokens.
I think it's right on time for those questions. Thank you so much, Dominic.
Thank you for your time. Thanks for your time, everyone. Thank you.
Thank you. Yeah, that deserves some great applause. So now I'd like to hear your feedback. Since you couldn't ask a question, I'd like to start with you, Charlie. What did you think of?
Yeah, the question I was going to ask, I think the biggest challenge they're going to have there is user acquisition. Because if you look, well, my understanding is they only work with decentralized compute providers, so Akash, Kudos, IO, and so forth. If you look at all of them, they all have wait lists. So it's like kind of a chicken and egg problem in the current state, right, where there's not driving enough demand where anyone can freely tap into them. And then the second one is they're targeting, basically their product, right, is targeting primarily kind of net new users to decentralized compute. So it's how do they acquire those users?
Thanks. Thank you very much. Anybody else want to react?
Yeah, I would actually pretty much align with Charlie, because if you want to onboard Web 2 users to Web 3, deepening product, but at the same time, they will be also tackling issues with, fiat on off ramp. They would be also introducing tokens to those people. How would this be smooth enough for people to really use their product for Web3 products? Yeah. I think that would be a problem. Yeah.
That's very valuable feedback, I believe. What about you, DC?
For me, I've seen a lot of these or similar projects. The thing that I'm mostly skeptical of is one is like user acquisition, but two, on the technical level, like when you're someone making a business decision for using a specific infrastructure, you care about other things than just having access to the centralized compute. You care about liveness, right? So you need to have an incentive mechanism for people, or like penalization mechanism for participants to, like, if they're not providing the services that they agree to provide, and that causes me a failure in some of my use cases or my needs. There's like a lot of problems around verifiability, liveness, just economics of it. Like you need to do a lot of like auction design, mechanism design, so that these things are sustainable economically. And these are sort of some of the things that I would like to see more of discussed. Yeah.
Amazing. So I think now it's time to welcome our second funder. Please, some applause for Jacob from Lemonade. Welcome in. There you go. Yeah, just push here. You can place it here.
Hi, everyone. What if I would tell you that the future of Web3 is not only how we connect with each other and how we control our digital lives, but it's, the future of how we actually interact with each other. And I'm one of the co-founders of Lemonade. I'm Jacob, and it's a pleasure to be here today. Lemonade is a community-owned events platform with on-chain ticketing, community rewards, and data ownership. In really simple words, it's the consumer application Web3 needs right now. Our product is already live, so you can either go to the iOS or Android App Store and download our apps, or to our website and interact with it. You can set up your own Lemonade stand and can start building, engaging, and monetizing community in a super seamless way. We have on-chain and off-chain ticketing, our apps, and POS system. These are just some of the results in 2024. This is like the nice hockey stick curve, which everyone wants. So we're really excited, especially also now for the next results in December, and ready to scale in 2025. One of the numbers or KPIs is that we almost hit 1.5 million in on-chain ticketing sales over the last 12 months, and 45% out of these ticketing sales have been on-chain. So far, we've spent zero money on marketing, so our product was always 100% of the focus, and the better the product is, the better the marketing. These are just some of our partners we have been working with so far. So we have worked with Bacardi and Budweiser in the Web2 world. We're working super closely with the entire Cello ecosystem, super closely with the entire Zuzalo community. They're hosting the pop-up city and long-form events on our infrastructure. And then, Mega Eve, XLR, Chainlink, and so on. This is our master plan, how we're going to hit billions in revenue. So we already completed phase 1 and phase 2. Phase 1 is building the entire infrastructure on a product, platform, and product level to abstract all the complexity of Web3. And now we're ready for phase 3, launching a Kickstarter model so event organizers can already create and generate revenue to pay off vendors and venues. And also a staking feature which will go live next week. Just jumping to the last slide very quickly. We're opening a bridge round right now, and the last sentence, let's make lemonade together.
Thank you so much. So people from the jury who would like to kick this off with a first question.
Yeah, I can kick off here. I've spent a good amount of time looking at on-chain ticketing platforms, and I think all of them kind of have the same difficulty as how do you expand the market beyond just like Web3 events, right? And how do you, it's a super fragmented market outside of like StubHub on the event side, whether it's Partyful, and it's very geographic too with Luma and Eventbrite and so forth. So how do you think about kind of breaking out and expanding beyond like the current market?
Creating what?
How do you acquire users outside of like the Web3 market?
Yeah, our go-to-market strategy right now is we're collaborating with a lot of different blockchains and protocol and getting credibility in the market. So our first go-to-market or focus is in 2025 to onboard the entire Web3 crypto space. But then outside of that, like our goal is to compete with any other ticketing platform because to be very honest, even crypto or Web3 is still so small. So even if you take all the conferences and side events, the market share would be way too small. But you need to have certain focus. And since we are already like really well connected and credible in the space, so our go-to-market strategy is to collaborate with these existing partners and to scale from there.
So would you consider your best value proposition is your network rather than your product itself?
No. The value proposition definitely is the product. So we have been building over the last 2 years. It was really important for us to set out the right infrastructure. So now we are actually ready to scale. So also our protocol is ready. So if someone even has like their own front-end developer, they can actually build even a competitor of Lemonade and use our infrastructure and can build their own ticketing or events platform or community platform on top of our protocol. So the product is always king at Lemonade.
I see. So since you're trying to expand eventually, like after you seize the market within the crypto space in 2025 and so on, what are some advantages over existing sort of tooling platforms that the people outside of Web3 for your bigger total addressable market goals would benefit from within Lemonade?
Yeah, for us, we have always built Lemonade with the intent of a Web2 platform. So anyone, like that's why we have used or worked together with Budweiser and Bacardi, because the end user experience is super seamless. So most of the users actually don't even know that they just interacted with a Web3 platform. So data ownership is a really important point. Super seamless user experience, because in the end, why would you use another ticketing platform? Because there are existing platforms obviously out there. And then, having the best user experience in the market. That's why we have been building so closely with the existing communities and based on their feedback have improved Lemonade to what it is right now.
Perfect. Thank you so much, Jacob. There you go. You can keep this one. Some applause. So who would like to start with some feedbacks for Lemonade?
I can try. Thank you. Yeah. I would actually love to learn more about the differences, the different features that they are proposing to their users and merchants and vendors than other ticketing services, because he's talking about protocols that they're building and open sourcing for community usage, but. Probably we wouldn't have enough time for him to expand that in detail,
I see.
Yeah, I've attended hundreds of events over the last 3 years, and I've used virtually every single platform, like from Luma to Eventbrite, Lemonade including. I used it last month in Bangkok for a few events. I'm wondering if the fact that you're building things in open infrastructure might make the differentiator factor big enough for you to use it, because everyone can sort of build their own integrations for Web2, Web3 tooling including. So maybe if that is the good go-to-market, that'll be interesting to see. But I think it's like too early, and I have not seen that much in detail. So it's still hard to judge whether that's going to be the case or not.
Yeah, I think the biggest challenge with any of these platforms is, well, one, I think they're approaching it the right way. Product does really matter. It has to be on par with any like non-Web3 ticketing platform feature-wise. But even then, even like the long tail of ticketing platforms, they all battle for a very fragmented market, whether it's small venues or individuals. Like I think the most viral one in the US is Partyful, but that's just like on a very like personal, it's easy, it's all mobile. But what Partyful hasn't done is they haven't tried monetizing it. So like I think they're gonna really struggle even then. Like they have the user base, now they gotta figure out how to monetize it. And so I think that'll be the biggest challenge, is really reaching like critical scale.
Thank you so much. That would be very valuable feedback we'll have the chance to expand on for the last stage. So now, I think it's time to welcome our third contender. Please, some noise for Andre from LTV Protocol.
Hi, let me introduce LTV protocol to you. So, imagine, well, does it work?
It's the green button?
Yeah, and does it work?
The big green button on top. Yeah, this one.
Ah, okay.
Right, no worries.
Okay, so imagine there is a protocol where anyone can deploy a leverage vault on top of any pair of assets, on top of any leverage source. Sounds like a magic? Yeah. What is leverage vault? Leverage vault, it's collective tokenized position on some lending protocols, and it usually need a curator. But we invent the protocols that can make it totally curatorless, totally permissionless, without curator. So how it works? Look at this equation. In Uniswap, they have constant product formula. In our case, we have our constant target LTV formula. Yeah, and it's working the way that when user interact with our vault, we open the auction with the incentives, and the vault automatically rebalance itself without any interaction from the curator. So yeah, this is a pure permissionless protocol, and we describe full mass here in our paper. This is 50 pages of mass, so you can download it, you can read it, you can check it, you can verify it, you can formally verify it. By the way, if someone wants to formally verify our paper, just message me. Yeah, and why we are the team who can make it real? First of all, me personally, I'm ex-Metro Labs. Our head of research, Yuri, he expert in high energy physics. He have New York University PhD. All of our engineers are all mass Olympic winners. My co-founder, Ilya, one of the youngest Ubisoft software developer. So yeah, what will happen when we deploy our protocol to the mainnet? It will lead to the huge transformative token wave of permissionless leverage token. Because right now it will be totally permissionless, it will be totally scalable. We simplify UX for the leverage, because for opening leverage position, we just go to the DEX and buy a token. And we optimize the market, because leverage vaults is one of the best way for interest rate arbitrage. And you can bridge this token to the different chain and make cross-chain interest rate arbitrage. And you can cancel the limits for the max LTV, because leverage token can be built on top of any other leverage token. And you can use this new DeFi primitive on your protocol, and it will lead to the transformative Uniswap-like impact into the DeFi ecosystem. Thank you very much for your attention.
Thank you so much, Andre. I think that deserves some applause from the audience. Thank you so much. So now we'll move to typical Q&A. You know the drill.
So on my end, I've seen a few like leverage protocols or perps, derivatives. I would wonder like how do you compare against protocols like Gearbox and others, and when it comes to the construction of the financial primitive that you made?
Yeah, our protocol, if you compare to the different protocols, our protocol, it's totally permissionless. That means that anyone can deploy it. That means that, first of all, it's more optimal in the way, because right now, you need to, when you create a new leverage vault, you need to hire a curator, and you have additional risks, because it's permissioned that something went wrong, but here it's worked purely on the smart contracts. So it's much better, because you just set the target LTV, you deploy the pair of tokens, and it will work perfectly with the long tail assets, because you don't need to hire a curator for this. So it will be so simple as just open a new pair with this 2 token on the Uniswap.
How do you think about bootstrapping initial liquidity on the protocol?
Yeah, it's trivial things. First of all, because it's permissionless protocol, we will have a DAO, and you just DAO needs a governance token, and you just incentivize first adopter of this protocol by making liquidity mining, and that's how you can make first liquidity. And of course, there is we have partnership with all biggest LSTs like Rocket Pool, like Lido, and we will start collective promotion company. Yeah.
I think my question is also linked because in order to become a Uniswap-like impact, you will have to engage with a very large DeFi community. So I wonder, so how do you plan to onboard them as the first user? Because you want to incentivize the first user, but how do they come? And I don't know which stage of development you are right now.
Yeah, okay. About incentivization, of course, if you're just propose good API with the vault and you give additional token incentives, I think it will work. But related to the stage, right now we finish the paper, we write the proof of concept. The next step will be testnet. After that will be audit, security audits. After that will be mainnet. And after that we open it to the mainnet. Permissionally, we will deploy it on every EVM chain. Yeah.
Okay. Thank you so much, Andrei. Please, some applause for LTV protocol.
Thank you very much.
Thank you. So now I'll turn again to our jury members to let us know what you guys think of LTV protocol.
Yeah, to the liquidity point, I think in the current state, the DeFi protocols are so fragmented where liquidity is fragmented, and just doing kind of like a simple governance liquidity mining isn't usually sufficient to bootstrap liquidity. And yeah, so I think that's going to be quite a challenge.
Mm-hmm. Yeah, also if you want to incentivize the liquidity with your native token, when the native token is just launched and there's no adoption of the protocol on its own, it's like hard to speculate on the network effects of it.
Yeah.
Like usually the reason why governance tokens have a value is because they already have the network effects to support them. So it's like a game with a cat and the mouse. So like you need to solve part of the equation in order to even have that incentive be worth anything to build on top of you.
Yeah. I think the fact that they're having partnership would help a little bit, but it doesn't really engage a community that really will contribute and use the protocol. And it depends also on the feedbacks of the community, whether the protocol is really useful or not. So yeah, I think.
Amazing. Anybody want to add a quick word before we welcome our fourth contender, or should we welcome in?
I think that for LTV, like they're taking a similar approach that current DeFi protocols are taking, where it's not curated, like he mentioned. There's no curators. It's just anyone can deploy any market for any token, any asset. So we've seen things like Morpho in this space as well on the lending front and on different areas within DeFi. So I feel like it's a nice design, but the go-to-market for these is quite hard to pull off. So even though if the protocol is good, it still needs to actually sell that fact to the rest of the market first. So I think like there's potential there for sure. Yeah.
Mm-hmm. Thank you so much. So I think we've just completed our first half of Thunder. So in a second from now, I'd like to welcome on stage Sofiane from Newcoin. Please, some applause.
Hey, Prague. Hi, everyone. Who here wants to see AI owned by 3 companies? 5 companies? OK, I know, right? We don't want that. Hi, I'm Sofiane from Newcoin, and I'm excited to introduce Newcoin. It's a peer-to-peer AI protocol, an AI system. So let me start by introducing Bob. Bob is a top contributor for Reddit and Stack Overflow. And when Microsoft and Google purchased $500 million worth of license, he got 0 out of that. Then meet Alice. She's a top contributor in AI. She's a researcher from MIT. She wrote papers that are used by tech giants. She's contributed amazing libraries to Hugging Face. And like Bob, she's not getting rewarded. And then meet Adam, who's a customer like us. He has a paid subscription to an AI service, and he's always a little bit dissatisfied by the outputs. What if I told you all those problems had one solution? Let me introduce NewCoin. NewCoin is a peer-to-peer AI system. Similar to how miners will get validated on Bitcoin by submitting blocks of transactions and validating each other. On NewCoin, agents validate blocks of intelligence. So the way it works is each agent has a stake pool. You can stake and validate. And the goal is to get as many validations as possible to collect the rewards. So they are competing and collaborating at the same time. That validation is not just for the rewards. It's also used for orchestration, so we can route the tasks to the best agents. And it's also used for reinforcement learning as a feedback signal. It's not just an idea. We have already launched, soft launch. We don't have a token, but we have about 1 terabyte of data. We did some benchmark on generative image. We have 49% higher satisfaction rate compared to leading models. We have 44,000 knowledge producers, knowledge miners, and 18,000 agents. Our team is made of lead developers from major crypto protocols and talent from DeepMind, Berkeley, and Google Research. And our roadmap, we are launching new OS in January, where you can install a client on your Mac and run a lot of open source libraries following the protocol and then the token. So now let me end with one question. Do you think that the AI race will be won by one company or by a network of agents? Join us build a future where AI is owned by you, by you, by you, by you, by all of us. Thank you.
Thank you so much, Sofiane. So you know the drill. Now we'll go for the questions for all the jury members.
So you're building an agent network then? Or can you elaborate a bit more on the protocol or the OS that you're releasing?
Yes, sure. So the idea is that every agent has a DID. And when you have a DID, you are being prompted either by another agent or by a human. And then you will try to provide maximum satisfaction. So in the same way as RLHF or DPU or reinforcement learning, you are trying to optimize for the higher feedback signal. And you do that through a protocol where both the input, the output, and the feedback remain as a cryptographically signed signal that can be accessed by the open ecosystem. So every player in the system is a black box. We don't try to touch like at the model level, but we look at patterns in how those evaluations compound towards the best players in the system.
I see.
Yeah, sorry, I wanted to learn more about your token utility, other than because you mentioned staking as one of these.
Yes. So when you stake, the goal is to try to bet on the best agents. And so you will say, I believe this one is going to have a high success. You pay a fee when you stake. That fee compounds to a reward pool. And then the agents, based on their score, will receive a share of that reward pool. So the goal, they are all competing for a share of the reward pool. And it's not a token model based on inflation. It's more based on every customer or every validator is going to throw their money into the reward pool, kind of like Spotify. And instead of being rewarded based on your streams, you get rewarded based on the score that you get out of all those interactions with all the agents in the system. So you cannot game the system by just creating like two agents that like each other, because you throw your money into the reward pool, it's lost, and to regain it back, you have to really deliver value to the network.
Okay, and then how do you think about monetization and generating protocol revenue?
Sorry?
How do you think about like what's going to drive the protocol revenue?
So what's going to drive the demand for the protocol? We have a consumer product where we already have people who are using it every day. We haven't started to charge. We are going to do on-ramp onboarding from January, where you will be able to pay $20 a month, and those $20 are going to go to the reward pool. We'll start by paying validators and miners with USDC until the token is launched.
Thank you so much. Any subsidiary questions for the jury members for the last 15 seconds, that might be short, or?
I'm good.
Very good. Perfect.
Thank
you so much,
Thank you
Sofiane.
so much. Have a great day.
Thank you. So just give me the clicker. Thank you so much. Perfect. So for all 5th contenders, I'd love to hear your thoughts. Who would like to start with?
So I've invested in several like crypto XAI startups. There's a few building at different levels of the stack, be that like decentralized training, inference. The thing that things are starting to become interesting is around like agents. Agents starting to become more and more able to do interesting things. Like for coding agents, they can program like a website. They can start doing more interesting things. And now that you can give these agents access to interesting APIs, even within the crypto domain, right? You can give them access to a crypto wallet, and that wallet can interact with DeFi, it can interact with NFTs, and can interact with any smart contract, or even build their own and go from there. I think the good thing that crypto has is value alignment with cryptographic incentives or crypto economic incentives, where if you design incentives right, and there's a market for competition where sophisticated players can deploy interesting things, there's going to be probably like a good avenue for this. So it's directionally going in the right direction. It's just going to be interesting to see that materialize in some real tangible way. But usually you don't know these things ahead of time, so it's good to just release something and then iterate from what the market tells you. So I think that this is sort of like what I think about Newcoin.
I think the fact that they are issuing a token brings me the question that beside from just staking, what's really the utility of the token? If it's just that, I guess that's enough for the beginning, but I would want to learn like how actually this would be linked with the token's price, and why should people be trading those tokens beside from also staking them and really engaging with the protocol. Yeah.
Thank you so much. So we only have 2 contenders left. So I'd like to welcome on stage Chris from OneSafe. Please, some applause.
Hello everyone, I'm Chris and I'm the founder of OneSafe, a crypto-friendly bank for companies globally. Now, if you're a founder, then you probably know that it's really hard to open up a bank account for your crypto company. You even mentioned crypto, and good luck passing KYB. And even if you do happen to get a bank account open, well, that's just the start of your operational headache. Maybe you're going to have to get an exchange now, move money from your bank to your exchange, and your exchange to your bank. Maybe you have to off-ramp a grant that you got from an L2, bridge it over to your multi-sig, get that into a bank account, and do crypto payroll in 3 different currencies because you have a distributed team. And just generally, I get PTSD just talking about it. OneSafe merges everything into one platform, streamlining your financial operations. And sure, it's nice that you have the ability to send euros and receive US dollar SWIFT. There's a built-in exchange, and you can on-ramp and off-ramp seamlessly, make crypto invoices, make crypto payments, and that were available globally in over 169 countries. It's also nice that we have over 600 companies that have onboarded in the last 9 months, moving over $30 million per month. But what's really exciting about OneSafe is actually the use cases that we enable. Of course, you have the vanilla use cases where you have DAOs such as Polkadot, Blockchain Academy, YGG, or Celo, off-ramping treasury to make vendor payments. Or you have the more interesting real-world asset use case where you have somebody like Mansa who sources liquidity from from DeFi protocols, off-ramps that into US dollars, deploys it to get returns, and then takes those returns to on-ramp and pay back their loans. But the most exciting is actually when you get a completely non-crypto company like DTC Pages, which is actually a Shopify agency, Shopify consulting agency based in Argentina that uses us to receive global payments and then on-ramp that into stablecoins to run business operations and payroll so that they can protect themselves from a very unstable Argentinian peso. And let me just emphasize the fact that this is a traditional Web 2 company showcasing the mainstream adoption that we've always dreamed about today on OneSafe. Because what's exciting about OneSafe isn't the fact that it's only for Web3 natives, but it's because we're able to support real-world businesses, traditional businesses facing real-world problems. Because in the not too distant future, you can imagine a world where every company will want to be able to make and receive payments in crypto and in fiat because of the opportunity and benefit this provides. And OneSafe will not only be the catalyst, but also the platform for all of these transactions to happen in the future. Thank you.
Thank you so much, Chris. Now we're going to follow on with the questions from all the jury members.
Yeah, how do you guys handle like the fiat payouts and on the banking side?
We have a collection of 4 or 5 different banking partners, and so you actually get your own bank account, and you can send wires, ACH, SWIFTs through our banking partners.
What happens if you get debanked?
We actually, funny, we've been debanked 3 or 4 times. We actually have a suite of 5 banking partners now, so we have redundancy around that. It helps that we figured it all out during the crypto winter when it was really tough.
Got it.
So how do you deal with KYC and compliance? Is there any issue on that?
Yeah, that's a great question. So what we do is we have a suite of banking partners, and they handle the compliance. We ourselves are not like a bank, we're a neobank. And so as long as the banking partner can onboard you and can support your use case, then you can start using all of the rails that they provide. And so in that way, let's say one of our banking partners won't onboard you because you're a Cayman Island foundation, we can actually route you to another banking partner.
Okay.
Yeah. So within when you're banking and off banking, so do you have an on-chain component as well to this, or?
So we used to have this whole self-custodial multi-sig account abstracted with Open Zeppelin, Relayer. We found nobody really used it, and everybody was actually more interested in the Web 2, Web 2.2 piece. So we actually have a Fireblocks wallet. It's custodial through our qualified custodian that you can receive and send crypto from. It's connected to an exchange that's then connected to your bank accounts so that you have all those rails. But I would imagine in the future, I don't know, year, 2 years or so, we will start moving more towards Web3, where we can start doing more non-custodial transactions.
Right. So you're trying to aggregate across multiple providers on the Web2 front, and then use Web3 wherever it makes sense on the. Yeah,
exactly. We just want to make sure operations is super seamless for a crypto company. They don't have to worry about any of this. If SVB goes bankrupt, they're not going to have to scramble to find another bank account.
Okay.
So in terms of the platform revenue, what does it come from?
So revenue comes from a variety of different things. We actually have a MasterCard that you can top up in US dollars and in crypto. We make about 1% interchange on that. We also have exchanges. So when you're off-ramping and on-ramping, we also take about 0.1% on that. And I think cards-wise, and we're also launching Yield quite soon, and we'll be earning revenue through that.
Okay, thank you.
Awesome, thank you.
No more questions for founders?
All right, thank you very much.
Thank you.
Thank you so much, Chris.
Bitcoin at 100,000.
Thank you.
So after those questions for Chris from OneSafe, I'd love to hear your thoughts about this crypto bank.
Yeah, I think it's a pretty compelling company. I think people kind of sometimes forget that you can't just exist on-chain in entirety. And if you have a business that crosses over, it's quite a pain point dealing with kind of the Web 2 finance side. So there's a huge need in the space for kind of an in-between company that bridges both the on-chain and off-chain aspects, especially when it comes to payroll, accounting, doing hard wires from stable coins to fiat. So they're solving a real need in the space.
I think in terms of their business stream is pretty straightforward. It's a little bit like an exchange also, and the way that they're operating, I guess it's really, as Charlie mentioned, it fills the empty space right now. I wonder how they would be moving from Web 2 users to Web 3 users later on, actually.
Yeah, me personally, I'm not someone who spends that much time in this specific domain, but something that I've seen personally just by trying to use our infrastructure is that there's a direct need for all these tools. Like Charlie mentioned, is like there's this risk, like regulatory risk of getting debanked in the first place. So I'm wondering like if that redundancy is enough, or like what level of redundancy is good enough so that you're actually able to sustain things. The good thing here is that even if they debank you, they're only debanking the on-ramp and off-ramping part, but the custodian is still like, okay, like you still have USDC or USDT or whatever stablecoin you use, but even that might also be problematic when you have blacklists. So there's a lot of things to consider on this front as well. Yeah.
Thank you so much. Well, last but not least, I'd like to welcome on stage the founder of PWN DAO, Joseph.
Good afternoon, Emergence. My name is Joseph, and I'm in this room because I share the same conviction as you, that crypto is changing the financial ecosystem as we know it today. Let me start with a story. In 2019, I applied for a mortgage. I got rejected multiple times because of my affiliation with crypto industry. My options were either I sell my ETH at 150 bucks and lose my exposure forever, or I leverage DeFi and borrow, but overexpose myself to a liquidation. My third option was to get my hands dirty and build a product for people who don't want to risk it all, but also don't want to let a bank to decide which financial tool they can use. And this is how Pawn started. What is Pawn? Pawn is the most universal fixed-rate lending protocol for the tokenized economy. It lets you execute fully customizable peer-to-peer Lombard loans against any token. It doesn't require pools. Pawn is very capital efficient without actually creating a lending pool. Instead, it leverages existing lending pools such as Aave or Morpho and lets their supply to come to Pawn and subscribe to complex lending strategies with higher upside. Once a borrower shows up to Pawn, they can execute a loan based on these strategies, effectively locking in the higher yield with no opportunity cost for the lender. On the other hand, the borrower gets the benefit of fixed rate, clear repayment schedules, and clear original funds for their bookkeeping. Because Pawn is built different, we can leverage the assets that are complex, the assets that are hard to liquidate, such as liquid staking derivatives, RWAs, or even LP tokens. Actually, right now, you can go to Pawn and you can get 12% on wrap ETH on a loan against LP tokens. But this is just the start. Deloitte estimates that Lombard lending is actually the fastest growing lending product in TradFi, with over $4 trillion locked in things like stocks and bonds. Our bet is that all of these assets will eventually end up on-chain, and Pawn will be ready to service them. But Pawn is a true protocol, not just a product, and allows to create and bootstrap novel products such as under-collateralized loans, or even long-lasting tools such as DeFi mortgages. When I say we are a collective of 15 crypto natives, supported by an awesome group of advisors and the most amazing angel board of over 40 angels, including people like Vitalik, the founder of Ledger, Aragon, Gnosis, or even the creator of the DAO. We're currently raising $2 million before Pawn DAO goes to public. We have a live product on more than 8 chains right now. We have over 2,000 users who tested the protocol. We're long-term committed, and if you are convinced in the same future as us, you can go to our data room, you can check out everything, and you can reach out. Thank you.
Yes, so you mentioned you're live on 8 chains. What's the current TVL?
Since we deployed in August, the latest version, the TVL would be something like $2.5 million with almost $1 million in outstanding debt.
Gotcha. And then as you think about it, I mean, there's been a ton of startups try to tackle like fixed rate lending, but most have failed. So what do you think, what are you guys doing differently, and what do you think is going to make Pawn DAO successful?
There is a cold start problem. And instead of us trying to create the whole market setup from the scratch, we leverage the existing infrastructure. Like back in the day when things like ETHLend started, none of that was existent, including the technological tooling, but also the open lending protocols. So our approach is not to try to recreate what Aave or Morpho does, but essentially just leverage the unutilized capital that they have by hooking into these lending systems and just providing a better yield, better terms for the same supply.
You mentioned you're raising $2 million in token?
Yes, it's a token round.
So what would be the utility of the token?
the protocol will be, or it actually was already handed over to the DAO. We are taking this like minimal setup DAO approach. So right now, we have over 80 different parties participating on the governance of the protocol. The protocol works in an append-only way. So the people who participate in governance can decide on new loan types and how the protocol expands. Otherwise, the loans are fully immutable, so there's no way to influence them.
How are you thinking of onboarding different like capital holders of different kinds and their assets onto Pawn?
So Pawn is completely permissionless. You can right now use it for any ERC 2721 or 1155 token standards. But there is definitely a lot of work to be done on the BD side, and that's why we are raising the capital before we actually want to go public with the DAO.
Thank you. Do we have more questions from the jury?
Yeah, you mentioned that the protocol is already handed to the DAO, so I wonder who are the profile of the main contributors and how are things going right now?
It actually happened on December 1st, so this is 3 days old.
Oh, wow.
So we don't even have a proposal yet. We are still distributing it to more of the advisors. I mean, it's a due diligence process and like a lot of bookkeeping.
Okay, got it. Thanks.
Awesome, thank you.
Awesome. Well, Joseph, thanks for joining us today.
Thanks as well.
Thank you. So now, this is the last moment. We'll get some very specific feedbacks for PWN DAO from our jury members before we move on to the global selection of the winners.
So before we start, I also wanted to just do a full disclosure. Like, I'm an investor in Pawn DAO. So I've participated in their previous rounds. One thing that I've noticed over time is that like the demand for peer-to-peer lending has been really important. Like even myself, like I've wanted to have a protocol like that. That's why I was really interested in that. Like the feedback I have as a user of Pawn, because I've tried to issue a few loans, is that these loans usually, like the only hard part is like when you have an RFQ type system where like you sort of create your own market and you have to find someone to fill it, right? So if you're someone who is well connected capital-wise, then it's quite easy to probably find a counterparty that's willing to settle on that protocol. But if you're a single player that maybe like you don't have that much access to capital, you can only be on the taker side, not on the maker side. But hopefully if there's enough awareness for that market and liquidity starts sinking to it, then people can finally like have a lot of markets to take from. Or even if they create a market, there's someone who wants to take that peer-to-peer lending opportunity.
Yeah, it's one of the fixed rate lending is kind of one of those things over the last like 3.5, 4 years. Everyone's like, it makes sense. Like, why doesn't it exist? But for some reason, it doesn't exist yet. To his point, though, I think a lot of it is the space and what exists in the underlying infrastructure. Fixed rate lending is kind of like a secondary or tertiary kind of on the DeFi kind of stack. And so I think we're at a spot where this can be successful now that you have like the underlying liquidity pools like Aave and more of them being composable with them. I think will be key for that, solving that cold start problem.
Got it. Lou, would you like to add one last word?
So I guess we wouldn't have enough time. Just wanted to say, I guess it's a very early stage project, but still with good growth potential. So I guess it's important for investors also to take a look at this kind of protocol right now. Yep.
Thank you so much. Well, in seconds from now, we're going to pass to the most interesting phases of the startup competition. So I think we've heard those 6 contenders. They all have something to defend. They all have a vision for their solution. And now I'm going to ask our jury members what are their top 3 picks. But before they make up their minds, because now it's time to decide whether they want to put, like who they want to put in first, second, and third position, which will end up receiving points. So to outline the rules, if you put a funder in the first position, he will get 7 points. The second position funders will get 4 points. And the third position funder will get 1 point. That way we'll be able to add up all points and determine who are the first, second, and third winners of Starting Block. So before you give me your top 3, I'd love to hear from you. What do you think of overall those 6 contenders? Would you like to start, Charlie?
Of like them specifically, or just as an aggregate of the 6?
For now, I'd love an overall appreciation of like the level of the founders, the stage maybe.
Yeah,
What you think?
I thought all the founders were great and presented really well. And what stood out to me is just the breadth, right? You had everything from kind of a 2.5 managing the on-ramp from traditional finance to decentralized finance. You have very innovative DeFi protocols kind of tackling like the next generation of DeFi composability, availability in the DePIN space, and then also the consumer-focused apps with Lemonade and Newcoin, which just shows like how broad blockchain technology is, and you have all these companies building really impressive products tackling a lot of different aspects of the stack.
Thank you so much. Lou, would you like to follow on?
Yeah, I think it hits really different with the founders really presenting the project rather than just seeing their pitch deck in the data room that you shared. And I do think it makes a difference because from a let's say primary market investor perspective, I still think the founder's presentation, the team itself is very important. It's actually, sometimes ideas can be repetitive, but founders can make differences. So really happy to see, really good presentations today with founders that are really confident at speaking publicly and also presenting with a very methodical, way. Yeah.
I can only agree with you. What about you, DC?
Mm-hmm. Yeah, so yeah, I second all the points said before, right? Like there's a lot of breadth, a lot of interesting things. Crypto feels like a technology that can be used anywhere, just like AI. That's, I feel like, why the two are sort of one of the most interesting areas to be in. I feel like in the time that we've been here, there's a lot of interesting things where there's people building interesting protocols, there's people building interesting primitives, and things feel ready that now that we've had a lot of time to iterate on different form factors of how to distribute these products, how to build them in the first place. The thing that we need to focus on most is customer acquisition. So of course it's like really hard to measure if the teams that presented over like a 3-minute or 5-minute period, if they're the right team for the right job. But they seem to finally start thinking, like when you heard pitches 5 years ago or 3 years ago, 2 years ago, people were mostly thinking about building better tech or building infrastructure. Now people are thinking more about the user because the infrastructure feels like it's almost there or it's pretty much there. So I'm excited to see people finally start thinking of the user and work backwards into their products as opposed to having to think about all the missing pieces that they need in order for something to even be possible in the first place.
Mm-hmm. Yeah, I feel like 3 years ago, every consumer or retail-facing app became an infrastructure layer out of necessity because they had to build out all this bespoke things. They realized, why don't we just turn this into a platform itself?
Amazing. So I think we're now ready to unfold each of your top 3 picks. So I'd love to start with you, Charlie. Can you give us your third, second, and first position contenders and defend your top 3?
Yeah. So third for me was Pondao. Second was Lemonade. And then first was OneSafe. Yeah.
Sorry, which is the second, you said?
Lemonade was second.
Lemonade, so perfect. That's 4 points for Lemonade, 7 for OneSafe, and 1 for PWDAO. Lou?
On my side, it's so Lemonade on third, OneSafe on second, and Pondao for first.
Pondao first? Thank you. So now we'll get to the last judges to tell us his top 3 picks.
Yeah, so I noticed that I'm in an interesting situation because I mentioned I'm already an investor in Pondao. So, and also we're tied for the first place, so I'm the breaking point right now. So it's an interesting situation to be in. But personally, I believe that Pondao is great, but this time I also really liked all the other teams as well. So for me, the number 3 is Lemonade. I really like the events team. I've used them in the past as well. And I really like Pondao, but I had to put them second this time and put OneSafe first because I feel like Pond has a lot of great go-to-market and stuff, but OneSafe is also something that I feel like the crypto space right now is demanding a lot. So that's why I put that in that order.
Amazing. Well, I think we just have our top 3 picks. If you're done the computation, you should know about it where we are now. So on this piece of paper, I'm going to announce who are all top 3 winners. So by now, I think we'll have amazing giant checks joining us. Thank you. For the 3rd position of this startup competition, Starting Block, with over $1 million in prizes, with amazing partners, I'd like to welcome Lemonade, represented by Jacob. Please, some applause for him. Congratulations, you can grab your giant check. No place. And join us in the middle of the stage with the jury. For the 2nd position of contender of Start in Block, I'd like to welcome Joseph from Pound DAO. Please, again, some applause. Congratulations. You can grab your title. And now you should know who is going to be the first winner. Please, some applause for Chris from OneSafe. Congratulations. Here's our big check. This is yours. All right. All right, so I think we can have all jury members standing for a group picture. I think we have some enthusiast partners who wanted to join us on stage, or we're going to do the picture now. So, would you like to come forward on stage? We have a photographer who's joining. So I think you'll be in the middle for the first place. Here, you can join us. And we can have the jury members right across.
Here.
Perfect.
Awesome.
Perfect. Lining this up.
Thank you so much.
Congrats. Yep.
Congrats.
Well done. Congrats. That was great.
Welcome. Welcome.
Congrats.
Sorry,
Congrats.
Yeah, that's yours, guys. You've earned it. Great job, man. Well done, Charlie. Good having you.
Thank you for joining us. My name is Jason Shubnell. I'm a news editor and markets reporter with The Block. And we're here today to talk about how we're making crypto genuinely more accessible to retail traders and retail users out there. Get us started. Let's everyone get a chance to introduce yourselves, who you're with, and briefly what your company works on. If you want to start outside in, Max, if you want to kick us off.
Thank you very much. My name is Max Bohnen. I am the founder of PVO1. It's a startup that puts real-world assets onto the blockchain. And prior to that, I was at B2C2, one of the main dealers that services retail brokers in the crypto space. And yet before that, I was an interest rates trader in London.
Hello, everyone. I am Sam, and besides being a fruit enthusiast, as you can see, I am also a community spokesperson for the Tron DAO, which is one of the largest decentralized autonomous organizations in the globe, and we're dedicated to fostering emerging technologies like Web3 and growing the Tron network. Happy to be here and very excited to also be in Prague, and a big shout out to The Block for setting up this conference.
Hey everyone, Bill Barheit, I'm founder and CEO of Abra. We provide crypto services to consumers in like 100 countries, trading, custody, yield, lending, staking, also to institutions and to high net worth and users and family offices.
Hey everyone, I'm Linus. I'm with the revenue team at Zero Hash. We provide embedded crypto or digital asset as a service, which simply means that allowing companies of any sorts to launch crypto products without touching crypto.
Thanks. And stablecoin adoption and the addition of spot ETFs, especially in the U.S., has helped drive the retail use, especially over the past year. But in many ways, we're still very early on in the game here. And so I'm just curious to hear your guys' perspective to start things off. How has the narrative changed in highlighting the relevance of crypto and digital assets to the everyday retail consumer? Bill, you want to start us off?
Sure. I think given what we've gone through in the last kind of 8 years over 2 cycles, a few things have changed significantly. One, I think a lot of retail users, traders are savvier than they used to be, either through hard lessons, dealing with the likes of BlockFi, Celsius, Voyager, FTX, whatever. In those instances, users were effectively a liability on an exchange's balance sheet. And in English, what that means is when you deposit onto an exchange, you're effectively lending your assets to an exchange, just like when you deposit in a bank. That's not hyperbole. You are physically lending your assets, which is why you're a liability on their balance sheet. Everything's going fine, no problem, but when things blow up, you fight it out with, as a creditor with the bankruptcy court. And so one of the big changes I think you're going to see is this emergence of crypto banking services that don't make you a liability on their banking sheet and use a vault-like model to protect client assets. And that's something that we've been working on for years. One of the reasons we're still here when all these other companies blew up is that clients' assets are fully protected because you're no longer a liability on somebody else's balance sheet, but you can still access trading, yield, staking, the ability to borrow against your Bitcoin, Ethereum, Solana holdings. So I think the savviness of a lot of retail users for us is the biggest and most important change. And as a result, they're asking the right questions. Number one is, what happens to my stuff if you go away? And if the counterparty, like Abra, doesn't have a good answer to that, which I think we have a very good answer to that, then move on, right? And I think that's the biggest change that we've seen.
I guess to add on to that, I think a big narrative that's being pushed as well is the user experience aspect in the past 2 years. I think developers are really starting to put a lot more emphasis on having actual user interfaces that are friendly to mass adoption and retail users, and also structuring campaigns around that so that we can get more mass adoption from top-down funneling approaches, whether that be through marketing campaigns or more ecosystem development initiatives in markets where they could really utilize blockchain technology. So I think user experience has really grown a lot in the past 2 years, as any sort of emerging technology tends to do as it starts to progress and mature. As more developers start to understand the nuances, especially in blockchain technology, because it's difficult to abstract at times, but now we're seeing more of that abstraction, whether it be via gas abstraction. I believe it's EIP 337, I might be butchering that number, where now you can actually make payments not with the native utility token, but you can actually make payments straight with just Tether and buy a cup of coffee without actually having to have the native token. So I think that's a big thing that's also helped with mass adoption, as well as RWAs being more accessible and that into the market. I think in the past 2-3 years that's become more popular, and that's going to be a big driver for ETFs in other markets, not just across North America.
If I would add, I think another important thing that I notice is the mindset shift as well, both from the retail and enterprise side. So crypto as such is no longer being seen as just speculative only, or just playing with the price, going up and down. It's actually being focused on the value that's being provided and in the utility that you get. And that's both from the use cases as well as from the real users, especially in the emerging markets, and they're showing this firsthand, how they're able to tackle inflation, send money more cheaper, faster, along with the UX that simplifies entrance into the crypto space in the first place.
A couple of you touched on it already, but what do you think still like the main barriers to adoption to a widespread retail audience?
I think there's one. It's sometimes fees are too high. I saw a tweet yesterday of a very basic Ethereum transaction, maybe some kind of swap, like $250 fee. Yeah, because when the market gets elevated, you really see that pop through. But even on a normal day-to-day basis, anything you want to do in DeFi, if you use Ethereum mainnet, $10 to $20. I think it's to be that steep for retail, and that's a shame because a lot of the buyers that we have, because of regulation and otherwise, you don't really have them in DeFi. But in order to participate in DeFi, it's got to be way cheaper. And as a DeFi user myself, I find that the further away you start to go from Ethereum mainnet, then the more clunky it becomes. You got a bridge, and sure, the fees are going to be lower, but lots of stuff doesn't work. There's no liquidity, if you want to say. Even just taking some USDC, turning them to Tether on a big L2, like let's take a Polygon, there's very little liquidity and you've got huge price impact. And I think that itself is a huge barrier because as we see the success of Tron, especially in the context of Tether, has really also been underpinned by its extremely low fees. And I think we've got to generalize that to Tether, to DeFi if we want to support retail adoption a little bit here.
Yeah, and if I can also add on to that, hence why I'm wearing the banana, not just to look more expensive, but it's also to showcase how marketing campaigns of any size could actually get more mass adoption as well. So when you touch up on the aspect of the fee model, with the Tron network, we have it pegged into our protocol level where if you utilize the native utility token, you can actually earn energy and offset all types of gas fees that happen on chain. That I think having that type of creative technology in place can really help drive mass adoption as we've been able to see honorably in Latin America, Africa, Southeast Asia, which tend to be places where fees can be very detrimental. And sometimes, not everything has to be on the blockchain. You don't have to reinvent the wheel. So when fees get too expensive, more people are going to lever more towards convenience. So I think blockchain technology has to really stick to that aspect of lowered fees, lowered settlement times, and increased speed, reliability, and transparency to ensure that we stay ahead of the game and, of course, continue to have more mass adoption.
So maybe just a couple of things. So reality check, the single most important factor in the software world when it comes to adoption of consumer technologies is motivated developer support. I don't even know what number 2 is. And in the last cycle, motivated developers were working on DeFi, yield products, lending products, and that was really important because it basically built out the protocols that we need for this cycle. To be able to borrow against Bitcoin, to be able to earn yield, have two-sided marketplaces to replace the banking system. Now, motivated developers who are getting funded or crowdsourcing funding or simply funding themselves are working on next-generation apps using highly performant L1s, right? So Solana, Sui, Aptos in particular are getting outsized kind of developer support for generating next-generation apps because they can develop really easy-to-use consumer-facing applications now that are 1, highly performant, 2, have close to 0 fees, 3, can basically use things like lending protocols, yield protocols. You can earn yield on a stable coin in the background as a neobank and not even know that it's crypto. And they don't have to worry about, okay, well, what happens if fees go to $15, which isn't going to happen on any of those blockchains I just mentioned anytime soon. So I think that motivated developers understand where the action is going to be for the next few years and are responding accordingly. And I think, honestly, I think this idea of, oh, we need better UX or we need, we need to fix this, it's all false narratives because at the end of the day, it all comes down to incentives, right? And the developers are going to be incentivized to go where the action is. And I think right now, it's very clear that the action is going to be on consumer-facing applications coming out of a nasty, nasty global downturn that we're probably going to face the next few years on fixing the banking system, fixing media, and fixing a bunch of other industries that probably need to be highly decentralized that aren't. So.
And what specifically, what's 1 or 2 things that your firms in particular are pushing for or working on to drive that growth over the next 1, 2, 3 years? Linus, you wanna?
Yeah, so I think one of the biggest focus for us at Zero Hash is, how can we abstract the complexities that come to, managing crypto, managing all the RegTech, and provide this as a simple solution for others to embed and launch their, crypto products. So one of the things that we did very recently, we launched an SDK solution which allows pretty much any platform to embed this and accept stablecoin payments. So it could be for trading, it could be for betting markets. So Kalshi was a very successful use case. A bit of an outlier given the election in the US, but again, there's a clear value proposition to have global transactions by default accepted from anywhere in the world with no chargeback risk. And I think this is still, although it comes with protections when you go via Visa or MasterCard, but for a lot of users, having this transaction with no chargeback rates that is global and often more cheaper. It's an immediate value add. So making sure that this works globally, it has a good enough UX and easily embeddable for the traditional financial players. This is, I think, very, very powerful thing.
I can tell you what we're doing. I mean, our thesis is that the current banking system is going to collapse in the sense that it's simply going to be replaced. We're not even going to really realize that it happens, but we're going to be migrating to a world where banking looks like Netflix, right? It's going to be always on, 24/7, global. You're not going to care, is it a U.S. company? Is it a Czech company? But it offers me the best yield. I can actually look on chain if I'm so inclined to see where my stuff is. I trust that I'm not lending my assets to some unknown entity. And that's the future of banking, and that's what we're committed to building. Can't necessarily, in the US, there's a lot of draconian legal issues that we're working through. I think we have a friendly administration to work through that. I can't call it a bank, whereas here I probably can. I'll get a cease and desist if I call what we're doing banking in the US, but it's banking, right? You deposit assets, you earn yield on the assets, you can lend, you can borrow against the value of the assets, you can do it 24/7, even on Sunday night when US banks are closed, right? Last night, Bitcoin hits 100,000, right? Yay. And the ETFs, which are getting most of the inflows, are untradeable because it's off market hours in the US. So all of that is going to be replaced with crypto-based solutions. We're not going to call it DeFi. We're not going to call it crypto banking. It's just going to be banking. And I think that the first step is what companies like Abra are doing, which is making these banking services available 24/7. We still know that it's crypto, but that's what's coming.
And I guess for Tron, at least in a DAO organizational sense, we're definitely pushing for more stablecoin adoption across the global south. As Linus mentioned earlier, people utilize stablecoins in these areas to hedge against inflation. And in a sense, a lot of them don't have that sense of financial infrastructure, so they really rely on layer 1 blockchains or stablecoins as that alternative to a system that they may not already have. So think of areas in Latin America, Southeast Asia, but most importantly, I really want to focus in on Africa, where intracontinental trade within Africa, or intra-Africa trade, is upwards of $85 billion. And of that, banking systems take out 10 to 12% at times on a yearly basis. That's about $9 billion a year. And that money in magnitudes is very, very powerful in areas like Africa. So if you tokenize a lot of those assets and bring it on a blockchain, now that's $9 billion of excess capital that emerging markets can utilize to pay for new items, increase more consumer spending. And then the second thing I would say is definitely user experience. I agree with Bill on the aspect of developers being very important. You need incentivized developers to build applications. But in order to get consumer adoption, you need UI that's very, very good. It sounds simple, but it really is that simple. I mean, take a look at Robinhood for an example. The reason why they were so successful is how easy it was to trade equities in US markets. So I think that's something that we need to see in Web3 more of, and that's something that we want to try to incentivize.
Yeah. And in that context, I'm hammering the point again here. But the level of fee is very important because if it's going to be banking proper, then you need to have the same services that you're used to in banking. And the most basic one is a current account that's been solved. You can self-custody. Mm-hmm. But then the second one is a savings account. And the savings account is something maybe like Aave. Or our product itself, we put it on Curve. The Curve AMM, so you can go and buy it from Curve. How much does it cost? It depends on the level of fees, but it's $10. Yeah? So $10 in, $10 out. And if you think of it, I reverse engineer at what level of wealth it becomes interesting. If it costs $10 in and out and you stay there for a year, which is a long holding period actually, and you consider, well, the $20, it can't be more than like a month's worth of interest. It can't be more like a tenth. So really, of the $20, that's got to lead to at least $200 of annual interest. Otherwise, the level of fees compared to what you gain is just too high. Mm-hmm. And $200 of interest at current rates, it basically means $5,000. So at the moment, DeFi, at least on Ethereum mainnet, doesn't really work unless you've got at least $5,000 in a one-year holding period. So we're not there yet. And the difficulty is that right now, there's cheaper chains, but they're non-EVM, they have slightly different ways of working. And so to integrate all of those, that's a technological problem. It's going to take a while. But it's also a fragmentation of liquidity that becomes actually quite apparent as soon as you want to touch those products. It's simple things as turning Ethena into Tether. As soon as you go outside of the biggest chain of all, it becomes really, really tricky. And I would love to be able to say, well, okay, it costs just like 1 cent to invest my money at 5% because I don't think I'm going to need anything for like the next week. And maybe it works at 1 cent, but it really starts to break down if you start to have to pay like $1, $2, $3 to do that on a weekly basis.
Yeah. To Max's point too, and you brought up a great point with liquidity aggregation, for example. I think liquidity optimization is super important. And it also plays into the point of user experience as well. If you don't have proper liquidity with a lot of these dApps, it's going to be very difficult for people to get in or out of potential transactions. And having like a yield-bearing stablecoin to cover those gas fees could be very, very beneficial to getting more consumer adoption as well. And it's just a matter of ensuring that that layer one or that settlement blockchain meets that apparatus to ensure that the yield that's generated can offset those gas fees. Otherwise, why would people utilize dApps when they could just use the convenience of the current system? Which again, it's options, but yeah, I think that was a great point.
And all that is for prosumers, right? Because you've got to remember that it's for people who get it and are willing to go and get their hands dirty to do that heavy lifting. If you start to look at users that are not so technically proficient, then it's got to be a little bit more centralized. But then you brought up the example of BlockFi and others. I don't know if the retail market as a whole is so keen right now to go back to using platforms like that. Although, as we know, people forget quickly in crypto, and Bitcoin $100,000, maybe that greases the wheel a little bit.
So I think what's going to happen though is you're going to see this cycle cross-chain DeFi emerge, and it's not going to be retail that's going to make it happen. It's going to be institutions, because they're going to be able to arbitrage and yield farm on different protocols running across Ethereum, Aptos, Sui, Solana, whatever. And that's going to set the stage for having bridges that make it super easy for retail apps to access that liquidity. And I think that's a key kind of last step that we need. Now, we're specifically talking about banking use cases for retail, obviously, but I do think that now that we have the performant L1s, you're going to see the bridges, you're going to see the cross-chain DeFi, basically all the challenges we had, and anybody in here who was using DeFi on Ethereum during the last cycle when transaction fees were $75 knows what I'm talking about, because nobody in emerging markets can deposit $25 in any kind of stablecoin into an Ethereum wallet if the fees are more than $25, right? I think at a high level, we've solved that at the L1 layer. Now we need to solve it in terms of the actual kind of, crypto smart contract-based banking. And the way to do that is to make it agnostic of all these chains with, protocols that are now kind of cross-chain, instant, with a layer kind of on top most likely. But I see a lot of developers working on this problem. And the rate at which they're able to address these problems now and incentivize money to come in to these different protocols. And we're one of the largest providers of liquidity into all the DeFi protocols. So we see this firsthand. It's remarkable. You launch a protocol on a Sunday, and by Friday there's $150 million in this new protocol. And so I think that I think you nailed a key challenge in making this work. But I'm also seeing in real time that we're highly likely going to be in a position to have this addressed in 2025.
Earlier today, a marketing officer from Binance compared the U.S. presidential election to a marathon and a sprint, with the sprint winning out, with Donald Trump winning re-election. And I'm just curious, do you agree with that? And how important was it for this pro-crypto administration to enter the White House at this moment in time?
How important was it?
Yeah, go.
Have you seen the price? I guess it was crucial.
Yeah.
Yes.
I mean, look, clearly the markets, institutional markets, believed that crypto was basically being held back, right, globally by the US, and the US polices the world through the correspondent banking system. Most Americans don't even understand that, by the way. that we effectively police the world's banking system by being able to shut off Czech banks' access to the global banking system via correspondent banks, which I think is criminal. But it is what it is. And so if you believe that that weight has been lifted, which clearly the majority of the planet now does, that was probably a 40% drag on the value of the crypto markets, which is reflected in the fact that the prices have gone up 40% since the election. And now it's really a function of money supply. And that's awoken retail, right? Because when you have incumbents talking about, congratulations, Bitcoiners on 100K, which I'm guessing, President Biden would look at that tweet and say, I have absolutely no idea what he's talking about, right? And so that's the difference in what we're dealing with, and it's clearly waking up retail now. If you look at sentiment searches, Google searches, one of our altcoin funds tracks meme coin sentiment, and we can see that retail is waking up.
Yeah. I try not to focus too much on the price action aspect of things and just try to grow the ecosystem, but I think what's really driven a lot of ecosystem growth and a lot of that sentiment in a positive manner is just the fact that there could be more regulatory clarity, not just in the US, but also across other markets as well, because as mentioned earlier, the US really tends to be a driving force, especially in the world of technology as well. So I think by providing more regulatory clarity, we're going to see a lot more adoption of cryptocurrencies across the United States and the broader North America and globe. And I'm very excited to see that continue to grow.
Yeah, and I think that this is also an important factor when we think about more of a traditional players and embedding the crypto products in that. So even though there's some clarity, but if they are operating globally and there's not a clear regime, they better choose to be risk averse and not to go into that in the first place until there's like a global standard. So the hopes are that in the coming years this will become much more clear. And we already have PayPal's, Robinhood's of the world in there. And as more traditional players come in, this will become just as well said, it won't be like crypto banking. It will be just another way of probably financial markets, 2.0, 3.0, I don't know, but
yeah, I agree.
And if I could also add on, I mean, there's also use cases for the technology within the United States. I think there was an article that went out about how the US could be looking into doing more digital voting and utilizing that on a blockchain system. Also in California, we also had the DMV adopting blockchain technology. So I think there's bigger use cases than just wealth generation that could be utilizing blockchain technology for other applications that can make lives much, much easier in those areas, whether it be for population census, like what we're kind of seeing with the DMV in California, or what we're seeing potentially with voting. That might be a taller task to go over, but there's a lot of applications that government bodies can utilize with blockchain.
Bill, you mentioned earlier, it's taking away the terms crypto DeFi, it's just going to be banking. What can the industry do to present itself? Is there a way it can present itself, much more directly and more, relatably to a retail user like that? What's the biggest thing they need?
Sure. I mean, it's like, when I was at Netscape, I remember sitting in meetings with Blockbuster. I literally went to Blockbuster, and we showed them demos of streaming services, and they said, "Yeah, that's very nice. Have a nice day." And so I think there's going to be two tracks here. I think there's going to be the track of, yes, banks will start to hold Bitcoin now that with the new administration, international banks won't have their correspondent banking relationships at risk if they happen to hold Bitcoin here in Czech Republic, for example, or in the US, wherever. That's great. I think they should be allowed to do that, especially if it's held in vaults so that you're not putting this on the bank's balance sheet. But more importantly, I think you're going to see upstart banks, now we're talking about Netflix versus Blockbuster, that are doing this the right way, that are building their systems from the ground up that don't use traditional bank cores that are based upon 70s mainframe technology, modernized, to run on whatever, that they're actually using smart contract-based systems, work 24/7, are always on, can meet the reporting requirements, but know that those reporting requirements are going to go away because it's untenable, right, to have 150 different securities and banking regulations in a system that has no off switch. So I think that the upstarts are going to win the same way they did on the internet and every other industry that's been, basically completely, flipped on its head by the internet. And banking has had this artificial moat around it for 50 years, because of regulation that's basically enforceable because of these arcane systems. And so now you're going to see probably I'll say 10, but I really think it could happen even faster. The largest banks and the fastest growing banks in the world, certainly in 15, probably 10, maybe faster, because it's going to happen so fast, people's heads are going to spin, are going to be crypto-based. And just like Blockbuster was one of the fastest growing companies in the US, and then literally overnight it just seemed to die. Right? And so when the banking system collapses, and I don't mean like there's going to be like some global depression, I mean it's going to collapse in favor of what I'm talking about, it is going to happen incredibly quickly. Because people are going to just have this bridge to move their assets to a truly, digital, always-on bank via stablecoins, and the banks won't be able to stop it, right? It's a risk for the U.S. system because obviously the U.S. bank, most Western banks are insolvent, but that's not our problem. That's the government's problem.
I guess, yeah. Do you want to go ahead, Max? Yeah, to that point too. I mean, you look at emerging markets, so Global South, as I mentioned earlier, a lot of them don't have banking systems whatsoever. So they're already kind of utilizing blockchain technology as that alternative, whether they utilize stablecoins to hedge against inflation or they're actually utilizing it to offset payments that they're making. We launched an initiative in the Philippines where people can now purchase or make payments for their Social Security utilizing USDT on Tron. We did the same thing or a similar thing in Argentina where now you can do public transportation payments utilizing USDT. We have about nearly 3 million, 2.5 million daily active users. A large amount of them are in those Global South areas. So we're already kind of seeing that use case or case study of people utilizing these types of technologies to act as their financial infrastructure because the current system that they have is either non-existent or it's very, very limited or not as transparent as they'd like. So bringing it to the globe is definitely something that could happen in the next couple of years and it'd be great to see.
I think that's a very good point brought up here on the tech, and I could refer this to some of the popular use cases that we already see. So the reason why Revoluts of the world, Robinhoods of the world, new banks of the world have been so successful because they started from scratch. The technology allows them to scale as fast as nobody else has done in the past. So if we trace this back to the crypto first, it's the same way. So the same way like M-Pesa leapfrogged kind of a mobile payments globally, the same way, as Bill rightly said, we will see other banks that probably we might not even know right now.
And they don't have an existing business to cannibalize.
Exactly, yeah. And that's a very powerful uplift, especially for those who are already like crypto first. So maybe, as you said, the Global South will drive the adoption, and being global by nature, then everybody will join either because
it also grows, dominance for the U.S. These are all fiat currencies of the U.S. dollar.
Yep.
It provides more reliance to a nation that should really be accepting and providing more regulatory clarity. But yeah, I just wanted to jump in there. Sorry to cut you off.
No worries, all good.
But just one point, because I totally agree with what you're saying. So the average consumer doesn't think about decentralization. I do. But they don't. They don't sit around saying, God, why isn't my bank fully decentralized? It's just, that's not a thing. But why does my bank have closing hours? Why does stocks trade 35 hours a week, right? When my exchange trades crypto, 24/7. Makes no sense. And so these problems, I think, are only solvable via the smart contract model of always on, 24/7, global, no off switch, et cetera, and it's fully decentralized. That's the technology answer, and it's going to cause a revolution in how apps are built in this cycle. Again, follow the developers, they're starting to get it.
And one last thing I wanted to say on that, not just on the decentralization aspect, it's very, very key, but also data. I mean, the data market is massive. And right now with centralized apps, they utilize that data and they're selling it to whomever may be paying the biggest dollar for it. Now imagine if DApps can now monetize that data and consumers now have access to that. Because yeah, they don't care if the bank is decentralized or whatnot, but they may care more about their data and being able to actually have access to monetizing that, which can allow them to purchase whatever they'd like or utilize that at scale. So I think that's another thing that should be focused on a bit more and could really drive more adoption of cryptocurrencies.
4 or 5 years ago, we saw Dogecoin run up incredibly, mostly off the back of people just wanting to buy it because it looked fun, literally just kind of on the name itself. And we're seeing that this year, especially with the growth of the meme coins. And I'm just curious, do you view the presence and the growth of meme coins as a net positive, introducing retail users to crypto, or is it a net negative for the potential pitfalls that come with it?
Any publicity is good publicity, right? I mean, the banana, it's done a lot in terms of top-down funnel approach for marketing. Now, obviously, with that being said, just because something's decentralized and open doesn't mean there shouldn't be boundaries in place to ensuring illicit activity doesn't occur. With Tron, for example, we've partnered or collaborated with Tether and TRM Labs. We created the T3 Financial Crime Unit, working with global intermediaries and partnerships, or government organizations, I should say, to reducing illicit activity that may happen on chain. So similar thing that could happen with meme coins. We don't want it to get too crazy to where people are utilizing memes for the wrong way. We want them to utilize it as a community jumpstart to mass adoption in a manner that helps bring more people on chain.
I think that that's naturally part of a cycle or of excitement. I mean, we also saw something similar, maybe not to the same extent with GameStop. I mean, it was also crazy nonsense, but some people made a lot of money, some people lost, but I guess those who lost, they knew the risk, right? So it's kind of the same. If it drives publicity, it might be better in the long run. But ultimately, I would also agree that there should be some, risk mechanisms in place, so this wouldn't, get completely out of control.
Yeah, I guess I see it differently. I mean, look, GameStop was very unique because for the first time, some Reddit users figured out how to fade a hedge fund, and it was more like, hey, great, let's stick it to the man, whatever. Fine. I mean, like if they can, usually hedge funds are taking advantage of retail, so if it happens the other way around, I really don't care. And I also don't care if myself included, who puts 0.2% of my crypto stuff in, Bonk and whatever, and I lose all my money, couldn't care, right? And I'm sorry for retail users who, if you start putting all your money in Pepe and it goes to zero, it is what it is. More importantly, like infinitely more importantly than that, is if I'm building a neobank on Solana right now, my first question that potential investors in my token sale are probably going to ask is, does Solana work? Is it going to scale to 100 million users? And guess what? We've been running the biggest global financial services test in history, in human history, on a decentralized platform for the last 18 months via this meme coin craze. It has proven that we can scale a layer 1 blockchain to 100 million users, to daily DEX volume bigger than Ethereum, right? With revenue generated on the platform more than Ethereum, and it's working. And so you can do all of that in theory on a testnet, but having it run on an L1 live where you can see the volumes daily via meme coins or whatever is happening is a gift to mankind. It really is. And I don't think that, that was Toli's grand plan to prove that they could scale Solana to Visa numbers, but they proved it, for however. And it's getting better, right? Firedancer is a huge breakthrough. And so I am extremely grateful that a bunch of retail degens, and I'll put myself in this bucket, have put money that we may end up losing into these meme coins because it's given us this huge gift as a result.
Got just a couple more minutes here, so try to wrap it up. But going into the new year, what is like the biggest thing you're looking forward to in terms of user adoption, user growth for your firms? Max, if you want to kick us off.
There's one thing I'm looking forward to, actually, strangely enough, is I find DeFi very complicated. And one thing that's helped, and I think it's going to get better, I'm not the smartest guy in the room, and so when I try to access DeFi, often I have articles to read. I don't get it. The one thing that's really helped me is LLMs. Whenever I have a question about DeFi now, I ask ChatGPT or something like that. And I'm starting to think sometimes, well, as LLMs get broader adoption, and surely, I mean, they've had an incredible adoption curve, maybe that's going to make some of our processes that we're used to a little bit more accessible to everyone else, and I hope there's a good interplay there. This is not, some sort of AI shilling here, but I do find it quite interesting how good the answers are that you get just asking ChatGPT, how can I bridge this from that, etc. It's quite good, actually. I know already that especially retail businesses actually in crypto are making huge use of AI customer services and have made incredible advances in cost savings there. So that's actually quite a good synergy.
Also, AI agents on chain are going to become very popular as well, and also training LLM models too. But in terms of Tron DAO, our organization, we really want to showcase the activity that we've seen on chain. We've been able to prove that we can scale Layer 1 blockchain to massive heights with nearly 3 million daily active users. Just in the past quarter, we generated, our protocol speaking, $600 million. And then on top of that, we've seen $15 billion in TVL locked, currently on chain. 9 billion transactions with a B that's happened on the Tron network since its inception about 6 years ago. And then on top of that, the total transfer volume is upwards of $1 trillion as well, if not more. So we've been able to scale a Layer 1 blockchain and have been able to bring it to those emerging markets that really need it. Now it's just a matter of showcasing that to the masses so that they can see that this works, it's right. I think we just surpassed 275 million total accounts. And of that, 120 million of it have over, I think, $15 or $10 in their wallet or in their account. So this is something we want to showcase because blockchain technology, it shouldn't just be something that is an extension of anything. It should be that thing, kind of what we were talking about earlier. And I think we're going to see more of that.
So I think for us in the next year, the most important thing that we're focused on is educating the public that crypto banking in this new model that I'm describing is safer than traditional banking, right? Independent of the backstop of the fact that they may print more money when the banks fail, right? You have a safe 24/7, always-on model now where you can actually see your assets on chain if you want to, but you have a super simple user experience that gives you access to stablecoin yield, crypto yield, lending, the ability to buy and sell assets globally, 24/7, always on. And I think that the public is going to recognize that there is this new crypto banking model that is safer than traditional banking.
I would probably extend it in a sense that I hope that everyone in the industry, us included, would optimize more on the UX and user value. So it would be more simple, more easy to offer the services so others could leverage the value and experience, let's call it new banking or banking reinvented, and could tap into the value that's already being leveraged by others globally.
Well, gentlemen, we are out of time, and we appreciate you all coming out here tonight. And we got one more panel left, so please stick around. Thanks again.
Yep, thank you.
Thank you.
No. Thanks, man. Yeah.
Thanks. Thanks, Dave.
Not finished. You thought it was finished? No, it's not.
Oh, there is Love that.
Hello, everyone. Thank you for coming to our panel. We know it's late. We know we have to celebrate the 100K on Bitcoin, but thank you for sticking with us for the last 40 minutes of discussion around staking. My name is Artem. I have a media in France and a crypto research platform called Oak Research. And here are the wonderful speakers. Could you please present yourselves, your companies, and then we'll get right into it. Laszlo, you can go, Laszlo.
Let's do it. Is it last panel or?
Yeah, the last panel of the day.
It's the best topic, huh? Staking.
Oh yeah.
We all come back to staking. So I'm Laszlo Szabo, the co-founder and CEO of Kiln. And Kiln, we are one of the leading on-chain rewards platform, staking in DeFi.
Nice. Great to be here. I'm Alexis Tabak. I work in the sales team at Chorus One, also an institutional non-custodial staking provider. I previously was at Gemini in compliance, but that was dreary, and glad to be in staking. I also host a podcast called Glitter Ledger, glitter like sparkles, ledger like the blockchain. And it's kind of a fun, cheeky interview where I interview movers and shakers and also scammers and grifters. But I like to use humor and a little vulgarity because I think we need a little bit of more of that in crypto. There's a plethora of crypto podcasts. Shout out Into the Block. Thanks, Frank. But I think that we need a little bit more humor in crypto podcasts, and that's also where I like to contribute.
Oh, we can bring that to the panel too. My name is Maya Schmid. I'm the co-founder and CEO at Alluvial. We're a staking-focused infrastructure company contributing to the development of staking standards, including the Liquid Collective protocol.
I'm George. I'm founder of Hinko, which is the biggest ZK private wallet. And I guess the reason I'm here is because we pioneered anonymity staking, which is not really staking, but it's a yield generative primitive that allows some predictable yield similar to staking.
Perfect. To start off, as this is the first conference since Bitcoin hit 100K, there will be a replay of this panel, and so we will have some people that are not familiar with crypto that might watch it. So let's just give a brief introduction to what staking is, what it is used for, and then we will get into the topic.
Yeah, I can start with this one or try to. I actually have kind of a funny story also. So I was on the phone with my best friend who's 90, my grandma, and she said, Alexis, what are you doing? What's staking? And I said, it's a consensus protocol. It's a consensus mechanism where you add transactions to the blockchain. And then I realized she hung up on me. And I called her back and I said, Grandma, why'd you hang up? That's so rude. This is my life's work. And she said, I just don't understand what you're talking about. What I just want to know is what's staking. So I said, and can I make money? I've been through the war. I don't have time for this. And I said, okay, Grandma, here's the deal. If you have Ethereum and you stake it, you're earning more Ethereum. If you have Solana and you stake it, you're earning more Solana. So do you know what she did? She downloaded a Solflare wallet and bought Solana and staked it, but then she also staked it to Kiln. So it was awesome.
She's so smart.
Yeah. So
I love your grandma.
Yeah. So it's awesome. So she got the. So she's staking to Kiln on Solana, and she's super bullish. But that's what my understanding of staking is.
Yeah.
Visionary woman.
Yeah.
I think it's worth mentioning that it also helps to improve the security, besides the yield, the factor that we.
Well, yeah, for sure. I was waiting for my peers too to add that if they wanted to.
Yeah, and I wanted to talk to you about the staking itself, because today the staking word is kind of thrown around a lot, because on the one hand, we have the network inflation, where every block you have new tokens which are emitted on the network, and then on the other hand, we have artificial inflation. So for those who have been here in the last cycle, when the ape token launched, that was staking on the ape token. But it was basically the tokens that were artificially created, and you did not secure the network or anything. So could you please elaborate on the difference between the two and give like a brief overview of how you manage the various stakings?
You mean the source of the rewards?
Yes.
Rewards.
Yeah.
I mean, staking rewards are, there's two sources. First is the protocol inflation, as you mentioned. So every year you have X amount of Ethereum plus, part of it is burned, so sometimes it deflates, but there's definitely an inflation in the protocol that's very predictable according to the number of assets staked on the Ethereum blockchain. Same for Solana, same for the others, so that's the inflation of the protocol. And then another part of the rewards is the fees. When you send or play with meme coins, when you do NFTs, and then you get paid gas fees to the network, and it goes back to the staker that has validated the transaction. So on, I would say, non-mature blockchains, the fees are usually representing a small part of the reward. On more mature or very hyped or very used blockchains, Solana, Ethereum, and the others, the fees are becoming the major part, actually, of the revenue you're making.
Yeah. Makes sense. So let's now talk about making money with staking. So on the one hand, we have anyone can do some staking through delegation, for example, or through some protocols. But how do node operators and staking providers actually make money? And I think it's an interesting question because we had a chat about this at the airport when we met. Could you please explain what is the policy for selling tokens? How do you approach this type of money that you get from operating nodes and providing a service?
Yeah. We do take a commission on the rewards that we offer to our clients and that they also can offer to their clients. And then usually it depends, I guess. Some staking providers will sell the tokens right away on weekly basis, which is usually what we do. We're not an hedge fund, so we have a reasonable crypto exposition versus fiat. And some others would have more of a hedge fund strategy and keep a big part of their balance sheet in crypto. I don't know how Chorus One is doing or how Liquid Collective is doing, but
yeah, I think that's pretty consistent. I think the most traditional way in which staking companies make fees is effectively taking a percentage of the staking fees that are being generated, effectively as a commission or a percentage. I think the fee market is changing slightly. I think there's two reasons for that. One, over time, because staking is a security mechanism, as more and more tokens get staked in almost all cases and for all blockchains, staking fees actually trend down over time, while the fees that are generated on the network as transactions increase actually increase. And so we've started seeing staking operators actually alter the fee models that they have, optimizing for things like MEV and other fees that are generated on the network to optimize performance. I think another thing that's been quite interesting, and I think Solana might be actually the first network where we're seeing this become more and more popular, is staking providers moving into supporting settlement. So instant redeems, for example, that they can effectively lever fees on to provide much more smooth and capital efficient transactions and also liquidations as part of the staking process for their customers.
I think it's also important to separate two approaches. It's a new blockchains where you heavily rely on new validators. So how would you track them? And here we see a lot of approaches with airdrops and with artificial inflation, right? So you somehow try to incentivize them to participate. While for older ones, right, it's quite efficient market. So you earn 3-5%, similar to what you can earn in T-bills. So I would say there's less playground to really earn something outstanding.
Yeah, and so if we take the example of Bitcoin mining. So in Bitcoin mining, you have two things that matter. So it's the cost of electricity and the price of Bitcoin, because the less it costs to produce a Bitcoin, the better you are. What are the costs that node providers and staking operators can have today? What are the most important costs in this type of operation?
There's definitely cloud provider costs. It's just like we don't buy GPUs to Bitmain and deploy it in the data center in the US, and then edging our electricity. We have different costs. We do deploy validators on cloud providers. There's a security cost. Like all of our business is around security. If we get hacked, if we get slashed, we are nearly done. And then there's distribution cost. Yeah, that's the main cost.
I would also add employee costs as well of top-notch engineers who understand the protocols that they're working on. That's a huge cost and pretty important, if not one of the most important.
We don't actually run the staking infrastructure, so I'll defer to the experts on both the software and hardware requirements for node operations. As part of our product, what we actually provide is orchestration across different operators, with the main objective being to mitigate potential risks of slashing, fault tolerance, and other things that effectively allow the distribution of stake across different market participants. For us, the biggest surface for cost and consideration is always audits and security. And so ensuring that we really optimize to ensure from formal verifications to pen tests to audits across the entire stack, we can ensure that we offer really bulletproof services to clients that are integrating with our APIs.
Yeah. I think overall what I see that staking follows Ethereum decentralization path with enabling new primitives such as solo staking. So basically the costs go down. And I don't know if there's any future for a lot of infrastructure since it will be optimized for everyone to run on its own computer.
Yeah,
It's a super interesting, actually, notion, just to piggyback off that, which is on Ethereum in particular, the economic incentives actually disincentivize centralization. It's different from mining in the sense that economies of scale are extremely prevalent in the mining industry, where there's heavy reliance on both electricity and hardware costs. When Ethereum was designed in the early days and still today as part of the Serenity spec, it was a core primitive to ensure that ordinary personal computers could run nodes sustainably on top of the network. And so today, one of the main mechanisms that has been implemented to ensure this sort of decentralization force on the network is correlated slashing, which we just talked about for a second. But there's actually discourse to continue to increase the incentives for decentralizing the network. I know there's an EIP that's currently in circulation to introduce attestation penalties, which basically even further reduce the incentive for participants to co-locate across cloud providers, on-prem structures, clients, and otherwise. So I think it's a slightly different dynamic from the economies of scale that we've seen in proof of work.
Yeah, and so just to get back on slashing, I think it's a really interesting topic and it's really important in staking. So how do you manage slashing today? Because I guess the slashing depends on the activity of the validator and of the node provider. How do you approach these types of projects? Do you have insurance? Do you have something to respond in a case of slashing?
Yep. Slashing is the concept of double signing, double attesting block transactions. And usually when you look at slashing historical event on the Beacon chain on Ethereum, most of these events, I think all of these events have been done because of just misconfiguration of the setup. So it's basically a node operator or a staking platform accident versus bad intention of trying to attack the network. What we do at Kilns to make sure we've never been slashed and we never will be slashed in the future, fingers crossed, is basically you try to monitor the keys, making sure you never deploy 2 times the same keys. You have a certain way to deploy the validators and a couple of other mechanisms. We've actually released a bunch of articles with the Ethereum Foundation on the topic. And then we have insurances. Large other staking providers have the same. We usually insured by 3 times the amount of the total amount that ever been slashed on Ethereum. So to say staking is the risk-free rate, I think that is very risk-free until we get slashed.
Yeah. No, I think that was a good explanation. The other thing that I would say is it also varies by blockchain. So for example, on Solana, there is no slashing. So already that risk is mitigated by virtue of what chain you're staking on. And with Ethereum, there are so substantially small instances of slashing, if at all. And with reputable providers like Kiln, like Chorus One, like some of our other colleagues in the industry, I would say that there was also 0 slashing events. It's a lot rarer than people think. It's because of such a scary terminology. But I would also say that there are insurances in place, at least at Kiln and at Chorus, so that if indeed you were to be slashed, you would be reimbursed for these rewards that were allegedly lost.
Yeah, I would agree with that. I think operators have done tremendous work to raise the bar on operational excellence and security. I think there's probably 2 ways to look at that risk. It's the preventative part, so what can you do to ensure that you do not get into a situation where you get slashed in the first place? And then there's, of course, the following or subsequent action, which is most effectively in the insurance market. So on the preventative side, we've actually invested a ton of work with a lot of our partners, Coinbase, PricewaterhouseCoopers, Blockdaemon, to develop a node operator risk framework that provides adequate risk measures and also standards to help think about things like key configuration, client setups, infrastructure configs that can help operators effectively mitigate some of the risks that can exist with faulty configurations. I would say outside of the preventative aspect of the market, traditional insurance markets are extremely immature. I think to date, the largest slashing insurance coverage that has been rolled out covers about $5 or $10 million in assets, so it's minute. The insurance market has not ramped up to support that, but there are alternatives. So you have more DeFi focused solutions like Nexus Mutual that have been effectively able to provide coverage for a number of different staking providers in the market. I think there's more and more commitments from node operators to take on part of the coverage inside of these potential occurrences, and so operators that we work with actually provide that as a guarantee to their clients.
Yeah, and I actually checked the stats, and slashing is below 5 basis points now, so almost it doesn't occur, right? So, glad you guys solved this problem, so we don't have it. But ultimately, I think slashing really follows the smart contract hack trajectory, right? So before we were all talking about smart contract hacks, and the past year actually they almost never happened. It was always social engineering of keys or like similar type of problem. So I hope and I actually think that the next year we won't talk about slashing at all, right? Because it will be embedded in the infrastructure that you guys provide without any risk for having it. So insurance costs will also go down, right?
Yeah, I have a question also about, like we talked about various blockchains, and do you think there is a network effect involved in staking? Just to explain a little bit what I mean by that is today we have DAOs and foundations which have huge amounts of tokens, and in order to ensure the independence of the vote or of the governance, for example, they tend to delegate it to node providers and staking operators. And so today, when launching these protocols, most of the time they have like a white list of operators or like the top 100 validators that will be able to vote on the blockchains and to be operational, to offer yield, and it happens through their delegations. So do you think that having good relationship with DAOs and foundations is a really important part in staking for node providers?
Oh yeah, definitely. They're our primary partners. In the end, we're here to empower protocols, validate their transaction, getting rewards if they're happy enough to give us good incentives to be on the network. So yeah, I think we should be close to foundations. If you are here to bring value, just running a validator is not the only thing you should do. Developing open source stack, distributing them through a custodian, a wallet, an exchange, a neobank, and a banks, and yeah, trying to bring value overall to foundations and protocols.
Yeah, and also establishing relationships with those foundations as well, especially as new networks launch and run on testnet. For example, there was a network that just launched, Namada, and I believe it ran on 12 testnets in 2 years, and Chorus was on every single one. So it was like we were there from the beginning and witnessed every single testnet, offered support, feedback, and really developed a relationship with them. So we were kind of there from the ground up and supported them in that way. And I think building that relationship with the foundation is absolutely crucial. I mean, Artem, when you and I were talking and getting to know each other and you said, oh, Chorus One, Cosmos, I mean, that was kind of our original starting grounds of being the original Cosmonaut validators and then expanding into the 65 plus blockchains. So yeah, the foundation relationship building is absolutely key and critical.
Yeah, and so this year in general, we have lots of talks about the fact that the institutions are coming and they are here now. And so staking is also a huge part of it because you can offer white label services for validators where you create nodes on someone else's behalf and you manage it, and then basically they provide the capital for that. Could you please explain a little bit how this works and who are the types of clients looking for white label today?
What would you call institutions?
I mean, what I mean institution is like, for example, you have a company which reaches out to you and be like, yeah, I want to have a validator on Cosmos, for example, but I want to have my name stable on it, and I want to be able to communicate the fact that I am running a node on this network.
Yeah, I guess there's a couple of ways to serve clients. You could say an institution is a wallet that has enough cryptos so that you should treat this person or this company as well as you would treat a large traditional financial institution. Then you have the platform, the wallets, the custodians, the exchanges, the new banks, and maybe tomorrow the banks that want white label services when it comes to staking and DeFi. And I think what the market is referring as institutions the past 12 months is the traditional financial institutions, and that the asset managers, for example, the ETPs, the ETF, which will be major stakers tomorrow, are part of this group, or maybe the banks as well. Yeah, and as like Kiln, of course, or Liquid Collective, we're here to power them for sure, because this is the next wave of staking adoption.
Yeah, I think also the wave comes from treasuries, new treasuries to be created, right? Fireblocks is onboarding a lot of Web2 institutions, accumulating a lot of Bitcoin, but now also ETH, right? So since they also have ETH, now they want to have yield on this ETH, then they go to you, right? So I assume there are a lot of new upcoming institutions that we call enterprises coming, willing to have it. But I think if they buy ETFs, right, that's alternative way. But ETFs don't distribute staking yield yet, right? At least in the US. Maybe in Europe, you guys know better. So I think that's another trajectory, right? So before ETFs actually distribute staking yield, they will need your service, right, to have additional, like, to maximize the value from ETH or SOL, right?
Absolutely. I think we can probably all agree that the single most important unlock to institutional and mainstream adoption has been and is regulation. I think we're seeing a tremendous shift following the US election and the attitudes and the sentiment towards adoption, unleashing the potential for institutions who've had to sit on the sidelines until today to actually participate, whether they are ETF providers that are looking to get approvals on staked ETH ETFs, whether it's asset managers that are looking to enter the space with their existing bank accounts, whether it's banks in the US that under SAB 121 have simply not been able to offer custody in any scalable way if they're publicly registered. And so I think that's what really opens the floodgates now. And I think we've started seeing that. I mean, inflows in the US ETH ETFs has been $1 billion. I think it's the first time that we've actually seen a stakeable asset surpass inflows in Bitcoin in the last couple of weeks since the election. And so I think when you think about the institutional market, you can clearly distinguish, I think, from a lot of what I think in crypto we call institutions. Okay, crypto native VCs or crypto native wallets or crypto native enterprises. When we think about regulated entities, the solutions that they'll be looking to is making absolutely no compromises on their security, ensuring that they can build products that align with the compliance and the security needs that they have. And over time, I think we'll see much more innovation in that vertical. So we spoke about white label, traditional staking as a service, but I think orchestration, instant liquidity, receipts, all of these innovations will play a huge part in unlocking T+1 redemptions, hedge funds being able to run delta neutral strategies, being able to really unlock the product universe that can exist behind all of these different offerings in the market.
And so we have now some ETFs which have staking implemented in Europe, which are already live. We don't have this in the US yet. And so in the case where the staking is implemented, how does it work between the TradFi and how do you pay out the yield basically on these ETFs? How does it work?
I absolutely think they'll have to. These products are competitive. Do you guys remember when Bitcoin ETFs went live? People were like noodling on bibs of custody fees to get more customers to use their products. We're talking about percentage points. People are leaving full percentage points on the table that their users do not get access to today. If you have a stakeable asset in an ETF but do not offer staking yield, it will not be competitive. That's the first thing. I think the second thing is people will want to optimize for how much they can opt into these vehicles, right? Here's where the nuance comes. When you're staking on Ethereum, there's an unbonding queue. It can take a week, 2 weeks, 3 weeks. If you're an ETF, you have redemption requirements. So T+1 or T+2 is your window. There's an incompatibility there. And so what we're hearing from the market is ETF providers already thinking about how they can maximize passing through staking rewards to their users, how they can optimize the amount of the funds that they can actually stake, and how they can use things like receipt structures and credit lines to be able to arbitrage the opportunity behind that.
Do you think ETF in the US will be able to pass, and that's a legit question I asked to myself, will be able to pass the staking rewards they want?
I'd hope so.
I think so. When talking to a lot of ETF issuers, what really surprised me the most, I think, was how devastated they were that the staking piece of the ETH ETF did not pass. That was a critical piece that they were looking for in when the ETH ETF was issued. And I also think, you know, with the management fees being 2.5 and staking yields being for ETH being 3.1, 3.2, the management fee would then cover the staking yield, which was pretty exciting and would also change potentially this fighting for the BIPs that you were just talking about for Bitcoin ETFs. But as for whether it will happen, I don't know, but I know that from at least some of the initial conversations that it was disappointing, for sure.
And I'm going to assure you that if Trump can raise from his own website for his own campaign, we can definitely have reinvestments of ETFs for the yields.
So do you think the Solana ETF before staking added?
Yes, 100%.
I mean, I hope for asset managers, huh? Looking at the percentage rewards now on Solana.
Is it a competition for you, potentially?
Do you mean offering Solana or?
No, I mean if ETFs and then, you know, these yields are passed, right? So they can use probably, they can verticalize the stock themselves, right, ultimately.
ETF themselves, right?
Yes.
Yeah, that's a good question. I mean, first of all, we work with half of the top 10 ETPs in Europe, right? So these are customers. We're talking to the Hong Kong regulator about staking right now. You know, maybe I'm even confident we will be maybe launching staking ETF before the US. Will we be able to pass by the rewards back to users? I don't know. But definitely liquidity is a big topic. Can you stake 30% or can you stake 80% according to T+1, T+2 redemption requirements? Reporting, security. I mean, everything you expect from the highest institutional standards. And then verticalization. I mean, there's an event that happened recently in the market where Bitwise bought Attestance. Hi, Jim. I don't think he's here, but and I think, and Mara saw this prior because she was working at Buys and Shells and then become Coinbase Cloud. It's definitely interesting for an ETF because they start to verticalize. But the moment you are buying this company, staking company, Bitwise won't be able to serve their competitors, right? Like, do you really think BlackRock or Fidelity or VanEck is going to be saying, oh, we're going to go to Bitwise to get some staking services? Well, as Coinbase Cloud in 2021, 2022 had so much direct distribution, but wouldn't work with the other exchanges, right? Kraken or Bybit or OKX wouldn't use Coinbase Cloud as a cloud provider. So no, I think for us, it's pretty good. It's pretty interesting. The market is opening, right? There's consolidation, and if you're still there, if you're one of the last one standing, I think it's good.
Right. Well, there's always going to be a few because there has to be at least several staking providers, right, to keep the network decentralized.
That's
so
right.
It's not going to be a winner takes all because it can't be, right?
Can be.
Yeah, exactly. And I think consolidation is just a sign of a maturing market, which is good. Like, the technology is maturing. Healthy M&A is good for the industry. I think what's probably going to shift between, call it 2020, 2021, is a lot of the acquirers were also crypto companies, Coinbase, Anchorage. Things are going to shift, I think, more towards truly institutional markets. I think we'll see much more acquisitions happening within the traditional financial services sector. And I think what's actually really interesting, I mean, I saw it from the inside because Bison Trails obviously became the largest staking company in the world, got bought by Coinbase. We lost a lot of our clients because of the competitive dynamics and forces. Yeah. But if networks encourage market participants to continue decentralizing their stack, What is really interesting about that is that people will still pay for diversity, right?
Right.
And I think the network being designed in that way is extremely intelligent. You can run an in-house service stack and verticalize yourself, and you will still want to pay for the diversity that you get with other operators, independent operators or collaborative operators that ensure that your stack is sound and safe.
And just a nice record of happiness over the past months. Like 3 friends of mine received acquisition offers, and they really sold their companies, and they're all in crypto, right? Wallet, staking, and like infrastructure. But I agree with you that finally,
Great for them.
acquisitions are happening. So.
That sounds like a fun time.
When you say that networks will pay for decentralization, or will further pay for that, do you mean the users or the foundations themselves?
The customers.
The customers.
I think so. I'm yet to meet a large institutional client that will be comfortable running with a single operator. And increasingly also, more and more clients are also not comfortable being set up with a single custodian. There's sort of a dynamic, I think, that's evolving there where people want the optionality, they want the diversity, they know that it's important to manage and mitigate principal risks, and I think that's good. That means the network was designed in a way that's actually intentional and working.
Yeah, and so do you think there will be more M&As happening, because that's the topic that you were having? So we are seeing some on-chain M&As now between like various protocols, and so do you think that's something that would be that will happen more and more in the coming years, where a traditional actor which has a huge balance sheet that would be able to buy out a company which specializes in infrastructure and in staking in general?
Yeah, I think you start to see this in custody. BNY Mellon launching a custodian, well, all the US custodians, the QC, they're looking at this and like, well, maybe BNY could be a competitor in the future. Or at least buying our tech, but these asset managers, traditional players, hedge funds, pension funds, they trust BNY. And I think will be the same with staking or infrastructure play in general. You'll start to see more traditional players buying crypto companies. Because at the end of the day, it's like, this is not easy what we're building, This is not what easy with like Kiln and Chorus and Liquid Collective are building for years. There's expertise, there's smart contract, there's security, there's excellence, there's validators, reporting. People say it's a commoditized business. I disagree with this.
Yeah.
It's complex.
Just sell at the top of the market. I think that's also a good point as to when to sell these staking providers. But so we don't have much time left, but I would like to look at the 2 main trends that happened this year, which were airdrops and restaking. Is this something that actually is profitable for node providers and staking operators? Because we had some airdrops when you run nodes on the networks that are not live yet. So, for example, you mentioned Namada before. Is it something that is actually profitable? And is restaking an additional source of revenue for staking providers?
I can talk on restaking. And I was actually talking to several AVSs, right? And I was trying to understand, does it make sense for them to be AVS? And in most of the cases, the answer is no, right? Even we were thinking to become AVS, like to decentralize relay network, right? And then ultimately, right, you still optimize for launching a token, right? And if you want to launch a token, you never want to become AVS because you remove this single point of, your decentralization by letting someone decentralize you, right? So I think it's a fundamental mismatch of incentives. And so far, as I remember, there are 15 AVSs for Symbiotic, for Eigenlayer, and around 7 for Symbiotic. And most of them don't need to be AVSs, and at some point they will issue tokens. So I'm quite bearish on restaking.
For node operators, I mean, you said there's 2 trends, airdrop and restaking.
Yeah.
Isn't it the same trend? I didn't get it.
No, it's not the same trend, but it's 2 additional sources of revenue that have emerged.
I mean, our clients, they are retail users. They like airdrops. Institutional customers, they're like, well, where is the recurrent revenue in native token? So airdrops are fine, but I guess now Eigenlayer is having like a rewards mechanism that is clear. Same for Babylon. I think in February was the phase 2. Airdrops are good, but they're not sustainable. At least for institutional users. And for a staking platform or a rewards platform in general, we need to see recurrency. That's the core of our business. And we're fine to wake up one day and see a bunch of tokens on the wallet because we got an airdrop, but that's good for first distribution. Then you need to keep these networks and these marketplaces, validation marketplaces, sustainable.
Yeah.
I think it's pretty telling also that your question kind of looped in and mixed in restaking and airdrops together. I share your sentiments about bearishness in restaking. I think from the institutional perspective, it has been almost non-existent. I think in terms of defining institution, perhaps degen venture capitalists have been indeed interesting in restaking and earning additional yield of what is still somewhat unclear. So I would say no, it's not entirely profitable and in fact can be quite dangerous. There's definitely the supply for restaking. The demand is still to be determined. And as for airdrops, I certainly understand the desire to airdrop, especially when if it is a bear market and you don't have the TVL and you can't raise and you can't do a full test net. But for the actual health of the network, it is also concerning. But I think that you can learn a lot. You can and have a lot of fun with it, but I think it's also something to be very careful with.
Yeah, so it's not something to take into account when deciding to launch on a chain or deciding to run a node.
Yeah, I think it really depends on the market conditions, and I think it really is dependent upon what your goals are. Yeah.
And to end this discussion, Vitalik talked a lot about solo stakers. And it's something we should aim for in the coming years to decentralize the network and have a more inclusive network, basically. Do you believe that this trend is something that is manageable? And do you think that you guys could have a service for the people who would like to deploy their own node to help them out, or to have like a one-click deploy platform, something like that?
I'll give my controversial opinion that on networks like Ethereum, the margins are already razor thin. With an opt-in rate at 32 ETH, there's also a real barrier to entry for people who just want to set up nodes and run them at home without the technical expertise and support. I do think it's a discourse and a dialogue that's continuing inside of the core developer ecosystem, because solo stakers are important for diversity, and so those barriers to entry, those challenges need to come down. I think there are promising technologies that are looking to address this, including DVT, distributed validator technologies that make the configuration of operators and solo stakers much simpler, much more cost effective, and so I'm hopeful that we continue to see the right level of diversity across market participants on the network.
I think
it's definitely not getting worse as Bitcoin and mining, as you mentioned. The way proof of work is set is definitely push the small miners to the edges, or push the small miners to cut their operation because they can have a price of electricity cheap enough by kilowatt that makes their business sustainable. On staking, it's a long game. We build protocols that sometimes push decentralization, DVT, liquid staking protocols, but it's definitely not getting worse. That's what I can say.
I think it's a great way to conclude this panel. Please give it up for the speakers. And thank you very much for your attention, and see you all here tomorrow.
Thank you for staying this long.
Thank you, yeah.
For this very last panel.
Let's celebrate the 100K now.
Thanks.
Merci.